Say good morning to all of you. Happy Dasara to all of you.
Happy Dasara, sir. Good morning.
Good morning. Shall we start? Vijay Kumar, Sunil, shall we start? So, okay, I will just start my discussion. I will brief about as how to clear the examination. Just 2 minutes it will take. So before I could tell, let me just find out from you. Please introduce about yourselves. Unmute. And maybe firstly, I'm just seeing Mr. Purushothaman. And then to Shraddha. And to Arun Vishwanath. Introduce yourself.
Yes, sir. Good morning, sir. My name is Arun, and I'm a practicing cost accountant, sir, practicing in Hyderabad.
Okay. Shraddha.
Good morning, sir. My name is Shraddha Tachulia. I am a company secretary by profession, and I am from Kolkata.
All backgrounds are only overshadowing whatever you are speaking. Can you repeat? Can I come again?
Sir, my name is Shraddha Tachulia. I am company secretary by profession, and I am from Kolkata.
Arun.
Hello, sir. Good morning, sir.
Good morning.
I'm a practicing cost accountant, sir, and also a qualified company secretary, and I'm practicing in Hyderabad, sir.
Oh, in Hyderabad. Good, good. So now we
Yes,
will
thank you,
start.
sir.
How many participants? I do not know. We will start.
Good morning. I'm Purushothaman from Mysore.
Oh, that is another gentleman. What's your name?
Purushothaman from Mysore.
Mysore.
Practicing cost accountant.
Okay, okay.
I served for 39 years in public sector industry.
Oh, great, great. Okay. So we will start. See, I'm myself L. Muralidharan, practicing chartered accountant and qualified on this costing institute and diploma in IFRS of ACCA Institute. Then last month only I qualified in registered valuers course. See, for me, the area of interest being audit, taxation, as any chartered accountant would be interested to practice. I was also like that. By then, a gentleman who was an ex-partner of Big Four came for, am I audible? Right. So he came up and asked me as why not I could handle class for him exclusively. So besides practicing, I do take class for CA students at Chennai. And after this pandemic, across globe, through this webinar model. And when he approached, I didn't know much about this IBC requirement of registered valuers, etc. He's elder to me. I am 54. He should be close to 60. So when he took 2-3 classes during the day, my wife was asking, "What is that you are doing at this point of time? Any class? Normally classes would be in the morning and in the evening." I said, "This gentleman asked me. I can't say no for him." So then he asked if he can take up the course. Why is that you have not taken up this course? Is what she was asking. So for my wife's sake only, I took it up and cleared in the very first chance. So that was by September 8th. So now I have registered for RP also. There is insolvency professional. So besides that, my daughter is a chartered accountant, and she is not in practice but in employment. My son is also pursuing CA after doing B. He's into CA final. And my younger brother is also a chartered accountant and a CPA. He is working in Bahrain. So we have a lot of CA connection in family. So I put my wife also to CA, but my children told not to have all people in a family into CA. So she registered only for CA Foundation and she dropped. This is in brief about my background. So I qualified in the year 1987. I was just 21. And I find today a lot of people who qualify even much earlier than what I did during my time. So during my time, I was the youngest chartered accountant in the country. That was by May 87. There was no certificate and all that, but our regional council member was just telling this. Anyway, this is a brief background. So my area of specialization in taking class or this accounting standards, financial management. And last week itself, I am supposed to have taken on a Sunday. I could not just do that because of some other work. Today, we will start with Ind AS 38, followed with Ind AS 36 and 113. With these 3 hours, we can do justice only for these 3 accounting standards. And definitely, you people would be having some idea about this and how to take up this examination for clearing. I'll tell you that 60 is sufficient to clear. There is no rank, there is nothing like that. So therefore, your object is to clear only with that minimum 60. For that 60, you got to try. So from my experience of taking up the examination, let me tell you, if you are feeling confident of the answer, only answer for that. Where you have some doubts, please just don't answer because you have negative marking. And some 25 to 30 marks you have it on this financial management. Please go strong on that, and I think you can easily clear the examination. For me, since the subject being financial management that I take for CA final and at intermediate, for me there was no problem at all. So that was the capital for me to clear. I scored 63. I did not attend to all questions. So this is the secret, I would say. So don't try to attend all the questions. Now let's just take a plunge on the topic intangible assets. If you have any doubt, you can just raise your voice. And at this moment, please mute your thing. So what should be the objective of the study of this particular accounting standard is basically an accounting treatment for intangible assets. So that is the objective, accounting treatment. Then what is an intangible asset? Intangible asset is basically, we would come out saying that it has got no physical substance. So by and large, it is understandable, but under examination conditions, that is in MCQ model, they just don't expect this sort of general answer. They are got to be, we are got to be little more specific in answering. So they start with this way, where it is a monetary asset, non-monetary asset. So where you need to know what is the difference between monetary and non-monetary. Of course, in this case, we say non-monetary. So when we are knowing that it is non-monetary, firstly we should know what is monetary and non-monetary. Only then things will get seated in our mind. Monetary assets are those assets which will appear in the balance sheet or liability side, if it were to be monetary liability. So these assets and liabilities will be received or paid at the amounts at which they are stated in the balance sheet. Am I right? Let me repeat. Monetary assets and liabilities are those assets and liabilities which will be realized or paid at the values at which they are stated in the balance sheet. If you take up plant and machinery, that is PPE, the value at which it is stated is not the value that you realize upon sale. Investments, the value at which it is stated is not the value at which you realize. So these items will come under non-monetary in character. Same is the case, this intangible assets, the value at which it is stated in the balance sheet is not the value that you realize. Whereas debtors, the value at which it is stated, we would be realizing, theoretically speaking. Practically, you may offer discount, there could be bad debts. They're not really worried about these abnormalities. Theoretically speaking, the values at which they are stated would be the values at which you realize. Therefore, debtors would be an ideal example for monetary asset. Same is the case on the liability side, creditors, bills receivable on the asset side, bills payable on the liability side. So all these items are ideal examples for monetary assets and monetary liabilities. So you may be asked with MCQ this way: intangible assets, monetary asset, non-monetary asset, and with physical substance, without physical substance, that sort of combination in which questions will be placed. So you need to be a little more careful. So therefore, every term that they use in the definition or in the paragraph of that accounting standard becomes very, very important input, isn't it? So next item, which is identifiable, is what they say. And then lastly, without any physical substance is what we conclude. So what do you mean by identifiable? Say when we say that there is no physical existence for this asset, how it can be identified? So next question people would be asking, how this would be possible? Let me tell you, it is all possible. If I have to run this computer, I don't see Microsoft, but I can see Microsoft is driving this computer. So therefore, identifiable should not be understood as physically I should be in a position to identify. If I know that Microsoft is Windows is the operating system is driving the computer, it should be identified like that. It is non-monetary, identifiable, without physical substance. So in MCQ, these wordings are very important. So when you listen to the class, don't just be tensed and note down urgently and all that. Please just don't have that sort of tension in you, because I will share the PowerPoint with the RBO. You can take it from them, and in case of any doubt, you have my email ID, WhatsApp, and call. You can just identify that way, isn't it? So in a relaxed mode, please just take it up. Application of Ind AS, it applies to all intangible assets excepting these items which are coming under various accounting standards. They are all addressed by the respective accounting standards. And financial instruments in which there could be some reference about intangible assets, they are dealt separately under Ind AS 32. And similarly, exploration and extraction of assets, that also has got a lot of scope on those matters related to intangible assets, but they are having their own paragraphs which will deal with those rights and all that. And this way you just find these accounting standards on which intangible asset will have no role to play. So it is a scope that we are identifying. So these are the areas where you don't find Ind AS 38 having any implication, isn't it? So when we try to write whatever that is there coming in the screen, we will not be in a position to listen properly. Okay. So I will provide you the material. Please just don't worry about that. Then when to recognize? So what is the point of time they are to be recognized? So firstly, this intangible asset is expected to generate future economic benefits. FEB stands for future economic benefits. Elsewhere, FEB stands for February. Here it is future economic benefits, and the cost can be measured reliably. These are the two important points for recognition. In any accounting standard, we used to have recognition, measurement, reporting, and disclosure. These are the four areas you find accounting standards would be addressing, isn't it? So when to recognize intangible asset? When it is likely to generate future economic benefits, plus the cost can be measured reliably. How intangible assets would come to a entity? Various ways. Number one, when you acquire, when you exchange, when government is providing through business combination there, and in-house development also. So these are the ways through which you can get intangible assets into your system. Even goodwill is also a part of intangible asset only. So therefore, through business acquisition also you would be getting separate acquisition, part of business combination, a government grant, and internally generated goodwill, even though it is not recognized, but it is also an intangible asset. So through exchange, these are the ways through which you can have intangible assets emerging. What are the points at which you recognize them? Shall I proceed? What items are to be included in initial cost? Just like this property, plant and equipment, whatever expenses that you incur in buying it, and non-refundable duties if you have just paid, or those duties where you cannot adjust, those items are to be capitalized. If you can take input credit, then you should not be including that. And any professional cost that is involved, that is also to be capitalized. So purchase price including duties, but excluding those where you can take credit or seek any refund, that you should exclude. And directly attributable costs such as legal fees, cost of testing, employees cost, etc. Because sometimes what will happen is that you may have to engage them for testing, and our existing staff may also be involved in that, and their salary also to be taken for part of the cost of the intangible asset. Okay. What are the items that are to be excluded? So in property, plant and equipment, whatever discussion they have made, exactly the same they have repeated here. Finance cost should be excluded. That of course in all places they say, unless it is taking substantial period of time for developing that particular asset. In this case, cost of introducing a new product, cost of conducting business in a new location, including staff training, administration and other general overheads. So these items of cost, even though incurred, they are not to be capitalized, they are to be expensed. Shall I proceed? Then this is what I was just referring about. If deferred payments are made which are expected to exceed the normal credit terms, we are expected to take up only cash cost equivalent as part of our cost, and borrowing cost will not be taken up unless it satisfies the conditions given under Ind AS 23. Then initial operating loss. See, naturally any asset for that matter, before it is put to use, definitely there will be a lot of testing that they would be making, and during that particular period that there will be some initial losses or operating loss would be incurred, and the cost incurred during the period it was ready but not put to use, brought to use. They are not to be taken up for capitalization process until it is made available for the intended use. Whatever cost that you are incurring, that we would normally be capitalizing. Once it is ready for use, and when there is some expenditure that you are incurring post that particular period, we are not expected to include such expenses. So how intangible asset is initially recognized if taken as part of business combination. So please just understand, business combination is always promoting the idea of taking it up at fair value, only at fair value, even if the vendor did not identify one such item called as intangible assets in their books. But for the acquiring company, it is sounding as a separate item of asset, because as far as the vendor company is concerned, self-generated intangible assets are not given any recognition for accounting. But even though that item may be having some sale value, when an acquiring company is acquiring such an asset, we are expected to assign value for that. And what is the value at which it should be taken up? Only at fair value. So even though an item is not recognized by the vendor company in their books of accounts, for the purpose of there is acquisition getting done through 103 business combination, intangible asset is expected to be recognized in the books of accounts at their fair value. What is a fair value? That we will have a separate discussion. That is what we have just said. What is a fair value? Shall reflect market participants' expectation as on the date of acquisition, and exit price is what they tell. So when you say as fair value, so what we normally consider as a fair value, is it purchase price or the selling price? Because you would find different prices are available. So fair value concept is always exit price, that is sale value. But sometimes it is taken up at purchase price also, and we will have a discussion separately for that. So now itself I am just sowing the seed, and you should not be having a blanket understanding that fair value would mean it is always the exit price or the selling price. It is not like that. Sometimes it could even be purchase price also, but by and large we should carry that image that fair value is representing the selling price only. Shall reflect market participants' expectation as on the date of acquisition about the probability that expected future economic benefits embodied with will flow to the company, to the entity. So in earlier accounting standards, when you see government is extending a technology to a company for free of cost or at very, very concessional price, we used to record intangible assets in our books of accounts only at a very nominal value. If it is given for free of cost, we will take it about rupee 1, just to have a value for a particular item of asset. Even when it is given free of cost, you can't be just ignoring it, because when all assets and liabilities are to be verified, even though physically you cannot verify, but as an auditor we should know that this is an asset that you have. If you don't assign any value for that, you would not know that there is an asset there. So when you say, when you are making a report as true and fair view, true means what? Which is not false. So that means for whatever may be the value, but I am identifying all assets, all liabilities, all transactions are recorded. For that reference about true, I need to know that all items of assets are included. Only for that purpose, they are putting that rupee 1 as a hook. So rupee 1 is a hook value only. Hooking, please understand, in earlier accounting standards, we have recorded only at nominal value. So now after the advent of Ind AS, there is no question of nominal value there. Everything should be taken up at fair value. Only at its fair value. You can have a question like this way: government grant will be recorded at fair value, nominal value, concessional price, none of the above, or some other alternative. You have to tell only at fair value. Even if it is offered at a concessional price, when it is 100 crores and when it is offered at 20 crores, we are expected to book at 100 crores. For payment, you have to give credit to cash or bank 20. The remaining amount you have to take it as government grant. How the government grant will be treated, that is a different issue. So here we want to convey that intangible asset will be recognized only at fair value. How would intangible assets shall initially be recognized if acquired on exchange basis? So firstly, let us know what is exchange. We all know that, or we are all under the belief that exchange would mean if this is an item of asset. I'm not talking about intangible asset alone. Generally, I barter it. That is, I give my what I do is that the old item I leave it and new items I take. This is what we believe as exchange. But let me tell you that in exchange itself, you have two classifications. One is exchange, which will result in no economic substance, and exchange is potent of economic substance. What do you mean by having commercial substance? Exchange having commercial substance, exchange having no commercial substance. So, exchange having commercial substance would mean the exchange is likely to result in a substantial or significant change in the operating cash flow. Example, say as a Hyundai Motor Products company, where I have just given to government 100 vehicles, and in return I have taken some government land where government is allotting to me. So though it is not an intangible asset example that I am telling, but what I am just trying to convey is exchange which is not lacking commercial substance. So I give 100 cars, or I give my right and I secure another right. So I would just give up my telecom rights. I would be taking up pharmaceutical rights from another company. So this is likely to have impact on my operating cash flow. How come? So by using the pharmaceutical rights, I will be in a position to effect a new manufacturing or a manufacture of new drug, and that is likely to result in greater amount of cash inflow. And the telecom rights, where the market on telecom is fast declining with the arrival of Geo. So I am giving up that right. So my loss producing division can be avoided. So I could just enter into a new field which will have positive cash flow. This sort of exchange is what we call it out as exchange, which is not, or exchange which is potent of commercial substance. If you are exchanging, say, old car with new car, even though it is not an intangible asset example, old car and new car. So what we have changed is only old and the new. Will that have any impact or significant impact in your operating cash flow? Answer to that question will be in the negative. No, those items are not taken up as exchange in this particular accounting standard. Are you understanding? So where they say exchange resulting in commercial substance, exchange resulting that is lacking commercial substance, that's the way they classify. If it were to be exchange lacking commercial substance, this accounting standard is not addressing that particular issue in a great way. For example, old car, new car exchange. Old car will be credited, and the dealer will assign some value for that. And new car value, against a new car, the sale value of the old car will be adjusted. We are expected to pay the balance, and the difference between the carrying amount of the old car and the exchange value given for that particular car, the difference is going to be profit or loss on gain.
ज्यादा लोग पूछते हैं
Hello? See, if you have any point to make, you can just make your point, or else you can keep in mute mode. Okay. So sometimes it causes some disturbance my side. On my side, it is drawing my attention. Okay. So please keep them in mute mode. In case of any serious doubt where you find my audio is not working, there you can just stop me. Otherwise, you just allow me to proceed. And note your doubts, I will clarify towards the end. Unless it is so urgent, let the flow be not affected. So now you can understand exchange of intangible assets lacking commercial substance we will ignore. Exchange which will result in or which has got commercial substance only we will take up. Now the question is that what is the value at which the intangible asset which is coming into the system will be accounted? What is the value at which it should be accounted? That is the main issue for discussion. We are not really worried about the profit or loss on exchange. That is not our area for discussion. Intangible asset which is coming in, what value you would assign? That is what we will be focusing in this particular case. What accounting standard is saying? Yes, account the intangible asset which is coming into the system based on its fair value. Based on its fair value. Whose fair value? Fair value of the intangible asset which is coming into the system. Then that is the first preference. Then people will ask, supposing I am not having the fair value for that particular item of asset, then what is the way out? First choice is that if that is not available, then the next choice will be based on the fair value of the intangible asset given up. You may be asked with the MCQ like that, you have got to be very careful. Number one, the intangible asset which is coming into the system should be accounted at fair value of the intangible asset which is coming into the system, if that is available. Then people will ask, if that is not available, then what is the basis? Based on the fair value of the intangible asset given up, that which had left you, whose the fair value, because that is the mean through which you are acquiring the intangible asset. So therefore, the second preference is given to fair value of the asset given up, if available. Then people will ask another question. What sort of question they will be asking? If the fair value of the intangible asset coming in and going out are not available, then what is the basis on which intangible asset which shall be taken into the system? Closely follow. In all these cases, we are trying to find out the fair value of the intangible asset which is coming in. For that alone, we will find out the fair value of that particular asset. If that is not available, we will pick up the fair value of the asset given up as the fair value of the intangible asset that we are acquiring. In all these cases, our target area for discussion is only for the intangible asset that we are acquiring. What is the third alternative that you have? Third choice. If the first two are not available, intangible assets acquired shall be booked at the carrying amount of the intangible asset given up. This is the order at which you have got to do. Let me repeat. We want to account for the intangible asset which is coming into the system on exchange basis. First preference should be given to fair value of the intangible asset coming in, if available. If not, you have to take it up at fair value of the intangible asset given up. If both are not available, based on the carrying amount of the intangible asset given up. Only three layers you have. There is no fourth choice that you have. Are you understanding?
सर थर्ड पॉइंट एक बार फिर से बता दीजिए please.
Hmm?
The third scenario when the fair value of asset given up and asset coming up both are not available.
Hmm.
Then what will be it?
No, carrying amount of the intangible asset you should have in your books of accounts, no?
Okay.
So you can't have that as not available, because that is the one that you are having in your books. So you can't have
Okay.
that option getting out. Okay,
Okay. Okay.
that is not a possibility.
Okay.
Okay, this is what you are expected to know. I think are you seeing the slide moving?
Yes, sir.
Right. Okay, shall we proceed to next? Are you clear about this?
Okay. Okay, sir. Okay.
So I will just give you an example, possibly that will enable you to understand things better. You have intangible asset A acquiring, and you have intangible asset G that you are giving up. The fair value of this being 110, the fair value of this being 108, and the carrying amount of that, this is the fair value. The carrying amount of G is 25. So you have three different scenarios. What is the value at which this intangible asset acquired will be taken up? At 110, I will ignore these two. Correct? Next one, if this is not available, then 108. If this is also not available, then it will be accounted at 25. This is what we are telling. Are you clear?
Okay. Okay. Yeah, it's clear.
So this exchange would result in some profit or loss, gain or deficit. That should be transferred to P&L account without any hesitation. Shall we proceed?
Yes, sir.
Next one is, internally generated goodwill be recognized as an intangible asset? Answer to that question is in the negative. No. It prohibits the recognition of internally generated goodwill as an asset. So people would ask this question, why it is like that? So if allowed, then people will be playing around, and manipulation would be the next important thing they would be doing. So in order to avoid that sort of scenario, they have prohibited, you can't recognize goodwill which were internally generated. But other internally generated intangible asset will be recognized. So for example, we have an client who had developed their own ERP. So firstly, they have started with as an accounting package, then they've integrated, and nearly 6 months of expenditure what they have made, they were not knowing as where they are heading. So that sort of scenario, whatever money that you are paying for the developers and your employees who are devoting, were all to be identified as research phase. Then once they are hitting a point, they know that the future is likely to be this way, and further money is spent, or that particular phase, we call it out as development phase. That research phase expense, there is cost or to be expensed. And even in an accounting period, for example, you have interim financial reporting and all that. First 3 interim periods, you are not got that stage of development, and you have expensed them. In the last quarter, the criteria given in Ind AS 38 for development to take it up as a development phase, if you are satisfying those conditions, we are not expected to take up the earlier period expenses or earlier period cost for capitalization purposes. So even if an accounting treatment in an accounting period has resulted differently or discriminately or discriminative treatments that you have provided, one portion of that as expenditure, the other portion as capitalization, we don't have the right to take what was expensed as capital cost. An item once expensed is expensed, you cannot take that cost back and you cannot claim that as a capital cost. So therefore, we have got to be very careful, and before you could identify them as research phase or development phase. So once it is done, it's all over. Next. See, when there is no difference, they could bring out between research and development. So then we are expected to take up all the expenses only to P&L account. Expense it, isn't it? This is fair enough. So what are the criteria that we have got to satisfy? Here we have just communicating as only if the criteria are satisfied. What are the criteria? So this is a common sense criteria only. Whether it was AS 26 or Ind AS 38, they are all replica only. So absolutely, there is no big deal. You can just go through that and you can easily understand. Because in 3 hours or so, we are expected to cover good number. So just take care of this particular criteria there. I will provide you the copy, and even by chance, if RVO is not sending to you, you make note of my WhatsApp, you let me know, I will forward it. No big deal. Can the past cost be capitalized? Already we have made a discussion, not a possibility at all. No. How would intangible assets be recognized after initial recognition? So it is expected to be amortized. That amortization comes in the form of cost model and revaluation model. We don't have revaluation model under AS 26, but we do have it in Ind AS 38. What is it we are expected to do? In each one of those years, we are expected to amortize, which you call it out as say depreciation, cost minus accumulated depreciation minus accumulated impairment losses, which is equal to carrying amount. Revaluation model, same. Fair value minus subsequent accumulated depreciation and subsequent accumulated impairment losses equal to carrying amount. DO or date of revaluation. Okay. Shall I proceed to the next one? Is there any restriction in revaluation model? So yes. So for a particular class, you have got to have the same scale of valuation. We can't pick and choose one item for application of revaluation. What are those restrictions? Not applicable if it was not recognized as an asset itself in the very first place. So across, say, all softwares to be revalued would mean you can't have one item revalued, the other one, you can't allow that for cost model. So one particular item, for all the items in that particular category, revaluation model is what we have got to use. So this revaluation, this particular area I am skipping because more to do with computation. Say under the main examination, they just don't get too much of computational areas. What is the importance of useful life? Say useful life is so important for amortization purposes. So whatever carrying amount that you have minus the residual value divided by the remaining useful life will be the basis on which amortization is expected to be carried out. So therefore, useful life is so important in amortization process, where useful life is expected to be either finite life or infinite life, where the term between the vendor and the entity where they are not put any term. So we should only understand that it is infinite period. So when you have an asset which has got indefinite period of time, where you have the right to use for indefinite period of time, then no depreciation can be charged. Because what is the denominator that you can keep? No amortization at all. So you can't be taking, like in the case of AS 26. So in intangible asset will not be amortized for a period greater than 10 years. Even when the problem is silent or the scenario is silent, we will take up the cost of the asset, because in majority of the cases residual value will not be there, and that shall be divided by 10. Here there is no question of assumed number as 10. When you have indefinite life, no amortization at all. So we just go only by rule book. What is not stated, we can't have our own judgment for the purpose of treatment. What is conveyed in the accounting standards, that's what we are going to follow. However, those intangible assets which has got indefinite life, we are expected to take up for the test of impairment even when there is no indication. Impairment of asset, in that topic we will have a good discussion. There I will recall this particular item for discussion. Residual value. Residual value for in the case of intangible asset is going to be 0 unless there is a active market where the vendor is giving a promise that he will buy at a particular price. Commitment by a third party to purchase at the end of useful life has a guaranteed residual value, and it should be having an active market. Okay, are you understanding? So amortization, what is the meaning? When it will begin, when it will come to an end. So where the cost is considered to be an allocation of the depreciable intangible assets over its useful life. When to begin? When the asset is available for use. Not necessarily that it should be put to use. That put to use concept is there only in the case of Income Tax Act for claiming normal depreciation, additional depreciation, and so on and so forth there. Here there is no question of put to use. When it is available for use, you start your amortization. When do you close it? Earlier, when asset is classified as held for sale, or when the asset is de-recognized, whichever is earlier. What is this? An asset is no longer to be used. So you classify such item of assets under Ind AS 105. We don't have it this 105 in our syllabus, so we don't have to just really worry. The other one is that you keep this asset away from your list of intangible assets. So there is a time at which you stop amortizing on that particular asset. Amortization model is nothing but spreading the cost to the years in which future economic benefits are realized by the entity. If the pattern cannot be determined reliably, generally straight line method is what we use. Generally straight line method. So when you are not in a position to identify what benefits you would derive during this three years period, so better follow straight line method. And WDV, for which only when the policy of the company is like that, you can try. Otherwise, straight line method by default you can apply. Imagine that your basis of charge is on units of production basis. In a particular year, when production is not made at all, you don't have to charge it, or you don't have to amortize that item. When would intangible asset shall be de-recognized? Upon disposal, or when no future economic benefits are expected to arise out of that. What is this upon disposal? Disposal means we think that it is only sale. Not necessarily sale in all places or all circumstances, by entering into FL. What is that FL stands for? Any idea?
Financial lease, sir.
Yes, correct. Financial lease. And the other one is donation. So why I asked this question is that I think in earlier batch, one student was just, or one member was just telling about a financial liability. No, it is financial lease. So profit or loss shall be routed through profit and loss account. When it is derecognized, it should be taken up at fair value less cost to sell. The difference between the carrying amount and the fair value less cost to sell, that gain or loss should be transferred to P&L account. So that's all we have in the case of intangible assets. So now let us just take up MCQ. Shall we? See, I am just giving only lesser number now. So this accounting standard is quite easier when compared to 113. 113 fair valuation, we will just go, we will try 50 and odd MCQs. Whereas in this particular thing, it is very easy to score. Now let me just give you the thing. I would like you people to react. Come on. See, I've already told you the very initial stage itself. So it is non-monetary, correct? And having physical existence, not correct. And sorry. So monetary will not be there at all. So now between the two, here this will not come at all because they say having physical substance. So third would be the answer. Non-monetary having no physical existence. So it might sound simple. Let me tell you, it's simple only. But there can be some confusion under examination conditions. It might cause some anxious moments. Let us just take up the next one. Come on. A, B, C, or D. Please do participate. Come on. Nobody there?
See,
Huh?
C,
Okay.
sir.
Huh?
C,
C.
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 Correct.
see,
So make it fast.
B.
Huh?
It's B.
B.
B. Development phase.
Okay, good.
Nil, sir. A.
D.
D.
D actually.
D.
All of the above.
Shall be nil, or it could be minimum, or it could be. Okay. Shall we proceed?
So there is a criteria for residual value being nil.
Generally, residual value will be taken up as nil. Generally, only when you have minimum guaranteed value, when there is minimum guaranteed value, or When there is an agreement where active market is present, that would be the case. Generally, it is going to be 0. Generally, if you have an agreement for that, you follow whatever that you have. Or in the case of minimum guaranteed amount which is stated in the agreement, that could be taken up as residual value. Once an item is expense, it can be not be capitalized, deferred, none of the above.
Not be capitalized.
Yes, sir. Yeah.
Intangible assets provided at concessional rate or free
Fair
shall be
market rate.
reported at actual
See.
rate,
Fair
market
market
rate,
value.
C, fair value. Internally generated intangible assets are taken at fair value, taken at cost, taken at revalued amount, ignored from
Ignored from accounting.
sure.
No, no,
Ignored
no.
from accounting.
Taken at fair.
So actually, here in this particular case,
Internally generated.
intangible asset is what they are given. Actually, if it were to be goodwill only, it is correct. But goodwill is part of intangible assets, therefore it is taken up. Sometimes the question may not be having that much of clarity. Even B also. It could be B also. If the intangible asset is not a goodwill, where it is under development phase. So, as how one can assume it as goodwill, another person can also assume it as development phase. But what is coming really closer, people will immediately think of goodwill, and therefore we will take it up. So, one and only when they say as research and development, it is research and development, or else we can consider that as goodwill and take it up as D. Come on, 8. Can one of you read out this?
Exchange of intangible assets not lacking commercial substance shall be given the following priority order for recognition. Fair values of assets given up, fair value of assets acquired, and carrying amount of assets given up. B. Carrying amount of assets as in vendor's books, fair value of assets acquired, and carrying amount of assets given up. C. Fair value of assets given up, fair value of the assets acquired, and carrying amount of the assets given up. D. Fair value of asset acquired, fair value of asset given up, and carrying amount of the asset given up.
D is the answer.
Yes, sir. D.
D.
Is it so? Let's see. Correct.
Not amortized.
D.
Not amortized at all.
Not the amount of stock.
Intangible assets shall be recognized only if it is improbable to derive future economic benefits and cost cannot be measured reliably. Probable
D,
to
sir.
derive.
Answer is D, sir.
They just play with the
Economic benefit
combination.
and cost can be measured.
So now, Ind AS 36, impairment of assets. So kindly mute. So unless you ask any doubt or ask for reading, please just keep always in mute mode, causing disturbance here. This is fairly a very big accounting standard, but they don't ask deep down questions. So only at the preliminary levels, questions are being asked. Impairment of assets. What do you mean by impairment? Impairment stands for a defect. So days were gone, where people don't call a other person as blind. The way in which they are called is a little gentle or diplomatic. We call him as visually impaired. Person not in a position to hear. You will not call him as deaf. It is here he is having hearing impairment is what we take it up. Likewise, the term impairment is an indicator that it is a defect, isn't it? So, if impairment is to be considered as a defect, is it a physical defect that they are talking about or something else they are talking about in this particular accounting standard? Any idea about that? Can any participant throw some light about what you understand from the term defect there? Come on.
Sir, impairment is something like when you are carrying amount is much lesser than the value in use or the realizable value. Wherein because of some indicators, you feel that there is a asset is being impaired.
Okay. Anybody else? Anybody else? See, now I will put it like this way. Say, when I went to buy a two-wheeler, the showroom manager was talking about a scooter for my son. So he said, sir, latest one, I'm talking about 2 years back. 4G is available, is what he said. And at that point of time, 3G was also available, Activa 3G. I was asking, what is the difference? Sir, this is old model, price is less. New model, price is more. So I could see for one of our cousins, few months back we bought that 3G. That time it was not printed as 3G. Price was huge. There is a gap of 12,000 rupees. 12,000 rupees they have reduced. So even though it is brand new item, but it is representing an earlier technology, the value of the asset will automatically be coming down. So please just understand when there is an evolution, when there is a development taking place. So where you are getting into an advanced model, where the existing model, even though it is in good working condition, which has got significant remaining useful life, the value of the asset will be dropping heavily for no fault on the part of the asset. So a sort of a financial defect the asset is assuming. That is what generally we call it out as impairment loss. An impairment loss is expected to be shifted to profit and loss account. That is, from besides charging depreciation, some impairment loss is there. Quite naturally, that impairment loss will be transferred to P&L account. So our gentleman who had said that carrying amount should be lesser than the value in use. Actually, it is the opposite. Carrying amount is expected to be significantly higher than its real value. That means your balance sheet is having higher amount of unrepresented assets whose worth is not really stated. It is stated at a much greater price than it could be if sold immediately or if used in the future point of time. the present value of future such cash flows, which you call it out as value in use, to be compared with the selling price of that particular asset if you dispose it of now. So imagine that an asset upon disposal immediately is likely to fetch, say, some 12 lakhs. And upon further usage, if that asset is likely to fetch 15 lakhs of rupees. So which one of the two the entity will be forced to take decision to dispose it off at 12 lakhs or use it for the future and derive benefit of 15 lakhs? Which one of the two alternatives for which the company would prefer to take its course of action? Come on, all of you. I have given you fairly a very simple example only. You don't have to consider that it is a tough scenario that a question is placed. If I dispose of an item, it will fetch me 12 lakhs. If I continue to use it for its remaining useful life, it is likely to fetch at present value terms 15 lakhs. Which one of the two is better?
12 lakhs.
Huh? To
12
use
lakhs.
15 lakhs.
Dispose.
If
To
you
dispose
dispose
of.
it off, it will give you only 12 lakhs. If I use it, I will be getting 15 lakhs. 15 lakhs would be better than 12 lakhs. This is what accounting standard is saying in technical jargon. What is that? They call the first one as fair value less cost to sell, 12 lakhs. The second one, we call it out as value in use, VIU. Higher of the two, I mean fair value less cost to sell and value in use, whichever is higher, that is what you have to take up for comparison. And whichever is higher is called by a different name that you call it out as recoverable amount. What is recoverable amount? Recoverable amount is higher of the two. One, if you sell, how much you get, which you call in the case of inventory as NRV. Here you call it by a different name, fair value less cost to sell. And in capital budgeting, what is it you do? The future cash flows, we discount it, arrive at the present value, that you call it out as a present value of future cash flows. Here you don't call like that, you call it by value in use. If I sell, I will get 12 lakhs. If I use, I will get 15 lakhs. Whichever is higher, 15 lakhs is what we will be taking up. Imagine that the carrying amount of the asset is 17.5 lakhs. 17.5 lakhs. Now, you can consider that the carrying amount is greater than the recoverable amount by 2.5 lakhs, which is not represented, even though at the very initial stages they have expected that it would derive a lot of benefits and all that. Because of change in technology, you were charging at a older rate at a lesser pace would mean you would not be in a position to charge depreciation for a shorter period of time, because the old technology will not be continuing at the originally estimated lifetime. So definitely we are expected to charge it on accelerated basis. But what you have failed to charge at accelerated basis resulted in extra amount loaded into your asset. That extra amount loaded into the asset is reflected in the form of carrying amount is greater than recoverable amount. That difference is what we take it out as impairment loss. Am I right? It is not physical defect alone. Sometimes physical defect, many a times it would be financial defect. Financial defect and sometimes physical defect also. What are the reasons? Majority of the cases would be change in technology only. Majority of the cases, it would be change in the technology. Sometimes what will happen is that it may not be on account of any change in technology, but on account of government policy also, impairment may be caused. What is that? Say now you find onions are sold at very high price. The government is putting out one prohibition, export of onions. That is, they are prohibiting onion exports and increasing onion imports. So company which has got the license to do exporting of onion, when prohibition is involved, so quite naturally impairment had taken place. The profit generation is getting affected. So that sort of scenario also is a possibility. There is no question of technology. That is the reason as why I have said variety of reasons may cause impairment. Example that I've just given is government policy resulted in this sort of scenario. Let me tell you how government policy will affect a common man. I'll tell you how. See, I don't know how many of you had the what should I say experience like this. So when I was in the school, I have seen this milk van throughout the city in Chennai. They travel in the morning and two, they will travel in the afternoon. Two times milk delivery was made when I was in the school. So after my domestic duties were getting relieved, after, I did not notice all this. 5 years back, I was asking my wife, who is going to deliver milk packets in the afternoon? She was asking, there is no such practice at all. I asked, what is this? When I used to buy in the afternoon once. So government had stopped the delivery second time. In the morning itself, you got to keep. So why we were doing it two times, now it has come as one time. I have found the reason for that. Reason is that in those times, not even plastic, they're all in bottles. No storage facility. Many houses did not carry a refrigerator. There are no retail outlets. Now every household is having a refrigerator and milk is available free 24/7. You have it available. Why should the lorry come two times? So government withdrew this second delivery because of variety of reasons. So one cannot tell one reason. There can be multiple reasons. So, but in majority of the cases, impairment will be caused on account of emergence of new technology, which will kill or replace the old technology. All the investments made in the earlier technology are bound to be suffering, and that suffering is what we take it up as impairment. The loss arising on account of that is what we will be accounting for. Shall I proceed?
Yes.
So definitely, in order to account for impairment, indicators should be there, which you classify as external and internal and all that. And on that basis, things can be identified. So it is like we consult a doctor. You just report, sir, in the early in the morning, I'm just getting the headache. On a consistent basis, up to 2 o'clock, 3 o'clock, the suffering is there, slowly receding, and end of the day, I feel very tired, sleep next day morning, once again, I'm getting. Okay. The doctor will not be just saying, come on, come to operation theater, I will find out what is there inside. He will not tell, no. So similarly, whenever carrying amount is greater than the recoverable amount, you don't take it up the difference as impairment loss. It's not like that. Whenever you find that is happening, carrying amount is greater than recoverable amount, we will simply ignore. When is that we take cognizance of the difference as an impairment loss? Only when you have indicators. So the doctor would tell, are you having good sleep? We'll ask that question. Second question you would be asking, are you having eye problem? Check up with an eye doctor. Third thing is that you will be just asking, are you a social drinker? That might also cause problem. You will inquire whether bowel movements were all proper. List of questions you will be asking. and ask him to go for a test. Based on the test results, he will find out as whether surgery is to be made or medication is to be recommended. Likewise, as how surgery is taken up as a last resort, impairment is also like that. Unless you have indicators and indicators showing positive, we will not take up impairment. Just because carrying amount is accidentally greater than recoverable amount, we will not take up that scenario as a fit case for taking up impairment. Next question is that whether all items of assets are covered under this particular accounting standard. Answer to that question is no. Certain item of assets in which this accounting standard will not have any scope for playing, because the respective accounting standard by itself would be having similar provisions and that will be taking care. So these many items of assets on which impairment test will not be performed at all. So how come in the case of inventories, you take it up as cost or NRV, whichever is lower? That concept of cost or NRV, whichever is lower, will automatically take care. When cost is greater than NRV, the difference will take it up as loss. We book the closing stock at NRV and automatically loss is booked. So this way, inbuilt facilities you have in the respective accounting standards, you don't have to just apply this impairment into these accounting standards. How to compute impairment loss? Impairment loss is equal to carrying amount minus recoverable amount, where carrying amount is greater than recoverable amount. What is recoverable amount? Higher of the two. This is what we were discussing at the initial stage, 12 lakhs, 15 lakhs example. Is impairment test to be performed as a customary routine at all reporting dates? Generally, no. Certain cases, yes. What are those cases where I got to put these assets for routine test, whether indication is there or not? I told in Ind AS 38, we will have a discussion later. That time has just come. Intangible assets which has got indefinite useful life. Please understand, intangible assets having indefinite useful life for which no amortization will be made. When the intangible asset is not that available for use, which is under process, under development, or which is coming under development phase. Then goodwill in business combination. The arrival of goodwill, you all know that taking up assets at fair value, taking up liabilities, taking up goodwill, the sum of the debit and credit, we will take it up. If the sum of the debits being greater than the sum of credits, the difference we take it up as capital reserve. If it were to be the reverse, where the purchase consideration and the liabilities taken over at fair value being greater than the asset value, the difference we take it up as goodwill. Shall I proceed to the next one?
Yes, sir.
What is a CGU? So this accounting standard will have lots of times they'll be using the term as CGU. CGU stands for cash generating unit. What do you mean by cash generating unit? Any idea about what is
Which are
cash
not
generating unit?
cash loss,
Yeah, please.
which are not having cash losses.
I'm not getting. Can you just come again?
Which are not having cash losses.
Cash profit.
Cash
The
losses.
The
It's
cash
not-
generating,
It is not about cash profit.
Sales.
the cash generating unit is something you shouldn't see an asset as an asset individually, but as a sort of a unit as a whole, the process.
Is it so? Can you give an example?
Wherein you have a manufacturing entity, wherein there is a combination of plant and machinery wherein you can't distinguish each asset separately. You will have to look at the whole unit as a whole and look at impairment.
Okay. Say now I will say by and large it's okay, but it's, fine tuning should be made. Now let me just try what is cash generating unit. First and foremost thing is that not all items of assets that is taken up for the test of impairment would have fair value less cost of there is fair value less cost to sell and value in use. So example is a mining industry might have a conveyor system or a railway system where the area could be many hectares across few kilometers they would have taken up as license. Laying a railway is going to cost heavily in so many crores of rupees you have got to incur. When it is taken up for the test of impairment for some reason or so, fair value less cost to sell, it will fetch only scrap value. But when you want to construct it, it will cost you in crores. You will not get even few lakhs of rupees when you effect the sale. But when you have to construct, you have got to spend heavily. So therefore, taking very strictly the difference between the carrying amount on the that is recoverable amount, huge amount you will be taking up to profit and loss account. It will be a sort of overdoing of impairment of assets. The intention of impairment, this accounting standard may not be to that extent, but we will be overdoing, we will be overacting. And such an item of asset may not generate cash flow at all. Value in use is not a possibility at all. Because it becomes very difficult to connect the asset and the cash inflow. Very difficult. If such be the case, what they say is that don't approach impairment on individual item of assets. So you group the assets in such a fashion that you have all the attributes of the CGU. What is that? It should have cash inflow. Number two, it should function largely independent from the functioning of other assets. In a family, you find a person is generating cash inflow who is fairly independent when compared to the existence of others. So definitely I would consider that person as a CGU. Correct? In a joint family, there are 7 brothers you have. So you just find, that's for example I'm just telling you. Similarly, practical example also we can give. Imagine that we have chain of stores on retail shopping. Retail chain store you have, like Reliance that you have. Whether individual store will be an asset or should we have to group all these in a particular region and call them as SCGU. So all these Reliance shop, you would have common advertisement given, and in certain cases of that particular Reliance, if you take up more MORE, a retail chain, you just find they operate in a particular way. What is that? Their HR policy will be same, their marketing policy will be same. In some cases, the front width and the branch almost in every place will be same. The uniform, where is cash counter, how much is the width of the road where they should have, it will all be uniform. So, and they have a common purchase policy also. All the branches should put their intent and there will be a common pool, and through that common pool only they will affect the purchases. Please understand, all these chain stores will not be owned by one company. You would have given it on franchisee basis. Now the question is that whether individual store will be considered as CGU. Answer to that question is yes, because you have a point. Cash inflow is present and it can operate largely independent. I'm not saying absolute or 100%, largely independent. Yes, if I have in T Nagar, that is in Chennai, there is a place called T Nagar. In T Nagar, I have one Reliance. And we have another place, Ashok Nagar. In Ashok Nagar, that retail unit is closed. Whether this T Nagar unit will get affected adversely? No. When T Nagar branch is closed for some reason, whether Ashok Nagar's function will get affected? No. So all these units are having cash inflow, they are functioning largely independent, and you take up that as a CGU, isn't it? When you are not in a position to identify these factors there, then you have to group that particular asset and a bigger group, which you call it as a CGU, to be identified. The example which I have just given was a railway system. When that railway system does not have all the attributes, then we will associate that railway to the factory to which it is belonging. Factory as a whole will be taken up as a CGU. Okay, so smallest group of assets that generates cash inflow functions largely independent from other assets on CGU. Is it okay? There can be a question on CGU also. So all this I have already explained. Already I have made a discussion. It is only coming up later. I hope that all of you have just read it. Cash inflow should be multiplied by PV factor, and present value of future cash flow is what we take it up as value in use. This PVF should be your overall cost of capital, and that should be taken upon before tax basis. The cash flow should also be taken upon a base before deducting towards interest and taxation. Is it okay? Just like your capital budgeting exercise that we do, that's the way we are expected to carry out. Shall we proceed to next? This is what we tell about the test for CGU. Test number 1, cash inflow is present. Yes. Absence of this asset not affecting the functions of other assets. If yes, in all the three, then asset is a CGU, or else not a CGU. So here they might just give a particular case. They will ask whether it is a CGU or not. If it is not a CGU, then you have to identify which one is a CGU. Your answer will not stop saying it is not a CGU. So you should tell which one is a CGU. Next one is a corporate assets. Before we could proceed to corporate assets, let me tell you that for the test of impairment, we are expected to take up the carrying amount, to which sometimes we may be adding share of goodwill. Not only share of goodwill should be taken up for the test of impairment, even the corporate assets are to be taken up. What is a corporate asset? The building where the head office is located or registered office is located. Number 2, the ERP cost. because ERP is not for one department, it is applicable to all. Then there can be research and development wing in which assets will be there. I'm not talking about research and development cost. There will be machineries you would be finding in research and development. How that research and development building depreciation will be taken into consideration. How that WDV of those items will be taken up for consideration. Those items are corporate assets. What is it we are expected to do? Corporate assets are to be distributed on a reasonable basis across all the assets. So your carrying amount will be its own carrying amount plus share of goodwill plus share of corporate assets. So when you have identifiable asset against which impairment loss, if identified, impairment loss should firstly be knocked off in full in the share of goodwill. Then remaining amount of impairment loss shall be distributed between the carrying amount and the share of corporate assets that is distributed between the assets. Say for example, the carrying amount of the asset is 400, then share of goodwill 25, then share of corporate assets is 100. All that put together comes to 525. When you have recoverable amount to the extent of 440, impairment loss will be 85. Impairment loss will be 85. Impairment loss will be divided into two, as one for goodwill in full 25. So out of 525, 25 removed and you have remaining 500. How much to be taken for individual asset and how much will be taken up for the corporate assets? Are you understanding? So in what ratio it should be taken? That 400 divided by 500 into 65. What is that 65? If 85 is impairment loss, when 25 is assigned towards goodwill, the remaining amount is going to be 60. Sorry. Am I right? 400 divided by 500 multiplied by 60. How come 60? 85 minus 25. For corporate assets, 100 divided by 500 multiplied by 60. This is the way through which we are expected to distribute the impairment loss amongst the constituents of the total carrying amount. Isn't it? Say yes or no. Have you understood this? Is the comparison to be done with carrying amount and recoverable amount always? No. Then carrying amount of the asset plus share of goodwill plus share of corporate assets minus inseparable liabilities towards the asset. What do you mean by inseparable liabilities attributable to the asset? Let us take up an example that I have taken a building on lease. On lease basis, I have taken the place. To the landlord, I am telling that for 10 years, I will continue to be there in this particular building, but I want alteration to be made. The building owner is telling, it is up to you that you have got to carry out the alteration or whatever in the building that you want to make. a warm shell given, you make partition and all that. But he imposes one condition. What is that? When you are vacating, please ensure that the status at which the building is given, that is a status at which I should get it back. I don't want this furniture of yours there, or whatever partition that you have made is not required for us. So definitely when they are bringing out partition, there exists a liability for removal of that partition. Therefore, one has to expect as how much cost the company would be incurring in dismantling, and whose present value also is expected to be booked, and which is part of your carrying amount of the asset. But thing is that we cannot escape any liability. When we are capitalizing that particular item as part of the cost without money spent, to that extent, we are expected to provide on the liability side provision for dismantling on the liability side so much of sum. When impairment test is to be taken up, you can't take up the carrying amount just like that. When that is influenced by an inseparable liability, we are expected to deduct that item also so as to compare it with the recoverable amount, and thereby finding out goodwill, thereby we will find out a positive impairment loss or zero impairment loss. Only when carrying amount is greater than recoverable amount, you have impairment taking place, or else impairment will not be there at all. Are you understanding? On what basis goodwill and corporate assets are to be distributed? Goodwill arising out of business combination shall be allocated based on expected benefits arising from the synergies of the combination. How corporate assets are allocated? That can be allocated on a reasonable and consistent basis. Whatever discussion that I made, that is what it is there. Have a patient look at this. Anyway, I will share this screen with you. We have a few more slides there. How impairment loss shall be accounted? Adjust to P&L account. Sometimes the loss might be a loss against the revaluation carried out, which would appear on the liability side there. When an asset is stated above the carrying amount, you would have created revaluation reserve. When the same asset is identified for impairment loss few years later, and where the asset is fully knocked off from your balance sheet, what meaning it would carry for revaluation reserve that is appearing on the liability side? You cannot have a revaluation reserve on an item of asset not there in the balance sheet at all. The last time at which they got to adjust the revaluation reserve is when that particular asset is sold. So that point of time, this impairment loss, if any you are just getting, should firstly be adjusted against revaluation reserve, and anything beyond that only should be taken to profit and loss account. Firstly, adjust against revaluation reserve, and balance, if any, take to profit and loss account. Firstly, against goodwill. Secondly, on a pro rata basis to corporate assets and individual assets, which I have explained to you with numericals. Is there any possibility that impairment loss can exceed the carrying amount of the asset? I want all of you to participate.
Is it possible?
Is
possible.
Is possible. How?
Realization amount to be very, very less. The realizable amount to be very, very less.
Realizable amount is?
Very less.
Even if it is very less, it is going to show a lesser recoverable amount. asset carrying amount minus lesser amount, your loss is going to be lesser than the carrying amount. Here the question what I asked is impairment loss exceeds the carrying amount? Come on.
Sir, usually it is not possible, but when you are adding the corporate assets and goodwill element and then arriving at the impairment loss, at that time the impairment loss may be in excess of the carrying amount. Otherwise, no.
Imagine that goodwill and the corporate assets are not there.
Okay, then it cannot be more than the carrying value.
Okay. This is what a general belief we carry, but we can't. That is generally it is not possible, but we can't rule out the possibility. It is something like 11th down batsman, whether he can hit century. Possibility is there, but generally not possible. But possibility when you ask, yes, it is there. Likewise, impairment loss can exceed carrying amount of the asset. How come? Please do understand that recoverable amount when it is turning out to be negative. I have 100 crores in the carrying amount. Recoverable amount I am expecting to be lesser than 100. Correct. But I am getting minus 10 as a recoverable amount. How minus 10? Fair value less cost to sell is one of the two components that you have in recoverable amount, where cost to sell is greater than fair value, thereby I end up with fair value less cost to sell in the negative. In value in use, how that would be possible to have negative? When I continue to use the asset, in most of the assets, I may not generate cash inflow, I will generate cash outflow. If you keep AC in your office, AC when I use, that is not generating cash inflow. For me, it consumes electricity, AMC I am paying. So likewise, a particular asset need not generate cash inflow, it can generate outflow. Therefore, it may turn out to be negative. For example, value in use 14 lakhs negative. Fair value less cost to sell negative 10 lakhs. Recoverable amount, whichever is higher. Which one is higher? Whether 10 lakhs is higher or 14 lakhs will be considered as higher. Both are in the negative. It is 10 lakhs will be considered because if I sell, I will be put to loss only for 10 lakhs. If I keep it, use it, my loss is going to be 14 lakhs. Which of the two losses would be better? It is something like during our childhood times, you would have done some mischievous thing. Parents have given you the option either take the beating of mom or dad. You can't escape. Between the two, which one you would choose? I have chosen like that. Mom's beating. She will not beat at all. She will just put one patting. That is beating. Likewise, between the two negatives, whichever gives you a lower negative value will be considered as higher of the recoverable amount. If 100 lakhs were to be the carrying amount with 10 lakhs recoverable amount in the negative, where the equation goes like this way, carrying amount minus recoverable amount, carrying amount of 100 minus negative 10, impairment loss will be 110 lakhs. So please be careful. These sort of questions could be asked, so please be careful. Okay. Yes. Is reversal a possibility? If factors caused impairment were reversed, then reversal of impairment loss is also a possibility. If factors caused impairment is no longer there, not likely to recur, then impairment loss, whatever you have accounted, can also be reversed. So the export prohibition resulted in impairment of one of the units of Tata company. When they have made a presentation to the government felt that many industries are suffering and a lot of workers were thrown out of employment. Then they have decided not to impose prohibition, not only on a temporary basis, but on a permanent basis. Therefore, what we have accounted as impairment loss on an earlier occasion is not to be continued in the books of accounts. We are expected to reverse. So therefore, reversal is a possibility. Now, the next question people ask this way: to what extent reversal can be taken up? Is there any cap or is there any ceiling that we have for reversal? Do you have any idea of reversal of impairment loss as a possibility? You got to say yes or no. You can't keep quiet.
Reversal is
Yes,
a
sir.
possibility.
Yes, sir.
Yes, it is a possibility.
Is a possibility. To what
Yeah.
extent impairment loss can be brought back?
Maximum up to the previous impairment loss, sir.
Yes. But unfortunately, it is not that way given in accounting standard. Because reason is that impairment would have taken place 3 years back. That point of time you have kept impairment loss to a figure say X. 3 years later, when you find this reversal there, you can't be telling that ceiling could be X because 3 years gone. No, you can't bring it back to 3 years back position. So what they say as maximum extent that you can go for reversal is, listen carefully, I will try to make it as simple as possible. Had there been no impairment loss in the very first place, impairment loss you have accounted 3 years back, imagine for this purpose, had there been no such impairment loss in the very first place, your carrying amount of the asset would have reached some figure, say for that matter, let it be Y. Already we have used the term X. Had there been no such impairment in the very first place, the carrying amount would have reached some position as of now, let it be Y. But after impairment, you were charging depreciation based on new policy, etc., and it had reached a carrying amount, say Z. In the name called reversal of impairment loss, in the name called reversal of impairment loss, the figure should not be exceeding the difference between Y and Z. In the name called reversal of impairment loss, it cannot exceed the difference between Y and Z. If at all the amount is to be carried for a number greater than the difference between Y and Z, that amount which is in excess of that difference between Y and Z will be taken up as revaluation gain. So when reversals are made, when asset value is taken up to a higher base, if the value is exceeding the Y portion when you are reversing, then that amount exceeding that Y will be taken up as revaluation gain, isn't it? 3 or 4 slides only you have. What is a two-step approach of goodwill allocated? One, you allocate. The other one, allocated to CGU, test that CGU for the presence or absence of impairment loss, first step. This I've already discussed. So this is a very important point. Goodwill can never be reversed at all. Other assets can be reversed on a pro rata basis. Say that I was just referring about the difference between Y and Z. That is what it is all about. Okay. So now it is close to 11 o'clock. Shall we have 5 minutes break before we could just reassemble?
Yes, sir.
Yes. We will have 5 minutes break and we will reassemble and we will take up on to 113. Okay. Yes. India is 113 fair value measurement. See, this accounting standard has got a little greater focus in the sense that of the two accounting standards that we have seen, if I see one question just for the sake of ratio, you would find two questions coming from 113. If I would have started with 113, for all the 3 hours, we would be doing only 113. So much is there. But at the same time, if you had these earlier two accounting standards, this would be easier for us to navigate. 45 minutes time, we will navigate onto the theory. Last 15 minutes, we will take it up onto MCQ. Sorry, this is straight away onto MCQ. Sorry, I've chosen a wrong file. One moment. See, this is what I normally use for our CA final class. So our coaching class name is there on the type. That's it. So fair value measurement, what is the area that it is covering? It is covering only asset and liability. And even own equity instrument is also taken up for fair value. Correct? Shall we move a little fast? Role of 113. So, this role of 113 accounting standard, that is fair value measurement accounting standard, by itself it is not having disclosure requirements. So I would consider this like a dictionary. Say whenever there is an item of doubt coming up in the court of law, where the enactment or the statute, when you look at, you don't find any insight they could get, then the judges will shift their focus from law book to dictionary. Then they just interpret in such a fashion that they would say and should be given the same meaning as that of are. But generally and are exactly on the opposite side. But judges have passed judgment where they would say and is equal to are. Likewise, as how judges would jump into dictionary, same way, all those practitioners of accounting standards, for whenever they want to understand what is fair value, they should refer only to Ind AS 113. So, Ind AS 113 will not cater to a particular asset or particular liability. It will not tell this is the item that you are going to disclose. This you should not disclose. It will not be like that. It will be like a lighthouse or it will be like a dictionary. Dictionary is not going to tell us how English sentence you have got to use. Correct? So it is like a lighthouse. It will be a general accounting standard where all other accounting standard will pick the relevant information, what they require, and therefore it is not mandating that this is the way a disclosure should be carried out. It is not addressing any particular asset or any particular liability. What is a fair value? Generally, fair value should be understood as an arm's length price, isn't it? This is what even in taxation also, in the case of transfer pricing, they say that fair value is nothing but arm's length price. As how it is taken up now, I would like to try like this way. One is asset liability and own equity instrument. One is related party, the other one is unrelated party. Price, not at arm's length price, at arm's length price. Now I got a two columns. Column number one, items dealt are assets, liabilities, and own equity. Parties to the deal are related party. Then the price at which the transaction would be carried out cannot be taken up as arm's length price. But which one will be considered at arm's length price? If the parties to the transactions are not related parties, then the price will be taken up as arm's length price. Comment is that if transaction is between related parties, generally people say it is not arm's length price, therefore it is not a fair price. And therefore you have arm's length price equal to fair value. This is a sort of conclusion you can bring about, just like a layman. So what is arm's length price? What is fair value? Fair value is nothing but arm's length price. Arm's length price is not actual price, it is only estimation of price. Estimation of price of an orderly transaction without having any other influence. Any external influence should not be there at all. To sell an asset or liability between knowledgeable market participants at a measurement date under current market condition, not yesterday or tomorrow, under current market condition, at exit price from the perspective of market participant that hold the asset or liability. That particular entity which has got that asset or liability, if it were to dispose that item of asset or liability, what price it would fetch, that price is what we will take it up as exit price, and that is what ultimately we will take it up as fair value, isn't it? All these points are very important. In some way they will take it up in MCQ and they will be asking. So please lend your careful listening to the class, and I will let you know where exactly you got to concentrate. This is very important slide. Now, I would tell this way, a little out of topic only I will be going out, just for the sake of collecting common sense and connecting it with accounting standards so that you can easily understand the concept and retain it not only for your examination and beyond that. See, somewhere in 1970s and 80s, I was in the school and college. My dad was working for postal department, and he had a good connection with police department. You would all wonder as how postal department employee will have a working relationship with police department. In those days, when policemen were to track a culprit, They had by then no channel of telephone available to all, no mobile phone. Their only route is only to put in cover, send it to their family members. Policemen will track all the mails going to that particular house. Where would they just do? The nodal point is only the post office. So in the post office, they will apply some technique, open up the cover, find out what exactly he will be telling. I am in Tirumala, I am in Parani, or I am in Amravati, or I am in Rajasthan. Some place he will be telling, and they will inform their counterpart, culprit will be caught. This roundabout way of doing things, they were trying. After the advent of technology, they identify the culprit, but they would have a rough sketch of that person and they will publish in the newspaper, television and all that. This is after the arrival of television, but not mobile phone. See, after the arrival of mobile phone and the latest technology, you have almost every other house is having now CC camera. Through CC camera, they are identifying. Now on the national highway, they are having this toll and they identify how the culprit is moving. They could track everything so specifically. And I read one news item where a person had looted a particular location, went in a train. By the time he came to his headquarters with his booty, police took a flight and caught him. Technology had improved. Crime rate had just not increased or decreased. It's all the same. Same way, if I were to find out a fair value of asset or liability, I should have an identical item in the market, and for identical item, I would say the fair value, the price at which it is dealt could be the base I can keep it. Isn't it? That is level 1. Level 2, it is not identical but similar. Always remember, English is a funny language. We have got to use that with utmost care. So when we had students, twins in a class, they were all identical twins. What do you mean by identical? Almost the same. Xerox copy. We had in our class similar twins. Similar twins. Please understand, identical and similar. When it is identical, if I want to have market share, there is Reliance shares. Reliance shares available in the market. I can do that, no. Then similar. So Reliance is engaged in variety of business, or I would like to take up a company which is doing only one particular operation. So ACC Cement, and there is another cement company that I have, but it is not publicly traded. So here I will not say identical, they are similar. We are expected to bring about adjustment to arrive at the value. So lack of control, lack of marketability, so and market premium, a lot of adjustments you have got to bring about, plus or minus you have got to bring about to arrive at the similarity. Or even for that matter, I would quote another example. When the ball is going out of shape within few hours or few overs, say after 4 hours, the ball went out of shape after the hitting like Virendra Sehwag. I like his hitting like anything. He will just either hit out or he will get out. He will not just block and do that sort of bad business. He's a clear hitter. 4 overs gone and ball is out of shape. Today what is happening is that they will call from the pavilion, please bring such ball which are 4 overs old. In that they will find out which is identical, and they give. I remember when we were in the school times, when such hittings were made, what the umpire would do is that he will have one sandpaper and bring out the shining to get out. He will remove the shining and it will take 10 minutes for him to rub that on the ground also. That is called as adjustment. Identical and adjustment. The last one is that is neither identical nor similar. In this particular case, please understand this is very, very, very important input for your examination. Maximize the use of relevant observable input. In other cases, we are expected to bring about assumption. All these are, I am telling, as a base for fair value. In this case, we are expected to minimize the use of unobservable input. So, of all these slides which I am asked you to just in a relaxed mode, because I will be sending you, is what I said, no. This, of course, I want you people to make a note. Take that 2 minutes, make note. I'll wait for 2 minutes. Come on, make note. One mark will definitely be there here. Shall we proceed to next?
Yes, sir.
Fair value shall be assigned for asset or liability. Shall not take the restriction of the entity on the use of asset and liability. It is the restrictions related to an entity on use of the asset should be ignored, and you have to give importance to the worth of the asset and assign value for that. Example, if I were to be a parent company holding some shares in subsidiary company, I am put with restriction by SEBI that I should not be selling the shares. In order to evaluate the shares, should I take into account the restriction on saleability in order to evaluate the shares? So what we are expected to do is that we should ignore that restriction and find out the worth of the share as fair value. It is subsidiary, there is a mistake. Is it okay?
Yes, sir.
These are the governing rules of fair value. These are the accounting standards in which fair value will not be used at all, because the respective accounting standard by itself is having their inbuilt fair value, and therefore this will have no operating space in these accounting standards. Shall we proceed to next? Shall we proceed?
Yes, sir.
Is fair value to be invoked only on a balance sheet? Answer to that question is no. At any measurement date, you can try. At any valuation date, it can be tried. This is what you consider as a definition of fair value. Fair value is the price to be received to sell an asset or paid to for transferring a liability in an orderly transaction between market participants at a measurement date. What is to be understood as market? You have principal market, most advantageous market. Principal market, if the item is available, price of this market is considered to be having a fair value. Most advantageous market. So, if I have vegetables available in one particular hub, just for the sake of example, in Chennai, we have a place called as Coimbatore. I will not go and buy in that hub, which is 4 kilometers away from my residence. Every morning, I will not do that. I will just go to the nearest shop and buy. Most advantageous market is that. Okay, one moment. One moment. Yes. Shall we proceed?
Yes, sir.
Most advantageous market. So, the nearest market will be most advantageous market for us. Okay. So, what is to be considered as market, for which I've just given you an example as principal market and most advantageous market. But what we normally take it up as the base would be where you have maximum volume taking place. That price is what you have got to pick it up. If that is not available, then most advantages we will be taking up. So, like level 1 and level 2. So, the table which I am going to show you is also very important. So, please be careful. Come on, kindly just make note of this. Even though I will provide you, just write in your hand. These are all stated in the accounting standard as what you are going to do. If you have just copied, please let me know.
Yes, sir.
Assets are classified into two as financial assets and non-financial assets. The course that we have joined is financial asset course only, no? So, what is the fair value to be assigned in the case of financial asset and non-financial asset, especially the one that we are going to take up for at this moment will be for non-financial asset. Here we have a base called as HABU, highest and best use. Highest and best use, HABU. Mark this as very, very important. There will definitely be a question on Habu. To which of the asset Habu will be used? Monetary, non-monetary, financial, non-financial. You have to tick non-financial. Habu is used for non-financial asset. Okay. Highest and best use. We will discuss that. What is highest and best use? It is a fair value measurement of any non-financial asset. It indicates the ability to generate economic benefits by using it or disposing it. Like how we have discussed in the case of value in use in impairment. So many of these accounting standards are interrelated. Correct? Shall we proceed? If you don't have any specific usage, the current usage, the way in which it is used, that will be taken up as Habu. Non-financial assets do not have frequently traded market, unlike financial assets. For land and building, you don't have such market. And every user will have different use for the same item of asset. And restriction in specific market shall be ignored. Always remember, when it is specifically, as I told you, that when shares cannot be traded, when it has got some restriction, we will simply ignore that restriction. We will go only by the asset. This is very important. In the absence of potential best use, which is not easily available, its current use will be the best use. It becomes very difficult to say what is the best use, no? I have seen in one of the memes which were trolled as how a very old Bajaj scooter is being used in a corner of the country where they use. A lady will be seated in the Bajaj Chetak. She will use its scooter for some 7-8 feet distance. By the point of time it is moving, water will be drawn from the well and it will be pouring to that particular center. And once again it will resume to the original position. And people, what they are expected to use it on the road, they are using it in their agricultural field. That is what you have. Best possible use may be different for each entity. It is very much subjective, but we don't have any other go. When you have alternatives like that, you have got to teach, that is, stick the appropriate base. Physical, legal, and financial use shall be considered in measuring fair value. Okay. Is fair value applicable only to assets? No, it is applicable to liabilities as well as own equity instruments. What are the occasions for valuing liabilities? Whenever there is a business combination where purchase considerations were to be discharged by issue of securities, that point of time we use this. Please mute it. Unless you have a doubt, please just mute it. Only precaution is that the liability or own equity instrument shall be outstanding on the measurement date. You can't do this valuation for a liability to emerge later, for an equity instrument which will be issued later. It should be there outstanding on that measurement date. This is very, very important. Classification base for liabilities and own equity instrument. If it is a quoted security, whenever the term quoted would mean there is a market there. So when it is market is there, you have to use level 1. When it is not quoted, then try using level 2. Try maximizing observable inputs. When that is not there, bring out assumption and try to eliminate unobservable inputs. What is an observable input? Market data that are publicly available about the events and the transactions. Say, for example, a person is asking, sir, how to find out beta for an unlisted company? Good question. No, you would be having your there is valuation. How to find out beta for an unlisted company? Yes, you have to use for quoted investment. Find out whatever changes between the two. Make those adjustments and bring out that. What do you mean by unobservable input? Where you don't have anything for as a base. This is what I was just referring about, where the police will not be knowing us how the offender will be looking like. Some rough sketch in which they would have published in the newspaper, you would have seen very long time back. Assumptions taken by market participation. This is very important. Either you use income approach or market approach. What do you mean by income approach or market approach? This is a very, very simple common sense item. So for example, I have built an asset for the purpose of making some utility value in my factory. It is inbuilt. It is inbuilt. What value I should assign for this? I am not talking about the cost involved in building the asset. We are talking about the value. I am not talking about the cost. When you say cost is nothing but amount spent for that. But there are a lot of things I will not be taking into consideration when we are bringing out the cost. Say my intelligence used for developing that is ignored because you don't see tangibly. Now, how to assign a value for that? Say a particular duct is to be made ready so that production is not stopped for some bottleneck works. So a newly joined engineer who had found that a design itself is to be made in such a fashion, he made that alteration. The MD was very happy with this suggestion. He is also a technical person, started operating it. That bottleneck what they were facing when they were reaching 75% capacity, now that they are not doing it. So now the question is that what is the value that I would assign for that particular thing, not the cost. Not the cost. What I should do is that if there were to be such an item of asset, what is the extra income that I just get for a period of say 5 years, 6 years, as the case may be, as it loss, their present value of that cash flow is going to be the value that I can take up. That is the income approach. Similarly, I can take a quotation in the market. If I want this design, what is the price at which I will be getting? That becomes automatically a market approach. So where I have no similarity at all, either I got to use income approach or market approach. Market order is very important. They would ask this question, what do you understand from unobservable input? They will give a lot of option. You got to use income or market approach. Other approaches they will say not applicable. You got to ignore them. Catch up with income or market approach. Is the fair value to be taken up on gross or net? Of course, net. Is it okay? Now, we have come close to last few slides. If we try through the slide, the number of MCQs will be coming down. So therefore, even though I will be sharing, now I will switch my attention from, okay, 4 more you have, we will finish that. 45 minutes I told. Only 4 more slides we have. So did I not tell you that exit price in majority of the cases will represent fair value? But in some cases, purchase price will be taken up as fair value. Where? Purchase price will be taken up as fair value in the case of exchange transaction. Price paid to acquire the asset or receive to assume the liability will be taken up. So mark this particular slide as very, very important. Very, very important. So they would say generally exit price in following places a different price can be taken up. purchase price, they would put selling price, something like that they would be telling, because other alternatives, when they are very close to the correct answer, then the quality of the question is very good. If it is not so, then it becomes an easy question. It is something like, who is the hero of Ramayana? Rama, Hanuman, Lakshmana and Sita. So question is, who is the hero? No. Okay. Hero means lady will not be there. So Ramayana, Rama, so connect, tuck. Even if a person is not knowing anything on Ramayana, he can try. So it is, that simple questions are very rare. So please be careful. Shall we proceed to next? Assumption in making fair value measurement. This is also very important. Here we will assume that parties are unrelated. Remember that comparative table which I have just brought. There should not be any distress or panic sale. Say during the period of pandemic, post-pandemic, there were a lot of real estate transactions taking place. Some of them were not representing the true price. You are all under the discussion amongst our chartered accountants group whether this stamp duty value by applying section 50C will be applicable, because 6-7 months a person is not having any income, he wanted to dispose the item of asset. So at whatever price that he is selling for that price. The buyer is having definitely an advantage. So one cannot be taking such a price for the purpose of finding out fair value. That is what it is all about. Measurement scales are same with respect to rights and privileges. So you have got to be very careful, because the price may be with rights, without rights. Price may be with bonus and without bonus. You have to be very careful with respect to arrival of the price. And you cannot be taking two different markets for fair value. Market shall be same. These are the assumptions that we make. So fair value is one thing, transaction price may be different. Which of the two should be taken up? Record only at fair value. What do you mean by that? See, many a times, for lack of having that knowledge or the example, we find things very difficult to get into our head. Now, for this, I will give you an example. This is in the case of Ind AS 41, where we have the cattle are to be recorded at fair value less cost to sell, is what they tell. I know that a cow which is just had only one yield, the fair value is 50,000, but I have bought in the market at 47,000 rupees. 10 such cattle I have bought would mean what is the value at which I am expected to take it up in my books of accounts. I am expected to book each cattle into my books of accounts at 50,000, even though I pay 47,000. The difference between the fair value at which it is recorded as an asset and the amount that I pay, I will not take it to capital reserve like in the case of business combination, which is to be taken to profit and loss account. There we say profit or loss on fair value change at the initial purchases. Please understand, Ind AS is promoting gain or loss to be booked at the time of purchase itself because of the fair value. Whereas in the earlier legacy accounting system, normally the profit or loss will be taken up only at the time when sale is made. So recognition of profit or loss is not restricted to sale alone. It is extended even at the time of purchases, only with respect to few accounting standards and not in the case of all accounting standards. So knowledge on other accounting standards will be of great help. Okay. So as I told you that for 45 minutes, we will run through this And now we will take up on to MCQ. Yes.
All of above.
I would like you people to participate, all of you. Say for the next 10-12 minutes, how many number of MCQs that we are running through. We will run through, but I want all of you to participate. Come on. So now unmute and please just try.
D.
D,
All
sir.
of the above.
No, not correct.
Then it has to be C. Market specific measurement.
Exactly. Who is that?
Shraddha.
Super. Good.
Thank you, sir.
Next. 2.
Dash is defined as the price that would be received.
Can one of you read?
Dash is defined as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. A. Fair value. B. Cost price. C. Purchase price. D. Market price.
Come on.
Market price.
Price.
Market price.
Fair value.
Fair
Fair
value.
value.
Received to sell a fair value.
Yes. One of you please take turns and read fast.
Dash are buyers and sellers in principle or most advantageous market for the asset or liability that are independent, knowledgeable, competent, and willing to enter into a transaction. Two parties, market participant, market maker, or market leader.
Market participant.
Market participant.
Market participant. Correct. Come on.
Which of the following is the characteristics of the fair value? Number 1, it is a price paid when the asset is sold to related party. Number 2, it is a price paid when the asset is sold in an orderly transaction. Number 3, price at which transfer of liability would take place between market participant. Number 4, price at which transfer of liability would take place between related party.
Second
2 and 3. 2 and 3.
C.
2 and
3.
3.
C.
That is C. Correct. Please read
Fair
out.
value should be determined based on the dash, that is the price to sell the asset or transfer the liability in dash. A, transaction price, related party transaction. B, entry price, orderly transaction. C, transaction price, orderly transaction. D, exit price, orderly transaction.
Come on.
Should be determined.
You had a discussion on this. Make it fast.
Exit price, orderly transaction.
D.
D. D.
D for Delhi. Correct.
Yeah.
You're right.
IND-AS 113, an orderly transaction is sale due to liquidity. As per IND-AS 113, an orderly transaction is A, sale due to liquidation. B, a sale in current market condition. C, distress sale. D, all of the above.
C.
All the above.
All of the above.
All of
Wrong.
the above.
Wrong.
A
See,
sale
always
in
B,
current market condition.
B.
B.
Sale in current market condition. Remember, I was just telling this slide is very important, is what I told you. This has just come from the last second or the third point. Come on. 7. Very easy. Please read out fast.
Objectives of Indian Accounting Standard in AS 113. A, defines fair value. B, set out a framework for measuring fair value. C. Requires disclosure about fair value measurements. D. All of the above.
All of the above.
Steve.
All of the above. These,
All of the above.
let me tell you. So though I just made a little easy for our classroom MCQs, but let me also tell you, in the main examination, you don't have all of the above, both A and B. That sort of question they are avoiding. So therefore, when you are practicing, at least we'll go through the other three alternatives. No, one of them will come. But I am just informing you that don't have in your mind something about all of the above. See, I've just seen one student was asking in one of the classes, A, B, C is A and B, and D is none of the above. So he says, such a question, when you are asked with, you can close your eyes and choose C. This is what his observations were by going through that textbook or whatever experience he had from various sources. And after his observation, when I just checked up with my inputs, he is correct to the extent of 95%. So, but let me also tell you the darker reality is that, bitter reality is that you don't have a question in the main examination as both A and B and none of the above. That sort of question will not be there at all. So just don't worry about that. But whatever you are reading for A and B might be one of the other options you have in the main examination. For that sake, you have got to read. Shall we proceed? Eighth. Come on.
IND-AS 113 applies to A, when another IND-AS requires to or permit fair value measurements or disclosures about fair value measurements. B, share-based payment transactions within the scope of IND-AS 102. C, leasing transactions within the scope of IND-AS 17. Or D, measurements that have some similarities to fair value but are not in fair value, such as net realizable value in IND-AS 2 or value in use in IND-AS 36.
I think A, sir.
A.
Yeah, correct. Because these things are not applicable to fair value. Yes.
The highest and best use of a dash might provide maximum value to market participants through its use in combination with other assets as a group, as installed or otherwise configured for use, or in combination with other assets and liabilities, for example, a business. A, non-financial asset. B, technology asset. 3, financial asset. D, intangible asset.
Non-financial assets.
This is what I was just referring about. Say, once you know a particular term and the related asset, then that sort of question only they will be asking. So maybe 2-3 questions based on that may be coming up. Next.
Under acquisition, accounting fair value of asset will be the market value, cost paid for asset, best price, or sale value.
Sale value. B.
Cost paid for the asset.
Yes.
Paid
B, B.
for
Under
the
acquisition
acquisition.
accounting, fair value of asset will be cost paid for asset. Correct. Are you understanding? Best price will not be coming. When you are acquiring, there is no question of sale value. So in that particular case, it is cost paid for the asset.
In acquisition accounting, fair value of quoted investment should be based on market value or the market price, B, cost paid, C, best price, or D, sale value.
So please just understand that what we are just using
Cost paid.
is
Quoted.
you have to
Market
be very
price.
careful. This is quoted investment. I've used
Market price.
Quoted investment should be based upon the market.
Exactly. So depending upon the question, only the answer will be changing. So you will be finding similar answers coming. That is what I'm telling you. Under examination condition, you will not be getting like that. Let me also tell you. So your first question may be a problem. I mean, some case study sort of thing. And second question may be fully theory, and next 10 will be theory. Then problem will be coming up. It will be a bundle. It is a mixture of all topics coming up. You have got to be very careful in handling it. Okay.
On consolidation, total of fair value of assets less than purchase consideration. A is goodwill, B value of business, C capital reserve, profit.
Consolidation.
Goodwill.
Less purchase consideration.
Goodwill.
Goodwill. Goodwill.
I skip this question. I skip because disclosure requirement does not apply to say all these item of assets will not be applicable in the case of 113. So therefore, all of the above.
The price in the principal or most advantageous market used to measure the fair value of the asset or liability shall not be adjusted for A. Transport cost, B. Installation cost, C. Transaction cost, or D. All of the above.
This I have asked you to make note. Remember that?
Yes.
Yeah.
Used to measure the
Yes,
fair
B.
value of assets.
Installation cost.
Installation cost.
No, not installation cost. We have not discussed installation cost at all.
The transaction cost.
Hey, look into which market, principal market or most advantageous market, where it will not be adjusted.
The fair value of the asset or liability shall not be adjusted for transaction cost.
So read the question carefully. There can be double negatives. There may be except that sort of thing they will be providing. So please be careful. Okay. We have 1 more minute to go. Let's just make it fast and find out how much we can push.
Dash in the active market provides the most reliable evidence of fair value and shall be used without adjustment to measure fair value whenever possible. Market price, quoted price, sale price, or cost.
Market price.
Market price.
Market price. Market price, sir.
Please have a look at this once again.
Dash shows
It's an active market.
Most
reliable fair value.
Quoted price.
Correct. What do you mean by active market? Active market is a place where you have large number of buyers, large number of sellers, and the price will not be influenced by buyer or seller. The price at which they transact is going to be the quoted price. Active market where presence of large number of buyers and sellers. So therefore, that is connected only with quoted price only. So this I will anyway, you people will be provided with the MCQs. Now it is sharp 12 in the sense that I would like to close it. For that matter, knowledge cannot be said that it is only this much. It is only the time within which whatever that is possible we have just done. And before I could just forget, all the very best for your examination, and take up at the earliest chance. Please just don't postpone, because don't have a feeling if one chance or one attempt we could not take up, or with sort of under preparedness when we have failed and all that. So I'm just telling you, for this insolvency professional course, that is, I've taken up the examination on 21st and I failed only. 51 marks I scored, 51 and a half. I'm not losing heart. Definitely I will qualify. November 3rd is the examination, is what I have. And immediate chance only we will take it up. And thereby our object is only to score that 60. What best combination that we take up is very, very important. So just don't postpone. At the earliest point of time, try banking. Even if you don't get a center, nearby center, you please go and take. So earliest appearance is the best. And the tempo and the heat that we develop in studying, that we should not lose. So all the very best. And the areas of my interest is not only accounting standards, but also on financial management areas. In fact, that is the area at which I have large number of students for CA final also. So you can definitely send mail or WhatsApp or call me. In case of any doubt, definitely I will be in a position to help you out. So my examination is on 3rd of November. I will definitely be in touch with you and I will communicate my success. And similarly, I would be very happy to congratulate you. Now itself, I just feel that you will all be clearing. Congratulations in advance. Do really well. I pray Almighty. So happy Vijayadashami and happy Diwali, happy New Year and whatnot. Thank you.
Thank you, sir.
Thank you,
Thank you.
sir.
And all
Thank
the
you,
best.
sir.
Wish you the
Thanks.
same.
Hemanta?
Very good morning, sir.
Yeah, good
Happy
morning.
Dasra.
Thank you.
Nice to see you, sir.
Yes. Me too. Very happy to see you.
My pleasure. My pleasure.
Bye. I'm just
Thank you. Bye. Very good afternoon, friends.
Good afternoon, sir.
Happy Vijayadashami to all.
Thank you.
Wish you the same,
Thank you,
sir.
sir.
Wish you the same.
I really appreciate and let me congratulate every one of you for your dedication, for sacrificing your festival and sitting the entire day. Sitting for a couple of hours and sitting for the entire day is an entire different ball game. Forcibly, intentionally, we are forcibly sit for the day. Anyhow, probably this can be one is the very turning point for you to keep it in mind that just now our good friend and guru and L. Muralidharan sir also preaching about importance of the examination, and all these sacrifices will be turned into result, and very soon you'll get it. When result comes, all these difficulties, all sacrifices of these holidays will go off in getting your provisional pass certificate. Anyhow,
Thank you, sir.
okay. So continuation of our yesterday's session. We started about understanding about what exactly the syllabus, entire syllabus of value examination, and we are talking about valuation of equity and business valuation. We started about what is the external internal environments and strategies, and we studied about what is the difference between expected rate of return and return on equity. So all these things we studied. Yesterday we had one problem for weighted average cost of capital, where we left the class study. We'll take one more because weighted average cost of capital is very important. We'll take one more sum practice for getting into. We'll take.
Yes,
Yeah.
sir.
Yeah. Company X issued debentures for 9% for rupees 35 lakhs, and company presently selling at their shares in the market 130 rupees, 130, and expected to pay dividend next year in 8 rupees, and growth rate for the company 12%. Find out weighted average cost of capital.
So please repeat the question once.
Definitely no, just like that. Can you somebody can help out to madam? Can somebody can help, because I'm for all fictitious numbers only. Somebody can help madam.
Okay. Company X issued debentures for 9% for 35 lakhs, and company presently selling shares at market at 130, and expected to pay dividend next year 8 rupees, and growth rate is 12%. So find out WACC.
Very good. Everyone okay? Yeah, go ahead. This is very, very important. There is a reason I'm taking before starting the session to practice one more time. And no one asked me about one information.
Yes, sir. Number of this one equity shares.
That's all. No one asked me about information.
Actually, I thought I was missing in the question, so I'm repeatedly studying it.
I'm intentionally was kept black. Someone will notice and ask me. Okay, debt equity ratio 3:6.
Okay.
Very easy.
Tax rate, we assume a 25%, sir, or no tax rate?
If nothing given in information, don't take it anything assumption. This is a Dubai company. Now you become foreign valuers, madam. Because you have to do the valuation internationally accepted valuation standards. So now we are on international level. Yeah, we'll go. So what's the answer? Debt 9%. Equity we don't know. We have to find out. Cost of equity is equal to DP1 divided upon cost of market price plus growth. DP1, how much? Whether DP1 is given or DP is given. DP1 is given or DP is given.
DP1.
DP1 1.
Straight away given. Life is simple. How much that?
8.
8.
8 divided by market price?
130.
120.
130.
120?
130.
130.
30. 130.
Perfect, no problem. Plus growth rate, that is nothing but how much? 12%. So what is the difficulty in this? Nothing. 18%. 18%. 0.15. ठीक है कोई प्रॉब्लम नहीं चिंता नहीं find out the weightages, multiply the value, find out the weightages, multiply the value, and sum of the thing will come is your weighted average cost of debt. Simple. Windows? Same answer?
Yes, sir.
No doubts? Very good. Okay, keeping that in background, now we understood what is exactly weighted average cost of capital. Then we'll proceed further on the topic. So yesterday we seen all these things, systematic, beta, all these things we learned. Now I'll come to another very important core area where, as you probably by this time you might be aware of the valuation of will be internationally, we had to do the valuation as per as internationally accepted valuation standards, comma, valuation standard adopted by your RVO. So international accepted valuation standards, IVS, invariably all the RVs are following in India today. So as far as that, there are three approaches, and three approaches is called cost approach, market approach, and income approach. Cost approach is nothing but your intrinsic value of assets, and to find out the intrinsic value, fair value of assets minus fair value of liability, total net worth divided by number of shares, you will get per share value. Very simple, everyone is doing till day. Market approach is one which I think you already seen. It's comparing your company with your nearby market and find out the value. Simple language. When my property is situated in Chennai, my property value, let us say 1 crore rupee. I never attempted to sell my property. 1,000 square feet, approximately nearby location. So 10,000 rupees per recently, 10,000 rupees per square feet was sold. So finding out of my value, approximately comparing with my nearby house and doing some discounting factors, arriving a value is the 1 crore. I estimatedly easily any layman can be able to arrive. The same way, company valuation also, nearby company finding out and doing the, yesterday we seen the adjustment like DLOC, DLOM, all adjustments will do, a discounting factor will do, and arriving the value is called market. Income approach, yesterday we seen there are two things. One, dividend based DDM, dividend distribution method, Gordon method, like in that no growth, you have a constant growth, two-stage growth, three-stage growth, we studied it. Now, apart from that, we have another method for free cash flows by using the cash flows of the company and free cash flows of the company. And even yesterday we were studying about CFO, cash flow from operating activity, and finding out the values and arriving a value from the estimating the future cash flows, what is going to be happen in the future period, and discounting into the present period, and arriving the value of a company of equity shares is the discounted cash flow in easy language. In free cash flows are two types. Free cash flows refers to a firm cash resources available for distribution to the owner of the company. Who is the owner of the company? Equity shareholders are the owner of the company. If you see is a net worth, yesterday we were discussing about two sets of companies. One, what is that? Leveraged company, unlevered company. In the case of unlevered company, only equity shares will be there. In the case of levered company, both equity and debt will be there. On total value, if you see as a resources left for after giving all these things, is available funds will called as a, that funds will call the net worth available fund as a, that cash flows which again distributing, removing the debt portion as a whole we call as an entity, and if you remove from the entity some portion of debt is called a FCFF and FCFP. Total revenue, you might the costing you might be known, you might seen total revenue less gross profit. Then if you, for example, even back to front, if you take sales minus direct cost, you will get earning before EBITDA, earning before interest, depreciation, tax. And if you reduce your depreciation, you will get earning before interest and taxes. If you reduce your interests, you will get earning before taxes. If you reduce taxes, then you will get earning after tax. That is the formula we used to follow for doing your all costing work related workings. And that means in simple language, the P&L account will be redrafted. The P&L account will be redrafted according to your convenience, according to your way of the questions which were given in the examination. In the examination also, the questions can be given anywhere the point, like if they can take it from sales to PAT or PAT to sales, or they may given EBITDA to sales, and whichever methodology you use, the ultimate result will be the same. After all, it is the number of 1 plus 2 minus 3, whatever formula we are using, plus or minus, we have to do it. So to understand better way, free cash flows is nothing but earning before interest and tax. If you reduce the tax, whenever EBITDA, from EBITDA you are taking it, interest before EBITDA you are taking, EBIT you are taking, sorry, EBIT and EBITDA you are taking, you have, that means before giving interest benefit, because interest eligible for the income tax deduction. That is the reason whenever you're taking a bit, when you restated the tax portion benefit, 1 minus tax, you have to give the benefit, and you have to, instead of taking 100, you have to take 70. I repeat, whenever EBIT is given, and you want to do the free cash flows calculation, I repeat, if you want to do the free cash flows, whenever EBIT is given, you have to take, to convert free cash flows, you have to start from EBIT into 1 minus tax, and from that non-cash flows, that is depreciation and amortization costs, will be added, and changes in the working capital plus or minus can be taken. Apart from that, capex plus or minus we have to be adjusted. Why capex will be adjusted? Whatever money earned by the company, entire money, if you're distributed to the shareholders or owners, then for the next year, what are the additional capital investment required for the company? Again, every time we can't call back from the investors. So that is the reason what are existing. That's what I told yesterday also. I used language called. We are a typical financial analyst. We are not accountant. To just show window dressing of balance sheet and make the profitability happy. To run the show of the company one side, on other side, we should also in a position to keep in mind that the business of to be existed in a smooth manner. That is the reason capex will be reduced out of that. So FCFF, FCFE, free cash flows to firm, that means including the portion of the debt portion, debt and equity as a total net worth of the business enterprises, we call the FCFF. If you reduce the debt portion and free cash flows to firm and free cash flows to equity, it will be is the cash flows available for the company supplies for the capital of operating expenditure, including taxes, have been paid necessary investments in working capital and fixed capital paid. Free cash flows to equity is the cash flows available to the company holders. Common equity after operating expenses have been paid investments in working capital and working capital has been made. So all these equations can be, so free cash flows to firm, no, not profit after tax, no profit, depreciation, amortization, capital. So this thing, I'll show you, I'll take you very, very interesting thing, like what are the experiment I made over a period of time. I'll just made you to make your life easy. If you understand this content concept, will be just like that. Kindly note down. Sales 100. Sales 100. And operational cost, example, you take it up. Example, sales 100. Operational cost 20. Then you'll get, what you'll get? Earning before interest and depreciation and tax. EBITDA 80. Correct? From depreciation, if you reduce, what you will get? Earning before interest and tax. And if you reduce your interest, then you will get profit before tax. Any doubts? Example, these all are the hypothetical numbers. And let us assume taxes are 30%. And if you reduce 15%, you will get profit after tax 35. This is how your question will be there. Examination question, or practically you will be provided P&L or projected profit and loss account. From the projected profit and loss account, you are arriving the cash flows, free cash flows for discounting for the particular thing. And working capital adjustments minus 10. Adjustments, working capital adjustments minus 10. And capex minus 10. Okay? Everyone? Yeah. Now I'm going to show you very interesting thing, which very total summary of your total exercise will be like this. We'll try to demonstrate whether this particular formulas are working correct or not. Kindly note down the formulas. Then we'll try to demonstrate. If you are arriving your P&L account, by using, we'll demonstrate whether these formulas are correct or not. So kindly note down this formula. If you are taking from PAT, what is your FEFF? What is the formula for FEFF? Instead of giving blindly the formula, we are trying to demonstrate whether the formulas are correct or not. So that conceptually you can understand. Great. From PAT, add NCC, non-cash charges, plus or minus working capital, plus or minus capex. Whenever interest is there, 1 minus tax, I told you. Then FCFF, that is from PAT. And from earning before interest and taxes. Can you note down? Can you note down? We'll start. Okay.
Yes, sir.
Note it down. So from PAT, if you do this formula, how much is the FCFF? If you go with EBITDA, EBIT, what will come? If you go with EBITDA, what will come? If you go with CFO, cash flow from operating activity, what will come? So let us demonstrate. Let us start. What is PAT?
35.
Profit after tax.
How much is PAT?
35.
PAT.
35, sir. 35.
35 is the PAT. Non-cash flows means depreciation or any amortization. How much is that?
20.
20.
20, correct. Working capital changes minus 10.
Minus.
Capex minus 10. Interest 1 minus tax. Interest how much?
10.
10.
10.
1 minus tax is nothing
Seven.
but 30%, 70%, 7 rupees.
7.
So 42 is the FCFF. Correct? So when you go for EBITDA, let us see how much is that. So I said before taking to 1 minus tax we have to take. What is EBITDA? EBIT.
80. Yeah.
EBITDA is 80. EBIT. EABT. EBIT. EA also. Earning before tax. How much is that?
EB80 before tax.
60.
60, sir. 60.
60 into 1 minus tax, that is 30.
30.
70, yeah. 42.
7, 40.
Then that's what I told you. Whenever you are taking for FCFF purpose, I repeat, whenever you are taking for FCFF, because by giving the income tax advantage, we have to do 1 minus. Whereas here, why you are not taking 1 minus tax here? Because this PAT is after interest. PAT is after interest. Whereas these two cases is not before, that is before interest. That is the reason 1 minus tax benefit has to be given. Add 1 minus 20 as usual, minus 10, minus 10. Correct? 42. Okay.
42. Yes.
Perfect. That formula is correct. Then EBITDA, how much is that?
80.
So 1 minus tax
Say 1 minus tax.
equal to 80 into 70 percentage. 56. So whereas this is we don't given the depreciation advantage, so straight away we will take the depreciation benefit out of that. So how much is the depreciation? 20. 20 into
70%.
30 percentage. 20, 30, 236. Correct?
Yes, sir.
Minus 10. Capex minus 10.
Minus 10.
Okay. This formula is perfect. Proven. Now cash flows from CFO. CFO how much? Cash flow from operating activity. Plus or minus and working capital adjustments. 35 PAT is there. And plus or minus working capital adjustments. How much is that? 35 plus.
What?
35 plus.
45.
35. How much is that? 35 plus 20 minus
Yes.
working capital minus 10. 45. Where is the confusion?
Okay, sir.
And capex minus 10. Interest already seen 7. 42. Proven. Any doubts? So, in other words, whatever the P&L account given, which you do the window dressing this side, that side, if you do the formula and apply your logics properly, you will get your FCFF very clearly. So FCFF is nothing but your profit account will be adjusted as a holistically by total company as an entity. FCFF, after arraying FCFF, if you reduce your debt and the liability on account of interest and the repayment of debt, if you reduce, you will call as a FCFE. That is eligible for the equity shareholders. Okay. So with the same index, we can go for one more formula.
So how the CFO has arrived? Can you please explain?
CFO. Okay. So what is CFO? PAT.
PAT plus
PAT how much?
depreciation minus capital. This working capital.
PAT how much?
35.
35. And it's not there. Okay. Here is there. 35 plus 20. How much?
Okay, got it, sir.
Perfect.
Okay.
Perfect. So clear?
Yes, sir.
Perfect. So now go to the question number 7. Huh? Somebody can take, some numbers are given, and we'll start walking into what is the FCFE. FCFE they want, correct? So we'll calculate it. FCFE will calculate it. Okay. They're given, somebody can read, sir? Somebody can help? Somebody can read?
Yes.
Arunji?
Sir, I'm finding the question, sir. One.
Take your questions yesterday sent.
Yes, sir.
I'm going to cover only equity related, but I sent a total material for you. Bonus, Dasara bonus. And I'll handle wherever equity related issues are there, I'll completely handle. FCFE.
FCFE.
Everybody can see? Everybody can open? Friends, everybody can open?
Yes, sir. Yes.
It is deleted?
No, sir. It's there, sir. Inside.
WhatsApp yesterday I sent the questions. In that question number 7, we are going to see. Yeah, go ahead.
Matrix Limited for the year 3, the year that has just ended, and for the next 5 years, years 4 through 8. Find out FCFE.
Yeah. So they're given 3 to 8 years. They want to understand from 4 to 8 years. Why they're given year 3 then? Why they're given year 3 information? They want to know about FCFE for the year 4 to 8. Then why they're given for the year
working capital adjustment.
That year will call as a
base year.
Base year. That is the base year, starting year, because if a new company, there will be no base year. For already existing company, before the year will be the base year to compare the working capital adjustment. Perfect, right, madam. So we'll let us start and work into that patch. Let me take 1 year, then the rest of the portion you can see 29. Then what is else? Preferential dividend, nothing. Fixed assets. So fixed assets from 190 it became 220. So what to do? How much is the difference?
We have to deduct.
So from 190 to 220. So plus or minus? Minus. 190 is the fixed asset. That became 220.
220.
क्या होता है कि we'll spend some money and
minus.
Inflow or outflow? Outflow. Very simple. How much?
30.
30. Perfect. Next. What else? Investments. Now investment, what happened?
Decreased, sir.
That means?
15.
That means?
Plus
inflow plus 50.
Inflow. Perfect. We sold. Then net current assets, net working capital. What happened? 72, 7 to 75. That means?
Let the current assets.
Working capital, when it go up,
Deduct minus.
minus 5. Perfect. Friends, if you could not able to follow, kindly tell me. I'll explain you one more time.
Sir, in the investment, I think
Sir, in the slides,
increase is
words
15.
are jumbled, so not able to understand the question properly actually. So I'm just
Keep that
Horizontal format. Keep that in horizontal format.
horizontal. If you're in office, take a printout. All options are available. Or save in the desktop, and you have to write your examination by seeing the screen and write the examination. So you have to develop the practice of seeing the screen and understanding the question and writing examination.
Sir, in the investments column, I think it is 15, sir.
Investment, how much? 15. Perfect.
15.
How much? 15, huh?
Yes, sir.
Perfect.
134.
Sure. Next. That also, if you from in this stage, if you do something, you will get FCFF. Now the requirement is FCFE. That means even debt also you have to reduce or add. So debt also what happened? Debt.
Add.
Add.
6.
6.
6.
Come up with the thing.
15, sir.
Perfect. 15. Can you do for the rest of things? Quick, what? Can you try? Friends, if you're not able to understand, if you want to tell me one more time, I'll tell you. Shweta Madam ji, okay?
It's 5 in the next year.
So,
Yes, ma'am. 5.
5. And then 15 in the next
15.
year. 16 and 16.
5.
15.
Yes, sir, 5.
1 5.
Third one,
16 16.
yes.
Okay,
It
let us see.
is.
Others? So fixed research, what happened? 220 became 240. Again, minus flow. How much? 20. And investments gone. Received money. And non-current asset 77 to 85. 8 plus 5. 8 plus 5, 13. Huh? 8 plus 5, 13.
13. Minus 13.
Minus. Debt.
minus, yes, minus 13.
10. 10.
10.
Add 10.
10.
This is 15, not 5.
Yeah.
And remaining things kindly do, please.
It is 5 only. 28. Minus 20. Minus 30.
The capex
This 10.
minus 20.
Yes, madam.
110 is extra added, sir, actually.
Huh?
Sir, investment you have added 10. So how 10 is added?
Sir, investment is 0.
There is no investment, sir, in the 5th year.
Investment has to be 0.
Investment became 0. That means what?
Yeah, it's 15.
We sold the investment.
Right.
We sold the investment, nothing in my pocket.
Right.
Yeah, yes, sir, correct.
Corona time, no money.
6. In the 32 column, then minus 20.
Next year,
42 to 66, 26.
Plus 11. So it's 6 is coming in the 6th year.
6 year 6.
Yeah.
Another answer 6. Any other answer?
I think it is
So 15.
15, sir.
15 correct?
15.
15 correct, huh?
I'm getting 15, sir. 15.
Sir, I am also getting 15.
Very good. Then 15. If everyone getting 15, I'm 15. Next. Try करो ना, please.
तो compare करें.
6th year का एक बार प्लीज करके दिखाएं.
कितना?
6th year.
15. How we got 15? That's what you are. Correct, huh? 6th year क्या हुआ? 32.
Yeah.
Next, yeah, fixed assets
Minus 26.
minus
6, yes.
26. Huh? Okay. Then investment
0.
net worth
Minus 2.
-2.
-2. Okay. How?
11. 11.
-11.
Plus
No,
love.
sir,
Plus, sir. Plus.
Plus.
plus 11.
Right.
Oh, yeah. Correct. Very good. Next, 7th year.
Minus 28.
28.
Sorry, to finish off -28. Then
-10 for working capital.
-10
Plus 16.
plus 16. Correct. Very good. Good students. Next.
-30
Minus 30. Minus 9.
and plus 15.
Plus
50.
-9 and plus 15.
Minus 10 and
-9.
Good, good, very good. Good bullying. Very good. Hope you understood very well. Now we'll go for next question. Very, very, very important question. Now we'll go for the examination mode. How examination question will be framed. We'll try to test and we'll try to work out. Okay? We'll go?
Yes, sir.
Yeah. Case study number 1. So anybody can take? Anyone will start?
Mr. Dev, a research analyst, has been hired to value RC Limited, a company that is currently experiencing rapid growth and expansion. Dev is an expert in the communications industry and he has had extensive experience in valuing similar firms. He is convinced that the value for the equity of RC Limited can be reliably obtained through the use of a 3-stage free cash flow to equity FCFE model with declining growth in the second stage. Based on up-to-date financial statements, he has determined that the current FCFE per share is ₹1. He has prepared a forecast of expected growth rates in the FCFE as follows. Stage 1, 8% for years 1 through 3. Stage 2, 7% in year 4, 6.5% in year 5, 6% in year 6. Stage 3, 4% in year 7 and thereafter and in 7 and thereafter. Moreover, Dev has determined that the company has a beta of 1.6. The current risk-free rate is 3 and the equity risk premium is 5. Other financial information, outstanding shares is 100 lakh shares. Tax rate is 40%, interest expenses 30 lakhs.
Very good. Yesterday we seen the same concept, 2-stage growth model. Instead of 2 stage, this is a 3 stage. That's all, nothing great. So 1 rupee, from there you can start. Instead of dividend, it will be free cash flows. There's also the FCFE. Straight away they go to 1, so you can start. 1, 2, 3, 4, 5, 6, and up to 12, 6 years, and 4% thereafter, and 7, 1. Fatapat. I think you can try. The same way they will give the examination. 4 questions will be given or 3 questions will be given with a multiple answers. A, B, C, D. Right? Friends, able to get for the question number 1? Simple.
Seventh year value is 1.57. K is 4.92.
No, KE comes at
11.
11%. 11% KE.
K is 11.
What is the formula?
KE RF plus beta into RM minus RF into 1 minus T.
3 plus 1.6 into 5.
That is the reason I'm asking what's the formula for KE?
Beta into risk premium plus risk-free rate.
Risk?
Risk-free rate plus beta into risk premium.
Market risk minus risk premium.
That is the reason you people end up with the mistake. That is the reason I repeatedly asking. Friends, very careful you go over the language. I told you there are two formulas. One is beta into return from risk return from market
RM.
RM minus
RF.
RF, or else risk premium is equal to return from market minus RF. Now the question is given risk premium or return from market.
Yeah.
Huh? Whether the question is given risk premium or
Risk premium.
Risk premium.
So there is no point of again minus something else. So risk premium into beta straight away you can enter. So risk free is equal to how much is the risk free?
5%.
3%.
3%.
3%.
No, sir, 5%, sir.
Risk premium is 5.
Currently risk free rate is 3%, and equity risk premium is 5%. Beta how much?
1.6.
1.6 into 5%. So this is the answer. How much is that? 5 into
11.
11.
approximately 11%. So 11.06. Answer D is correct. D is correct. So first question answer. Friends, I repeat. Be careful with the language. If risk premium is given, straight away you can take risk premium. If return from market they given, you have to show return from market. Don't confuse with return from market and risk premium. Don't confuse. No confusion. Okay? Okay. First question we got it. Now for a period of growth rate you have given it. Take it. It's very simple. One is given, and first 3 years 8% growth. Yesterday also you see. I think this you can do it. Then from 4th year onwards, it will be 7%. 4th year 7%. Then 5th year, 6th year,
6.5.
5 and 6.
5th year 6.5. 5th year 6.5.
6%.
5th year 6.5. Okay, no problem. 6.5 is equal to 22.
6%.
Percentage. And 7th year onwards,
7%.
7. Any confusions in this?
It's 4%.
4%. Sorry.
4%. Okay. Up to this, any confusions?
No.
Any confusions? No confusions. So what the question, next question is, what is the terminal value of year 6? That is MP6 is equal to, they're asking, MP6 is equal to DP7 divided by upon, what is the interest rate? 6%. 4%. What is the growth rate? What is the growth rate? 4%. And you know the interest cost of capital is 11% minus growth rate 4%. 4 then? Yeah, 4. Sorry, 4. 4%, not 5%. 4%. So 22.60 nearest A. Any doubts? I think yesterday I worked this.
Yes.
Find out. So now question number 3. Same way last year, yesterday also we worked, na? Same way kindly look into Take it, take it. $1.58. How much came?
Seventh, sir. Yeah, 1.58.
Okay. Then we just add this and copy paste for a period of time. Then add this, we'll get this. Then discounting factors is equal to 1 divided by 1.11%. Yeah.
Yes, sir.
1 divided by 1 divided by 1.11. Okay. This is the present value of this. See, any doubt? Okay, next. 3 cash flows to firm. FE, you know, we have to add the debt. We have to add the debt. Number of shares per share, number of shares, 100 shares, 100 into 100 lakhs equity. 100 lakhs equity. Plus interest, how much? Interest they given 30 lakhs.
30 lakhs.
So interest 30 lakhs, 40% of the 30 lakhs, because 1 man is tax. Wherever interest is taken, 1 man is tax. How much is that? How much is that?
18 lakhs.
30 into 40%, 60%. 30 into 60%. 18. 18 lakhs. So 1188. Answer C. I repeat. We already arrived at FCFE. FCFE. FCFE 100 lakhs per share value 1 rupee. 100 into 100. 100 plus debt you have to add. Once you add that, you will get the FCFE. Clear, friends? Any doubts, please let me know. I'll go one more time. You want to go one more time? We'll take
Yes,
one.
sir. Yes, sir.
Yeah. So this is very important. Examination, definitely you will get more or less the same model. You have to practice any number of items like this, and you will get this type of question in the examination point of view, in the practical life point of view also. Step 1, find out the cost of equity by using CAPM model. By using CAPM model, again I tell you, risk-free return plus beta into risk premium, or else risk premium is equal to return from market minus risk-free return. So question is given risk premium. So straight away we need not find out any reduction additions on that. Risk-free return plus beta into risk premium. If you multiply, you get 11% around that. So 11% answer D is the correct one. Once you find out the risk premium 11%, then what will happen? Just keep it here, and you find out your cash flows over FCFE cash flows over a period of time until the cash flows became constant. So the second question asked for the terminal value in the year 6. that is MP6. MP6 they are asking is, by using the formula of MP6 is equal to DP1 divided by cost of equity minus growth. That is nothing but MP6. MP6 is find out by using DP7. DP7 means cash flow 7 divided by cost of equity 11 minus 4. That is the growth rate, constant growth rate, and we arrive the values. Then add both values, free cash flows. Then you find out the present value factors and multiply the present value factors with the free cash flows of equity. You identify the sum of the total value. You will get the per share value of today's FE, total value, present value of the share CUL. Their present value of the share, you can identify by using this model. Then they want to understand FEFF model. They want to understand what is the present value of, sorry, FCFF I want. So 100 is the number of shares, per share value 1 rupee. So total is 100 lakhs plus 30 lakhs or 40 lakhs. How much? 30 lakhs is the expenses. 1 minus tax if you give, that is the net benefit we are going to be shell out to the creditors or debt people. That is 18 lakhs. So put together 18. That is total 118. Okay.
ठीक है sir.
Okay. Then we'll go for one more case study. Case study 5 will take. 5 will take. One by one will take. 5 will take. Is that? Who can take it? Yes, madam. Anybody?
Arzmeer Textiles Private Limited is one of the leading dyeing and printing units in the locality. The directors of the company are planning reverse integration by starting a weaving unit attached to the current facility. They have checked the feasibility of profitability of the venture and are keen to start work on the same as soon as possible. The directors have originally planned to raise the required fund internally by investing private savings and getting unsecured loans. But before any moves can be finalized or implemented, uh, state government announced interest subsidy on the weaving unit. For the purpose of obtaining subsidy, the loan had to be from nationalized banks only. The directors approached a nationalized bank for the loan. Amongst the requirements of the documents to be submitted, the bank has listed a valuation report of the existing business of the entities seeking loans. You are approached by Arzmeer Textiles Private Limited's directors to carry out the valuation assignment and issue them with a report on the same.
Okay.
So question 1, which is the most appropriate approach of valuation for this assignment? Cost approach, market approach, income approach, all of the above.
Answer as such, you are in examination condition. You are in examination condition. Answer, try. Try. Examination conditions, start. All 3 questions, kindly try. Then we'll try to answer it. Okay. Okay, friends. Yeah, what is the first answer?
I think it's income approach.
See, income
CC is
approach.
better.
See, in the case of valuation, there is no specific standardized mechanism for which approach for which method. First, understand. Invariably, unless otherwise circumstances demands, this is the existing company, and all three approaches are suitable only, subject to condition. So, which is the most appropriate approach means there is no single most appropriate approach. Generally, it will be all. D is the correct answer. We have to see all three approaches and identify which approach will be fit. But for consideration, all three approaches we have to generally react. Answer D. Second question. Suppose the valuation is carried out by the comparable transaction methods, that is market approach.
B.
Which is following steps will be included in the valuation process.
Sorry.
Pardon?
Sir, in this question, it is clear to say the first question. Why the income approach means bank is seeking valuation report for existing business of the entities.
Correct.
For the existing business of the entities.
Correct.
Seeking loans. So existing business entity which want to take a loan from the bank. So bank is required the income only, based on that income only they are able to give the loan.
This is the most appropriate valuation approach. So
for this assignment.
Yes, sir. That's what I'm trying to say, sir. For this assignment, we can't blindly take it as an income approach as a basis, because future you'll get income, then only you'll get. I'll do the income.
When bank is asking valuation report of the existing business.
That's what I'm trying to say. I'm repeatedly saying that if you're doing for existing business, there is no hard and fast rule that the only income approach we have to follow. If subject to, if you have even three approaches, you can have it. Even you can take average of three approaches, is absolutely necessary for the valuer to judgment which approach you have to follow. We have to consider all three approaches which is viable for the business, and we can weightages we can give it, and that is permissible by the IVS also. So the question is here, what is the most appropriate approach? We can't, most appropriate means only one approach, we can't come to conclusion. We can do even market approach, even you can do in cost approach also. So all three approaches can be considered, maybe fit, because situation will be different. That is the reason most appropriate, accurate means we can't find out. So all three approaches is the correct answer. That is the IBB answer. Second question. So suppose the valuation is carried out by the comparable transaction, that is the market approach. Which is the following steps will be included in the valuation report? All 1, 2, 3, 4, 1, 3, 4, 1, 2, 4. And like these questions, what will happen? You have to understand the sequence. One, identify the units of the comparison that will be used by the participants. Definitely, yes, required. Apply the adjusted values metrics to the subject, because you are doing a market approach. Definitely, adjustments is required. Choose the most appropriate type of cash flows for the nature of the subject asset and assignment. In market approach, cash flows are not required, so that is rolled out. Make necessary adjustments if the valuation matrix reflects difference between the subject. Yes, possible, required. So third point is not required in the market comparable method. So 1, 2, 4 methods is sufficient. That is answer C. Answer C is the correct one. What can be the differences that may be result? Adjustment between the comparable transaction and subject asset. So now we are talking about the first income method we see. Now we are seeing the market method related query. Material characteristics, yes, of course required. Historical expected growth, definitely required. Geographical location sometimes will differ from one location to one location. South Chennai value will be differ from Delhi value. So definitely required. So all three are required. Since all three are required, D is the appropriate answer. Good. This type of questions can become in the case of market-related approach methods, and we'll go for one more very, very important case study. Case study number, what is the number? 3, 3. You can try 3. AZ Limited, that one? Sir, AZ is that one only?
Yes, sir. Yes, sir. AZ.
Yeah, yes, correct.
Yeah, go ahead, sir. Very simple. AE minus Z, total value minus growth rate. If you reduce, you'll get it. Only thing is, if you put in the AZ column, BC column, they are jumbling the numbers like your professional exam. I think everyone will give the correct answer. So capitalization ratio is nothing but your expected rate of return minus growth rate. Simple, eh? There's no calculation. These are not one mark questions.
4.
4, simple. So answer is C, perfect. Next, there are 2 income-based approaches that are primarily used when valuing business: capitalization cash flow method and dash. This is also easy. Simple. Discounted cash flow method.
Discounted cash flow.
Nothing in that. And I'm more taking you one more very important. Whenever I say very important, you think it's very important. That's all. This is also very important. Case study number 4. Somebody can take. So there will be 3 companies are given. Let's go through anyone can read, madam.
The following details of calculated value, peer companies, EBITDA and EV sales. For A, EBITDA is 14, EV per sales is 2.5. For B, EV per EBITDA is 16 and EV per sales is 3.5. For C, it's 18 and 5.5 respectively. Details of company X. So sales is given as 10 crores. EAT is given as 50 lakhs. Interest cost is 40 lakhs. Depreciation is 20 lakhs. Other fixed cost is 5 lakhs. Debt is 8 crores. Rate of interest is 6%. Beta is 1.4. RF is 7%. Risk premium is 6%. And debt equity ratio is 1 and tax rate is 20%.
Okay.
The value of X company based on mean EV per EBITDA is.
Okay, that's one of the questions. So I'll tell you the concept so that you can take it. So we studied 3 approaches. One is income approach. We've seen with growth, without growth, 2 stages, 3 stages, FCFA, FEFE, all these things combinations we've seen. And we'll take just few minutes back. We've seen that market approach conceptualize questions also. And these are numerical questions based on the market approach. There are 3 companies in the market, comparable companies in the market. And for these 3 companies, A, B, C, they're given 2 sets of 2 market multiples. We call it as a market multiples. market multiple number one, that is like GP ratio, NP ratio, that's called market multiple, simple language. For easy understanding, market multiple means no technical language. It's NP ratio, GP ratio, that ratio, this ratio, you know different ratios. Like that, one ratio is EV means enterprise's value divided by EBITDA is one market multiple. Another market multiple is EV by sales. That is EV by sales is the one market multiple. There are given three companies. A company market multiple for EV by EBITDA, this is called rule of thumb in the market. 14, 16, 18. So what is the average? 14, 16, 18. What is the average?
16.
16. We can take maybe fraction. Some fraction may come, but 16 average you can take.
16.
So rule of thumb is the 16 is the rule of thumb for EV by EBITDA. Whereas EV by sales, rule of thumb is with 3.5 approximately. Okay. Now they given one set of information of P&L account. After that, they given you some details of CAPM model cost of equity. Now they require to calculate value of X company. So you are comparing company, your valuation company is X. This X company is the valuation company. I am the valuation company. You are all people are the market. I am taking you as a index for my company to compare. All your numbers average I am taking and I am comparing with my numbers. Okay. So first one question is value of X company based on EV by EBITDA formula, multiples. EV by EBITDA, we already know the formula rule of thumb is 16. Correct? Now they want to know the average company mean of EV by EBITDA is equal to 16 is equal to 16 is equal to EV by EBITDA. So what is EV? EV by EBITDA is equal to 16. EV by EBITDA is equal to 16. What is EV? EBITDA into 16.
EBITDA into 16.
So you know EBITDA. EBITDA you can find out from P&L account. EBITDA you can find out from P&L account. Simple. Find out EBITDA from P&L account. Multiply with 16. Hence 2 marks. 2 marks. Find out EBITDA. Multiply 16. Find out. I will not tell you. Simple. If you're getting this type of questions, 8 marks in your pocket straight away.
17.6, sir.
Find out. Let others also can. I request. Find out others also. We'll start. Don't rush up and don't find. Don't do mistake. That's what I'm trying to say. Easy questions. If you do mistake, then difficult. Easy questions. We should not do mistakes. Mistake only. 17.6 is wrong. Aram se. One technical point is that, and your presence of mind should be work. If your presence of mind is work, and entire 8 marks is yours. If you miss your presence of mind, then 0. Yeah.
Tax.
This is a question, I believe. Tell me, sir. No, I want one person, at least one person to done correctly. Then only I'll give the answer.
$1960.
What is the answer? A, B, C, D?
19.6.
Very good, madam. Well done, madam. Well done.
Thank you. The tax rate had to be earning after tax had to be worked back to find out what is the tax amount, and then you add your.
Whenever giving from EAT, earning after tax, that is, this is the formula. When you converting earning after tax, before tax, what we had to do? We had to add back the tax portion. Once you add back the tax portion, you will get earning before tax. Then you add financial cost and depreciation cost. You will get EBITDA. There is a simple multiply 16 with this matrix. Everyone? Same model. Sales by EB by sales. We already know 3.5 is the rule of thumb. Sales, we know what is there in this child's play. Only thing is logic, if you know, it's a child's play.
Okay, sir.
Next question, next answer.
Cost of equity.
What is the answer? No, how much is that for second question?
Second.
Second question, what is the answer? Value of X company based on the multiple of EV by sales. Using by EV by sales. What is the answer?
Okay. 1 second, sir.
Sales 10. 10 is the sales. Okay. 10 into 35.
10 into 30. 350.
35 crores. 35 crores.
Yes, sir.
Simple. 10 crores into 3.5, 35 crores. So answer C. Every one of you?
Yes,
everyone,
sir.
Friends?
Yes, sir.
Answer C. Cost of equity. Very simple. Again.
15.4.
By using CAPM model. At least you should not do mistake in this, friends. For doing these numbers. After doing this many numbers.
Is it D, sir?
Why doubt?
Because 15.4 is there here. That number is not given.
Absolutely right.
Correct.
Cost of equity is T. Because CAPM model, risk plus beta into return for market minus risk free. Simple. 2 marks is yours. Last one, definitely I'll not do here. WAC you have to do. I told you, that is the reason I told you repeatedly, without WAC, there will be no question paper. Somewhere others, they will include WAC. Kindly note down, those people could not able to follow. Hope everyone is following. So what is the answer? WAC.
8.1, sir. 8.1.
You missed out taxes, friend. Income taxes. Don't forget, wherever taxes, income tax, you have to consider. Debt to equity ratio, they already given 1:1. And your debt.
10.1.
10.1 is correct.
Yeah.
So if we have to give the discounting for, B16. What is it? Interest rate 6% is the given. 6% if you discounted with your income tax benefit, and 1:1 ratio, debt equity ratio, you will get 10 is 10.1. That is answer B. So, able to understand? Any doubts? Friends, this is very important. Lot of students are witness. Even recent times also the same question is asking. And proud to say that your immediate speaker, last month he attended one of my classes as like you, and he cleared your first attempt. Muralidharan sir cleared in his first attempt. So sir also got the more or less same type of same model in examination when he is sharing his experience with me. So very important model for the examination point of view. Clear? Any doubts? But yeah. What to do? We'll take 1:30 to 2 o'clock lunch, and 2 to 2:45 we'll take. That should be okay. Or you want to continue? We'll take break.
Yes, sir.
Better? I think from morning you are there. So we'll take a break now. So we'll rejoin at exactly 2 o'clock. So I'll try to 45 minutes. Some more one or two case studies as well as some MCQs, very important MCQs for examination point of view. How to do that MCQs, how to handle that we'll discuss. And with that, before 5-10 minutes, I'll leave it to you for Raju sir class. Any questions? Thank you. So we'll catch you at 2 o'clock exactly sharp.
Okay.
Welcome, friends. We'll start. We have another 45 minutes. We'll try to work out a couple of case studies as far as the equity is concerned. And after that, we'll go for MCQs for whatever time, 45 minutes left out. So last 10 to 15 minutes, I'll leave you for before taking the next session. So we'll take the case study number 2, very important. So there is a table is given, calculate Optex Limited using the following assumptions. Beyond 5 years, the free cash flows of firms will grow at constant growth rate of 10%, unlevered cost of equity 14%. After 5 years, we'll maintain the debt equity ratio 4:7, and borrowing rate of debt ratio is 12%. Borrowing cost, income tax rate 30%, risk free rate 8%, risk premium 6%, present value of unlevered equity free cash flows, which is the same for cash flows for the firm also during the planning period, is as beta of the levered company equity. So they given the numbers. We remember yesterday we have a formula for converting the beta into levered to unlevered, unlevered to levered. That concept will be worked out now. First, let us find out beta of unlevered. Okay, right, start. Let's start. Right, if you're not getting, I'll say. Try the answers.
So this is the case study number
2. Case study number 2. Okay. So some not required information is given. Forget. So we know that by using CAPM model, cost of equity is equal to risk-free return plus beta into risk premium. So cost of equity is 14 is equal to beta is absent because we don't know the beta. Cost of equity for the unlevered company. Cost of equity for unlevered company 14 is equal to risk-free return, that is 8 plus beta into risk premium. 14 is equal to 8 plus beta into percentage. So beta is equal to
1.
Beta is equal to 1. Beta for the unlevered company is equal to 1. Beta of the, now what do you want? Beta of the levered company they are asking.
14.
So you know the beta of unlevered company, you know. So beta of the levered company you want. What is the formula? Beta of levered company is equal to beta of unlevered company into 1 plus debt equity ratio 1 minus tax. Yesterday we studied formula. Beta of levered is equal to beta of unlevered is nothing but 1 into 1 plus debt-equity ratio, that is 4:7. 1 minus tax. So we can find out beta of levered.
Yes, sir. 1 minute, sir.
Beta of levered is equal to
1.4. Sir, 1.4, sir.
very good. Answer is 1.4. So first question is over. Beta of levered company is equal to 1.4. See the screen answer. So cost of levered equity is equal to levered beta. Now levered beta. Risk free. You know the risk premium. How much is that?
14%.
Hmm?
14 cost.
What is that?
Cost of equity is 14, sir.
16.4.
Very good. You can see the screen. You can see the screen. Excel you can see.
Okay, okay, sir. Yes, sir.
The desktop you can see. So last one whack. As usual whack I will not do. Work out.
Get your right color.
14, sir. Third. Third one is 14, sir.
You forget the income tax repeatedly. Income tax. Repeatedly. Same mistake you do.
Yes, sir. Sorry.
End of the day, you end up with quarter mark class. Half mark will go. That's what. Even you do your presence of mind is that full. Correct? Huh?
Yes, yes, sir. Yes, sir.
So this is the answer. You can see. If I'm having a doubt, kindly let me know. I'll explain you one more time. Confusions. There is a reason I'm taking you very simple way of calculation. Make your life easy. No complications. So I repeat the question and the answers one more time for the benefit of the members. In the question, the first question is that beta of the liver company. Beta of the liver company we can't find out unless you know the beta of that particular company. To understand the beta of the liver company, first you have to find out the available data. What is available? In the available data, cost of equity for the unlevered company was given. So by using the formula, you arrive the value of beta of unlevered company. So from using the beta of unlevered company, by using the formula, you are finding out the beta of the levered company. So that is nothing but 1.4. And by using the beta of the levered company, once you know, it's the child's cake play that you arrive the cost of equity. Cost of equity is nothing but risk-free return plus beta into risk premium. Then, as usual, you'll find out the weighted average cost of capital. While finding out the weighted average cost of capital, be rest assured that you should not do the mistake of income tax benefit for the whenever debt is there. Generally, this mistake one time you'll do in our examination. That is the reason repeatedly, strongly I'm telling you, don't forget interest. That mistake, once you can do the mistake, but same mistake you should not do. Okay. So hope this is a very interesting question which we are able to understand that. And another one very important question. I'll take question number 6. Question number 6. So, who is good in English? Who can read this? Madam can read. I have a sentiment. Anyone who is reading this question in my class, they will clear in the first attempt. I have a sentiment, and it's happening also. So who will take? Shraddha. Shraddha. Take. Anyone?
Equity index is established in 2001 for a country that has relatively recently established a market economy. The index vendor constructed returns for 5 years prior to 2001 based on the initial group of companies constituting the index in 2001. Over 2004 to 2006, a series of military confrontations concerning a disputed border disrupted the economy and financial markets. The dispute is conclusively arbitrated at the end of 2006. Total 10 years of equity market return history is available. As of the beginning of 2007, the geometric mean return relative to 10-year government bond return over 10 years is 2% per year. The forward dividend yield on the index is 1%. Stock returns over 2004 to 2006 reflect the setbacks, but economics predict the country will be on a path of 4% real GDP growth rate by 2009. Earnings in the public corporate sector are expected to grow at a 5% per year real growth rate. Consistent with that, the market PE ratio is expected to grow at 1% per year. Although inflation is currently high at 6% per year, the long-term forecast is for an inflation rate of 4% per year. Although the yield curve has usually been upward sloping, currently the government yield curve is inverted. At the short end, yields are 9% and at 10-year maturities, yields are 7%.
My God. I asked Madam to read simple English. She made some difficult story. So write out the questions and try to answer in the examination condition. Three questions are there. Once done, let me know. We'll start.
Sir, which question we are solving? Sorry, I joined now.
6, madam.
Sixth one.
Index established in 6.
Okay.
We'll go. So, answer. Question number 1. What is the answer? First, we'll take answers. Then we'll go for answers, the logics or any other thing. Question number 1. What is the answer?
B, sir. B. B.
B for Bombay.
Yes, sir.
Okay. One answer B. Any other answers? If you answer B, you lose quarter mark.
C, sir.
Huh?
C.
If you answer C, another quarter mark is gone.
It's a balance, sir.
So balance left out is A only. So you can take for this question A. So lesson from these, whenever these type of questions where we have no clue, no understanding, no clue or no other thing, two alternatives. By prima facie reading itself, you can conclude it is outside of our mind and sight. Just blindly leave it and go for some other thing. Don't disturb your time. It will happen. Don't disturb your time and don't disturb your mood. And don't disturb yourself so things. As I told you yesterday, even 10 marks, if you are not attempt also, you will clear the examination. Nothing to worry. So these type of questions, don't use your expertism or don't use your guessing work or don't use your some other pray God and doing something. That will not work out in this examination. Don't do that. If you are confident, if you are logically, if you want to apply your mind, or else you are very confident this attempt we are not going to clear. That conclusion you come to one stage. That stage you can look, you can free it. If you want to take it as free hit, you can use this as a free hit. Otherwise, these type of questions don't take a chance when you are generally having a border of 55, 56, 70, 60. So typically there is no big logic in this. Actually, this question was taken from some other resources and partially they cut and they thrown to us. And this question is very important in the sense of model is important. This type of model is important in this pandemic situation, corona situation. There we called as a military case. Now today is corona case. So easy understanding when before this particular military event was happened, war was taken place, the industry is stabilized and it's a growing in sense. That is the reason you used 2001 before. Prior to 2001, it is an upward direction. Premium will be upward direction. It is in the stabilized way. So, event in 2004 and 6. Second question. So, answer for the first question, A. Second question, B.
B, sir.
It is upward, it is downward. When war is there, when pandemic situation are going on, rates will be not stabilized. So the rate will be in the downward trend. So answer B for the second question. Common stock issue in the market average systematic risk 9% and above. C is the correct answer. First question A, second question B, third question C. Anyone answered correctly all three? One point of stage, I kept like this. 2001, if I found upwards, 2004 and 6 downwards. Any percentage, 9% above. That's what the only rule of thumb. Let me clear the examination, then we'll go for the logics. So, but concept is we have to understand this type of logics will come. So be careful about that. And probably I don't know the program of the next week about case studies. If next week I have remaining case studies, we can work into that. And before that, let me complete my MCQ part for the valuation of the equity also with the available time. So how many members are there? Active members, 7 or 8? At least before half an hour closure, let me understand. 1, 2, 3, 4 I can see. In festival day, let me see the faces, madams, sirs. 1, 2, 3, 4, 5, 6 I can see. Yeah, good, nice, very good. So thing is how we can approach this one. You keep 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Some numbers, around 40 numbers you keep, or any numbers we are going to cover. Let me discuss one by one, and each one has to read it, and each one has to give the answer. Remaining people give the opportunity. Okay. So my intention is all participants has to be participate. Only 2 or 3 only participating. Remaining people are enjoying their life. So I don't want they should not sleep today. Auspicious day. No sleep today. Let us join and take this exercise seriously. So starting with that first. Starting with who is that? First, Sir is there. I can see Sir. Sir the partner. So first Sir is there. Who is that? First one. You can also see, no? You can also see. Okay, I don't know who will start. Who will to start? Arun, you want to start?
Okay, sir.
Okay, start. This let me join one by one. One round. 8 members will complete. Again, one more round. Please, let us do 2 rounds, 3 rounds. We'll take it up. 3 questions only. We had to read 3 questions only. Start.
Sir, which one, sir? In the case study.
You can see the screen.
Yes, sir. Okay, sir.
Yeah, you start. You put 1, 2, 3, 4, 5, 6, 7. Kindly note down the answers. I'll share this particular file to you. Very important for your examination point of view. Let us practice whatever you learned so far. Start.
So in free cash flow model, free cash flow is defined as A, free cash flow to the firm or free cash flow to the equity. B, free cash flow to the equity or free cash flows to debt. C, free cash flows to the equity or residual free cash flows. D, dividend or free cash flows to debt.
Answer?
A, sir.
A is the correct answer. Second question. Madam.
The important contribution to modern portfolio theory to equitable valuation models is the insight at A. Hedging reduces the non-diversifiable risk. B. Hedging reduces diversifiable risk. C. Required return depends on non-diversifiable risk. D. Fundamental value is independent of market price.
What's the answer?
B.
E is not there one. Only A, B, C, D. Which one?
D.
D. No. If your answer is D, quarter mark gone. Then
you're frightening us, sir.
No, I'm telling the fact. Even though correctly, correct questions will go off. That's the fact only. Huh?
It's
sorry.
C.
C is the correct answer because apply the logic here. In the CIPM model, discovery return is always constant. Only beta will make significant influence on the total cost of equity. So answer C is the correct answer. Next, Shraddha madam, who is that?
Valuation is least helpful to an analyst in A. Defining investment objectives and constraints. B. Articulating an investment strategy. C. Executing an investment plan. Or D. Evaluating performance result.
Aram se. Aram say, see how to answer it. First, out of 4, 1 or 2 questions easily you can eliminate. That is nonsense. Or apply your mind. 2 questions will be similar answers. Two answers will be similar. If 2 answers are similar, there is no point of having answer in that. There will be only one answer for one question. So if any answer having options, any options having similar languages, investment strategy, investment plan, more or less same language. So it cannot be. So again, like the same way, defining investment objective, investment concept, all are talking about investments. Similar language. So the platform cannot be the same language. So what they're asking, equity valuation is least helpful. That means what out of 4, 1 is not, it is helpful only, but compared to others, this is very least helpful. So like that, you can apply your analysis and easily you can come to conclusion. What is the answer?
Sir, D.
D is the correct answer. Because balance sheet performance valuation will no way in helpful for that. So D is the answer. 4th. Next, Govardhan sir. Sir, I can unmute and speak, sir.
Yeah. All of the following are possible warning signs of declining earning quality, except financial footnote indicates revenue is recognized before shipment. Accelerated depreciation methods are used. Certain sections of SPVs are not considered for consolidation. The expenses are capitalized.
Very good.
All of the following are possible warning signs of declining earning quality. Okay. So, what are all the signs for declining earning quality? Financial footnote indicate revenue is recognized before shipment. Okay, that actually says that something is wrong. Okay, accelerated depreciation methods are used. So this one's accelerated depreciation method.
Fantastic, excellent. Because this methodology, whether which method you are following, will not make much significant. Remaining things are there. So that is the way we have to analyze. Fantastic, very good, sir. You caught the point. 5. Next. Somebody else? Madam is left out. Open. What's the name?
Which of the following are the 2 effects in the current period of a company makes an under accrual of an expense, future litigation expenses, and deducts the full amount of acquisition goodwill against the retained earnings? Overstated, A, overstated and equity will decline. B, understated and equity will increase. C, overstated and net income will decrease. D, understated and net income will decrease. Under accrual of an expense means you are showing less liability.
Now, what is the answer?
Understated and equity will increase.
Fantastic, madam. Fantastic. Very good. 5A. 6. Somebody else? I think left out people kindly.
Sir, that was 5B.
B or 5A?
5B.
I said 5B.
5B,
Yes,
yeah?
I-
Overstated. Overstated. A. 5A.
5A. Overstated and equity will decline.
A for apple. A for apple. 6. I think somebody is missing. Madams, kindly participate, sir.
Which of the following is the least likely to be considered an off-balance sheet item?
Super, very good.
Financial lease, special purpose entity, deferred income tax credit, derivative financial instrument.
Special purpose entity.
B.
Special entity.
Half balance sheet item.
Financially special. So deferred income tax credit.
Very good. C is the correct answer because it will not make sense. There is only a dummy entry.
Yes.
Form part of the balance sheet, which is not off balance sheet. C is the correct answer. Ah.
Yeah. CRM's net profit margin is 11% and operating margin is 19%. The sales are 31,50,000 and the equity is at 82 lakhs. The return on equity is closest to.
Return on equity. Yesterday also we studied, na?
Yeah.
Return on equity. Find out. Simple, no?
It B, sir.
B 4.23.
4.23 B. Yeah, B.
Everyone? So then why 19% is given?
That is only operating margin, sir.
Then why they are given?
To confuse us.
Confused.
Yes, sir.
In Russia, if you could able to multiply with 19%, one confusion, one answer will be there in here. So make yourself confused, only they give. So don't fall into that. Good. Next. I think last gentleman or madam. Over. Only 7 members. Yeah, fair enough. Arun, you start from here. Your turn start.
Flipkart, a large online trading company, recently acquired Myntra, an online fashion store. Flipkart paid a premium on its acquisition of Myntra. Flipkart accounting policy is to expense the premium in the year of acquisition. If Jignesh Shah, an analyst, wishes to determine Flipkart's operating performance relative to other online stores based on the return on invested capital, he would have to A. Include goodwill in the computation of ROIC. B. Include revaluation in the computation of ROIC. Exclude goodwill in the computation of ROIC. And D. Exclude revaluation in the computation of ROIC. Operating performance. Sir, I think it is B, sir.
B for Bombay.
Yes, sir.
Then again watermark gone.
It is A including goodwill.
Again watermark gone.
C.
C is correct answer. Goodwill has to be reduced from the thing basically. C is the correct answer. Little bit we have to approach the, this thing, even big story, you have to be taken to. Next.
Southern Switchgears produces electronic switches to its customers who are all over India. Management has gathered industry data. The expected demand and supply of the industry. Domestic capacity 562 million units. Foreign capacity 821 million units. Expected demand 412 million units. The forecasted capacity utilization to the is closest to. So
Simple. So in the expected demand, what is your capacity utilization?
Yeah, expected demand is
Expected
412.
What is your capacity? The domestic or international, this is your capacity. So what is the utilization?
136.
See.
Try to understand. They're asking a question, forecasted capacity utilization. Capacity utilization means we have domestically, we have one capacity. Foreign, we have one capacity. Put together, we have this much capacity. This much is stomach.
Sir, it is A.
Simple, no? 412 divided by 562 plus 821. This is my capacity. In that, I'm going to use
30%.
30%. Correct. So these small things we cannot do mistake. Next. Next, madam. Somebody can take.
Rohan Jain is a financial analyst covering Somani Tiles Limited, manufacturing high-end kitchen and bathroom hardware. Which of the following information is least likely to be useful in forecasting the future demand of Somani Tiles products? A market survey of home builders. B. Historical data of GDP and companies' growth. C. Ratio analysis of most recent financial statement. D. Forecast of national building permits of by region.
E. E.
C.
E. Historical data.
C.
Least likely to useful.
Least likely to use in forecasting the future demand of Somali tiles. Historical data of GDP and
B.
C, sir.
D.
B.
C.
The answer C. Ratio is only will be helpful for to understand. That's all. For market survey, definitely required. Historical without starting data, what is the comparable numbers? Will not prepare the numbers. Forecasting national print, that is also very important to understand the beta factor as a risky factor. So ratio analysis only available data to understand which ratio what will come. So there is a list that is also important, but not that much important to understand comparatively other three numbers. So answer C. Next.
Due diligence is always relating to review of financial statements meant to assist the decision of purchaser stroke investor. Nothing but in-depth analysis of financial statements generally carried out by the chartered accountants.
B.
B.
Meant to assess decision
meant
of
to
the
assess the
purchaser.
decision of purchaser and investors.
B.
Finally, what is the answer? B or D?
B.
B, sir.
B,
B for
B.
Bombay.
B for Bombay is correct answer. Next. Somebody else?
Most important aspect in any financial due diligence engagement is understanding overall financial reporting structure, review notes to account, review of audit report for immediate preceding year, documentation.
B, sir, I think.
Understanding the overall financial reporting structure.
A is correct. A. I'll share this, don't worry. Kindly note down answers.
Due diligence engagement involves A. Selection of statistical samples. B. Selecting and evaluating samples based on judgment. C. Selection of random samples. D. 100% verification of selected account balance.
B.
Did B, sir?
D, sir. D.
Due diligence nowhere 100% will be done.
It's B.
Even for it also.
B.
Selecting and evaluating samples.
Selecting and evaluating.
Based on judgment.
Next.
Sir, what was the correct answer?
What's the correct answer, sir?
B for Bombay.
B.
B for Bombay. Okay, next. Is that?
Yeah. The due diligence engagement is carried out always before completion of related transaction, usually before the related transaction is completed. After completion of the transactions, none of the above.
A.
I think it's A, sir.
A. It should be A.
So it should be C. Engagement is carried out always before the completion of related transaction.
Language is very, very important. English is very, very important. A is, if you write A, quarter mark gone. Always cannot be engaged. Due diligence will not happen in always. Once
A and B means the same.
Okay.
No, one transaction was initiated, in middle of the transaction, if the investor feels that in a particular area you want some due diligence, he can order and get it done the work also. It's not always. It can happen anytime. That is answer B. B is the correct answer.
Usually.
So always and usually it makes lot of sense. Always means mandatory, should. It cannot be. So language will make lot of sense. Kindly concentrate on that. Next.
Uh, Following may not be covered as a part of financial due diligence. Review of inventory valuation A. B is review of related party transactions. C. Review of provisions for employee benefits. And D. Review of patent litigation filed against the target entity. I think it is D, sir.
So Delhi. D correct. Next.
In general course, due diligence process is useful for investor, seller, regulator. The option are 1 and 3, 1 and 2, 2 and 3, and 1, 2 and 3.
D.
So 1 and 3.
1 and 3.
Investor and regulator.
I think B, sir. 1 and 2.
1 and 3.
D.
Yes, sir.
D for Delhi. It will be used. See, due diligence is a simple one. Anyone can use it. D for Delhi.
As per SEBI ICDR regulation, valuation may be done by A. CA, B. CMA, C. Merchant banker. The options are A. 1 and 3, B. 1 and 2, C. 2 and 3, D. 1, 2 and 3.
A 1 and 3.
1 and 3.
D.
Merchant banker.
What is the correct answer?
D, sir. D.
No, C is CMA.
Sir, which is the correct answer?
Only 1 and 3. A.
A.
A for apple. Next. Fast, friends.
Which type of due
Yeah, go ahead. Madam, go ahead. Madam.
Which type of due diligence focuses on matters such as contracts, compliance with law, corporate structures and governance, antitrust, exchange control, litigation, etc. Operational due diligence, financial due diligence, technological due diligence, legal due diligence. Legal due diligence.
Simple. Very good. Next.
Due diligence can be carried out by number 1 CA, number 2 lawyer, number 3 CMA.
D.
I think D, sir. All.
D. All. Everybody.
All.
For Delhi. Simple. This is not my area, Raju sir idea, but anyhow, do it.
Sure.
A bond's coupon rate is equal to the annual interest divided by which one of the following? Discount, current price, face value, clean price.
B, sir. No? Bombay.
Interest divided by
Face value.
Face value. C, sir. C.
C. Face value.
Chennai.
C.
Mr. X purchased a bond which pays 100 rupees a year as interest. What is rupees 100 known as? A coupon, B. Face value, C. Discount, D. Call premium.
A. Coupon.
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 A bond that has only one payment which occurs at maturity defines which one of the following: debentures, callable, floating rate, zero coupon.
Zero coupon bonds.
Zero coupon.
A bond that will pay rupees 175 each year in interest plus rupees 10,000 principal payment at maturity. What is 10,000 called as? Face value.
Very good. Face value is correct.
Real estate.
Real rates are defined as nominal rates that have been adjusted for which of the following: inflation, default risk, accrued.
Inflation.
Inflation, whenever real rates are coming, inflation will come. A is correct.
Your facility has a gross income of 5,50,000. Your operating expenses are 1,75,000. Let's say that facilities of your size, condition, and location are selling for 8.25% cap rates. Figure out the value of your property.
Easy. Find out the income divided by 8.25%. Capitalization method.
A 45, 45, 455.
Yes, yes.
A.
Okay.
Next.
On analyzing a toy retailer which has got 100 million in revenue, the total revenue of the whole toy industry is 70 billion and expected to grow at 3% annually for the next 10 years. At the end of 10 years, the toy retailer is expecting a market share of 5%. Find out the compounded revenue growth.
So if you use the formula of compounding and finding of the value, you will get answer B. You don't want to waste my time. Compounding, everybody knows. Next question. Answer B for that. Next question.
Value of equity is A, free cash flow, B, present value free cash flow, C, future value of all dividend payments, and D, present value of all payments.
B.
B for Bombay is correct. Next.
Free cash flow to equity, FCFE. A, net income minus capital expenditures plus depreciation minus change in non-cash working capital plus new debt issued minus debt repayments. Or B, net income plus capital expenditure plus depreciation minus change in non-cash working capital plus new debt issued minus debt repayments. Or C, net income minus capital expenditures plus depreciation plus change in non-cash working capital minus new debt issued minus debt repayments. Or D, none of the above.
So whenever these type of questions are
B,
asked,
B, sir.
I'll give logics for you so that it's easy for you to understand. The logic is these type of questions. Generally, there will be an answer out of these three. There should be one answer because this much difficult logics are given. End of the day, they will not cheat you. So answer D straight away. Time being, you can treat it as a not applicable throughout. Then you see from back to front. Go for back to front, then it's easy for you. Minus debt, minus debt. All are minus debt. This debt repayment should be minus. Simple language. Next, minus debt issued. Plus debt issued, debt issued. Debt issued means inflow. So debt inflow will come. There cannot be minus. So when it is a minus, straight away throw it off. Straight off. Gone. Now it's between the play between the A and B. So now up to this logics we find out. Next, changes in the non-cash working capital. Minus is there. Fantastic. That's correct only. Plus depreciation because non-cash flows to be added back. Correct only. Now here minus capital expenditure plus capital expenditure. Capital expenditure always will be minus. So that way, if you go front to back, you can easily eliminate in this stage itself. If you go back to front, this stage you can eliminate. So like that, one logic either front to back or back to front. If you apply the logics, we can easily find out the answers without any doubt. The answer is A. That is the logic of answering.
If yield is less than coupon rate, Debt will be priced at premium to its par value. Debt will be priced at a discount to its par value, or none of the above.
The A.
Yeah. Good, very good.
Equity risk premium is premium as per capital asset pricing model. CAPM is not dependent on the time period used, choice of risk-free security, arithmetic mean, geometric mean, Reserve Bank annual policy review document.
C.
Arithmetic mean and geometric.
Arithmetic mean or geometric mean?
I think is it D, sir?
D for Delhi.
D. Yes, sir.
Next.
On the internet, you find that IBM is expected to generate earnings of $4.38 per share this year, and that the mean PE ratio for its industry is $27.195. Using the PE valuation method, find the value of IBM shares.
Yesterday, that is the reason I asked to note down the formula of PE ratio. PE ratio is equal to MPS by EPS.
Okay. So 27.195 by 4.38. 6.2, sir.
PE ratio is given.
Okay. 27.
Just multiplication only.
Yeah.
Yes.
119.11, sir.
A is the answer. Next.
Suppose that you are interested in buying the stock of a company that has a policy of paying rupees 6 per share dividend every year. Assuming no changes in the firm's policies, what is the value of a share of stock if the required rate of return is 11%?
Simple. Simple formula, only one formula. I already told number of times.
Value of share stock.
Constant, no growth.
54.54. C.
Simple. C. C for Chennai. See how the answers are given 5.45, 54.5, 45. How the answers are confusing you. Only intention is to make you to do mistake. That's all. 32 easy. See, next.
Macro International will pay a dividend of rupees 2.5 per share next year. If the company plans to increase its dividend by 9% per year indefinitely, and you require a 12% return on your investment, what will you pay for the company's stock? So 2.5 divided by 12 minus 9 is equal to 83.33.
Very good. B is the answer. B for Bombay. Next. Same. What?
Suppose you know that the company.
So, excuse me, sir. So, what was the answer for the last question?
B for Bombay.
Suppose you know that the company just paid a dividend of rupees 1.75 per share on its stock, and the dividend return on this stock is 10%. What is the current stock price?
Simple. Same story.
87.5, sir. No.
You cannot do it in this stage. No mistake. MP0 is equal to what, sir? MP0 is equal to DP1.
94.5, sir. 94.5.
Then where is the mistake?
I didn't add this growth rate, sir, to dividend.
D for Delhi. Don't do mistakes, friends. Don't do mistake. D for Delhi. Oh, next. Same. Okay. 35. Also D. You note down. Next. This one is easy, simple. CFP model. Fatafat.
You are considering investing in stock that has an expected return of
Risk free is 5,
risk
market premium
rate
is
is
5.
5%
What is
and
the beta of the stock?
what must be the beta for the stock?
That is 13. Okay. Risk premium is 7. Sorry. 5 plus beta is 7.
1.14, sir.
Okay.
What is the answer?
1.14.
A is the correct answer. A. Okay.
Suppose you bought a stock at the beginning of the year for rupees 76.50. During the year, the stock paid a dividend of rupees 0.70 per share and had an ending share price of rupees 99.25. What is the total percentage return from investing in that stock over the year?
So annual rate to closing minus opening plus dividend divided by closing minus opening plus dividend divided by closing. Beginning. Closing minus opening plus dividend divided by beginning.
30.65, sir.
30.65. Simple. B for answer. B for Bombay. Now we are discussing about yesterday also arbitrage pricing method. Arbitraging pricing method is nothing but taking the different criteria, beta of different company, different things, proportionately taking the betas and arriving the value with the proportionate of the investment and other criteria and finding out the value. That is called arbitrage portfolio theory. Proportionately calculate.
Has to be
Proportionately calculate.
Yeah. 1.06.
1.06.
Very good. Good going. Next.
Which one of the following statements is not true about efficient market? Share prices behave randomly and do not show any systematic pattern in the behavior. Price of one share is independent of the price of the other share in the market. Share prices fully reflect all available information. None can earn abnormally high profits on a constant basis. Not true.
following statement is not true. That means
Is it C, sir?
C, share C.
share prices fully
B for Bombay.
price of
It
one
will be
share is
independent always. Cannot be influenced by any other share. I'm independent, you are independent. Next.
Value of an asset by looking at the price of the comparable assets relative to a common variable like earnings, cash flow, book value, or sale is A. Discounted cash flow valuation, B. Relative valuation, C. Contingent claim valuation, D. Free cash flow valuation.
B for Bombay. Total valuation. Next.
which of the one is not the principles of valuation? A. Principle of substitution. B. Principle of time value of money. C. Principle of risk and return. C. Discounted cash flow valuation.
A.
Yeah.
A.
Principle of risk and
Sir,
return.
time value and money.
Not the principles.
Sir,
Discounted cash flow
discounted
valuation.
cash flow valuation is not a principle.
It's a method. It's a method for valuation.
Very good. But yeah, next.
Dash is the typical price a product fetches in an unregulated market.
Is the typical price. Value.
Is it A, sir?
Price.
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 Very good.
Price.
Value. Price is different. 42A.
If the expected rate of return on a stock exceeds the required rate, A, the stock is experiencing supernormal growth. B, the stock should be sold. C, the company is not probably trying to maximize price per share. Or D, the stock is a good buy.
B, sir?
The stock should be sold.
Is it B? B.
It is D.
I think price will fall, sir.
C, the company is not trying to probably maximize price per share.
Since expected return is more than required rate, I think price will fall.
It's a good buy.
So I can't. Session over.
Is it disconnected or what?
A further class with Mr. Hemant Kumar, sir? Any other day?
I think there's a disconnect in.
He's coming again.
Him again.
I think Raju sir is not joined.
Okay, sir has come. So please finish off with the MCQs.
Well, what's the 43rd answer, sir?
43D. Good to
The
buy.
stock is a good buy.
We'll go for next.
If the company has a PE ratio of 20 and a return on invest equity of 15%, then the market to book value ratio is 3 times, 3%, cannot be calculated from the given information, none of the above.
A, 3 times.
Assume that in a stock market, the CAPM is working. A company has presently beta of 0.84 and it's going to finance its new project through debt. This would increase its debt equity ratio to 1.56 from the existing 1.26. Due to increased debt equity ratio, the company's beta would increase, decrease, remain unchanged, or nothing could be concluded.
It is B, sir?
No, it is C.
C.
C for Chennai. I think Raju sir also joined. So this is a time for me to take leave. So I hope all of us noted down the answers. So I'll share this particular file of to work into. And so thank you very much, friends, for the patient and cooperative interactive session of for last 2 days. So I wish all the best and best wishes for your examination. And I'll catch you very soon with your good results and catch you at your certificate of practice session for a day. So that time we'll catch you all. So thank you very much. Thanks for your support.
Thank you, sir.
Thank you, sir. Thank you, sir. Have a great day.
Thank you.
Thank you, sir.
Thank you. Any feedback?
Sir, we had a very good session with you. Like
It's almost like an.
was very interactive.
Thank you.
It's almost like an exam session, sir. So, practice over.
Thank you, madam. Thank you all. All the best. God bless you.
Thank you, sir.
Thank
you,
you.
sir.
Oh.
Actually, there is.
Okay. Good afternoon, friends. So before we start the session,
Good afternoon, sir.
very good afternoon.
Good afternoon, sir.
Very good afternoon. So may I request any one of you to just share what has happened from today morning? Maybe may I request Shalini ji to share what has happened from the morning, please? No, you are you have to unmute, madam.
So classes are going on since morning, and sessions are quite interactive. And last session, so impact was very much interactive and doing that, enjoying it. Forgot that today is the Dashera and all, but these things are going fine.
Okay. So what was the topic that was discussed in morning and afternoon?
India's 38 discussed, sir.
INDS 38, 36, 113 or intangible assets, then valuation application. The first topic was held by Mr. Muralidharan sir, and second one was taken by Hemanta Kumar sir.
Thank you very much. So then let me. Yeah. So this is our syllabus, and today I'll be focusing on intangible assets, valuation of intangible assets. And your syllabus is forming part of your 35 marks in your valuation application. So your serial number 8, valuation application. Good. And this is a very compact syllabus. If you look at this, we need to understand nature, classification of intangibles, identification and nature of intangible assets. This part, the second para, is compared to your IND-AS 38, which is intangible assets. And they have never mentioned anywhere that IND-AS 38 is there in your syllabus. Even in your serial number 5, IND-AS 38 is not mentioned specifically. But your para number 2 speaks about that, especially acquired or internally generated, generating cash flow independently, intangible assets under development and research. So all this stuff is only from IND-AS 38. Then the purpose of intangible assets. Under the purpose, you have many. So one of the purposes is financial reporting, another is legal, tax reporting, and transfer of intangible assets, lending. So all these are purpose. From purpose, there will be only 1 mark or maximum 2 marks. And maximum number of questions will be only from your valuation approaches. And here they are listed. They have listed out excess earning method, relief from royalty, premium profit, greenfield method, distributor method. They have listed out 5 methods. And these methods are income approach. So all these 5 methods are coming under income approach. And apart from this, so does that mean syllabus has only income approach? No. Other valuation approaches as applicable. So that is very given very generally. Plus what is the discount rate, cost of capital applicable for intangibles. So this is your syllabus. So before I venture into the syllabus, so I'll just share with you some of the pointers. So what are the material to read, especially with respect to valuation of intangible assets? My suggestion is the entire marks lies only in the valuation standards itself, especially for intangible assets. If you look at this, this is the comparison between ICRVO and IBS. So your ICRVO 302 valuation standard is about intangible assets, and the equivalent of international valuation standard is 210 intangible assets.
So these are the two standards I'll be comparing or referring every now and then. Good. So this is the three I'll be referring. So, and the questions will be only based on these these three areas. India is 38, ICRBO valuation standards 302, and IBS 210. Then, so before I venture into the main topic, there is one particular book maybe you can refer. That is Technical Guide to Valuation, especially page number 45 to 61. Okay. So hope all of you have that material with you. So this is that book. Asset valuation. So page number 45 to page number 61. So this is the chapter, and don't jump into this chapter. So this chapter is an amalgam of all the three. ICRBO valuation standards, India is 38. So all the references will be there. So better to go to this particular chapter after a thorough reading of everything. Okay. So this will be like a revision. So maybe if you are preparing for an examination, so a week before your exam, you can read this particular chapter. So this will be worthwhile. So this is given in a capsule. So we'll try to understand the meaning of intangible assets, measurement, recognition, types of intangible assets, approaches, purpose, and all this stuff we'll try to understand. Now, before I venture into the topic, I want to share with you one important point that India ranks third globally in intangible assets. And please look at this. This is a research report on world's intangible value. So you can actually download that report also. This is that report. It is published by a UK-based, London-based company called Brand Finance. So they have analyzed almost 500 companies across the globe, including Indian companies, where they have identified that India has an estimated intangible asset component of 74% of their total enterprise value. My goodness. So we are actually in rank number 3, and maybe first and second rank is US and Switzerland. My God. So that means only 1/4. Okay. So estimated intangible asset component, which is that means, please look at this summary. I'll just give you one summary. Please look at the summary. This is the breakdown of corporate assets, including intangibles. So enterprise value, if it is 100 crores, equity is this blue section. Debt value is this. And your gray portion is the premium over and above the book value, and that is your enterprise value. This gray, why you are paying more? And when they investigate, they understand that the total enterprise value, 1/3 constitute tangible assets and 2/3 constitute intangible assets. And another surprise is, out of this 2/3, only 1/2 is disclosed in the books of accounts. The other half is not disclosed. See, look at this table. You will be quite surprised. Maybe you can take any one. I don't know whether it is visible, to what extent it is visible. Any one you can take. Maybe you can take PepsiCo, or maybe I have to show you the table here. So please look at Microsoft. So the total intangible value is 904 crore. Total intangible. And what is the percentage intangible to enterprise value? 90%. So it differs company to company. So that is an average number that has been given. Then what is a disclosed intangible? It is only 8 million, 8 billion US dollar. So out of 904 billion US dollar, 8 billion is only disclosed. Undisclosed is the balance. My goodness. Let us take Facebook. 409 billion US dollar is the total intangible value. Intangible to enterprise value is almost 79%, 80%. Disclosed is only this much. The remaining fully is undisclosed. So disclosed goodwill and disclosed intangibles, $19 billion. Balance is undisclosed. So like that, they have given for every company. So what is the message is, it is not only for very big companies, it is also for, I will say, very small companies also, or even micro, small and medium enterprises also. I'll just share with you certain photographs, maybe. I think this is one mess in Vijayawada, very popular. This is one hotel in Udupi called Mitra Samaj, very popular, almost more than 7-8 decades it is there, and it is in the near to the temple, Udupi Krishna temple. So where you get fluffy hot idli and vada, and this is a mess which has been serving hot banana leaf food for I will say more than 80-90 years. It's very popular in Vijayawada there, and every city for that matter will have such a popular spot is there. And you mean to say in their balance sheet intangible assets would have been there? No. And every small and medium enterprises in our country, they have an intangible asset which is not disclosed, which is not recognized, which is not measured also. And even large enterprises, so example I just showed you now. So undisclosed intangible assets are huge, huge. And I want to share one more information to you that, yeah, see in the latest valuers bill, okay, the valuers bill, there is one particular para. Okay, I don't know how many of you have gone through that valuers bill. This is that valuers bill. Now I want you to look at this in the development of profession. The market needs valuation of every asset. Expertise required for valuation of each asset varies. Presently, how many asset classes are there? Only 3. Now, you mean to say only 3 are the only asset class? No. So, while the framework may enable valuation of all kinds of assets, to start with, there will be 3 asset classes: land and building, plant and machinery, and financial assets. So, the 4th asset class may be included. And I strongly believe the 4th asset class will be intangible assets. So let the show begin now. Okay. And I want to, these are all some of the other statistics you can go through. And I will just share with you one interesting input with respect to this. This is given by UNESCO, and they have identified 13 intangible cultural heritage elements from India so far. And Ministry of Culture has appointed Sangeet Natak Academy, which is an autonomous body of Ministry of Culture, for matters relating to intangible cultural heritage. And there are many cities in our country which is connected with this cultural heritage. And revenues are generated only because of that. Please look at this 13 cultural heritage identified by UNESCO. This is only a beginning. Vedic chanting is a cultural heritage. And Buddhist chanting of Ladakh, recitation of sacred Buddhist text, is actually a UNESCO cultural heritage. Yoga is a cultural heritage. Kumbh Mela is a cultural heritage. Maybe some of the states' special cultural dances are cultural heritage, like Kuttiyatam in Kerala, Mudiyattu, and Rajasthan, Kalbelia, and Chow dance. All these are, they have just identified. So, as a beginning, and the list will increase. So, with this, I want to start with the first point. So, point number one, guys. We know what is the standard number for international valuation standards. It is 210 for intangible assets. So that is actually one question. So which of the following IVS deals with intangible assets? So it is actually IVS 210. I know being a very, it's an afternoon session, it will be difficult for you to concentrate, but I want you to respond. So whenever you know the answer, please type it in the chat box. Okay. So what is the answer for this question? Yeah, you have to type it fully. Type it fully. No ABCD. After the alphabet, what is there? I want. Very good. Very good. So it is IVS 210. Then it gets registered. Very good. Thank you. So it is 1B. Good. Now, next question. How about others? Only Mr. Purushottaman, Arun Vishwanath, Shraddha. Okay. Shalini also has typed. Good. Now, what is an intangible asset? If you take the definition from all the three, you have a common definition. Only three points you need to mention. Remember, identifiable, non-monetary, without physical substance. All of us, we know intangible means you cannot see and touch. So therefore, it is without physical substance. Non-monetary, it is not a current asset. There are intangible assets which are treated as current assets. Example, inventory. I buy software, sell software. It's intangible asset. But that is an inventory for me. So then it may not come under this. Okay. Because I only consider that as a product. I only consider that as a product. I buy the product, I sell the product. But the product is intangible. But for me, it is a product. So an intangible asset is identifiable, non-monetary, and without physical substance. So that only, and this is an exam question. I would have asked this question later, not now. Now, let us understand the types of intangible assets. I repeat, the types of intangible assets. There are actually 5 types of intangible assets. From this, there will be exam questions. Okay. So what are they? Customer-based, contract-based, and technology-based, artistic-based. Generally, we'll only get the doubt only between customer and contract based. And what is customer? Anything related to entity, company, and customer, and the relationship between the entity establishing relationship with this customer. How? Example, having customer relationships. Sometimes you will you want to buy sabji. You will buy sabji only from a particular vendor. Even though so many vendors are there, you will only buy sabji from one particular vendor. Similarly, order backlog. L&T has order backlog. So meaning their hands are already full up to 2024, 2025. L&T is the only company they listed in their annual report their order backlog, which is not a mandatory one, but they voluntarily disclosed it. And they valued that order backlog also, for your kind information. I want call sheet of Salman Khan. There is Salman Khan's call sheet is order backlog. Why? It is full. Until 2024, 25, he doesn't have call sheet. Okay, good. So that is why these are all called as customer based. Now, contract based as an agreement. Rights that arise from an agreement. Example, employment contract, natural resource contract, rights contract, service contract, broadcasting right contract, permits, route permit contract, lease agreements. That is also contract related. So, contract related intangible assets. That is why in lease agreement, in India is 116, they say ROU asset, right of use asset. The right of use is an intangible asset. And you are listing it in property, plant and equipment in your non-current asset. Okay. So we measure that and we do it. So what is it? Contract related and customer related. So please be very careful about it. Now I'll distinguish between artistic related and technology related. This is where you will always get a doubt. Artistic related, please understand, it will always from benefits from the artwork. Benefits from the artwork. Example, films. You shoot a film, what is the benefit from that artwork? Music, benefit from the artwork. Books you write, from that, what is the benefit? Play you write, copyright, it is a non-contractual. What is the benefit arising from this artistic one? Now, what is technology based? Technology based is basically proprietary knowledge. Now, what is proprietary knowledge? Remember, guys, there is a lot of difference between what do you call it as art based and technology based. In technology based, you have what do you call it as proprietary knowledge is there. But here, artistic based, it is some creation out of your skill. Out of your skill. So, can I say there is a knowledge, proprietary knowledge is there? Proprietary knowledge will be there, and that is why there is a one term that is common between artist and technology. Please look at this copyright. Copyright comes under technology. Copyright comes under artistic also. Copyright non-contractual. Copyright here it is contractual. So technology based. Okay. So copyright, when the moment you have a contract, then that will come under contract based. But what is non-contractual copyright? What is copyright? From the proprietary knowledge, you are the owner of for example, a book you have written, okay, or a formula. So generally copyright is only with respect to any creation, anything which has been created. So the person who has actually created the original creator of that music or whatever, that is where that proprietary knowledge will come. So please be careful with respect to the distinction between technology based and artistic based. So you need to have a very important clarity here, number one. And another point I want to share, patent, if it is a registered patent, I mean unpatented technology, patented technology. What do you call it as a registered patent and unregistered? So if it is a registered patent, valuation will be less. Unregistered patent, valuation will be more because secret is there. So, but it is quite vice versa. For example, trademark. Trademark doesn't come under technology, doesn't come under artistic, but trademark will come under market related. Yes, why? It actually useful for evolvement of business and growth of business. Please look at this red color. Evolvement of business and growth of business. So now, come to questions. Which type of intangible assets are created by entity establishing relationship with its customers? So relationship with customer means customer based. Okay. So to be. Okay. Customer based. Very good. Next. Under which method are those intangible assets that create proprietary knowledge? So I told you, proprietary knowledge, is it the artistic based or technology based? So artistic based means it is benefits arising from artwork. Technology based means proprietary knowledge. Okay. So it is artistic wrong. Artistic is wrong. Shraddha, Dacholia, Shalini Agarwal, artistic is wrong. It is technology based because proprietary knowledge means technology. Okay, that is what I have given here. So 3A. You have to be very careful. Which intangible asset arises from right to benefit? Benefit from artwork is artistic. Okay. This is artistic. So this is 4C. Very good. So now, customer-based intangible asset, please understand. This is entity establishing relationship with its customer. Can I enter into an agreement with my customer? You should only buy from my shop. You can do so. Okay. Especially whenever there is a bulk purchases is there, you will enter into a contract for getting a bulk order and you may give a discount. He'll also say, I will not give order to anybody else. I'll only give to you. So all this stuff. So it can either be a contract based or non-contractual based. So that is why it is both. Customer based intangible asset is maybe contractual or non-contractual, both. This is here. Okay, so very interesting. Both A and B. Okay. Right. So it is 5C. Which of the following is not an example? Very important. Your exam questions will always be like this only. Not an example of customer-based intangible assets. So that means the other three are customer-based. Backlog orders customer-based. Customer relationship is customer-based. Customer contract is customer-based. Trademark is not customer-based. Trademark is market-related. Okay. So trademark is market-related. So answer, what is wrong is the right answer. So 6D. Okay, what is wrong is the right answer. So next, look at 7th question. Which type of intangible asset include customer list, backlog, contracts, contractual and contractual customer relationship. So backlog orders, so customer relationships, so it is customer based. So 7B, customer based. Good. Now, slowly I will take you to the method of valuation. Remember, you have income approach, market approach, cost approach. In market approach, can you value intangible asset? Very, very rare, difficult. Why? Because you need to take a comparable intangible asset, take its value, and then say your intangible asset is values this. Or maybe you have to actually do some adjustment, add premium, discount, all those adjustments you have. So what do? It is called relative valuation. It is called relative value. In relation to the comparative, your subject intangible asset value is this. So, which of the following method under market approach? Remember, market approach. Would you consider appropriate in valuing intangible asset? Okay. So, relative. Okay. So, 8B. And remember, guys, multiple, I'll use an income approach. Why multiple? Especially, I'm not able to project my income. Okay, I'm not able to project my income. So what I will do, I want to measure the income based on a comparative. So I will take a market, a comparative data I will take, a comparative company's data I will take. That multiple I will use it for my projections. So multiple. So that is also market approach only. Using market, you do your valuation. Will it come under income approach? No, it will come under market approach only. But appropriate. So while valuing intangible asset. So this you in multiple, you will only take the number. Then you have to do a lot of other calculations. Especially, you have to do a lot of income calculations. Then only you will arrive at the value. So therefore, generally multiple, unless another they make it very clear. This multiple you are going to use for what purpose? Okay. So then we can say, generally we'll say multiple we are only using for an income approach. Okay. Multiple can also be used for a market approach. Like for example, 2x. So the company's valuation, 2x I will take here. So, or 50% of that 0.5x I will take here. That is also multiple. But they have to be very clear. Generally multiple, we only use it for, we call it a EBITDA multiple. EBITDA multiple is what? It is earnings. Earnings means what? Income approach. Okay. So generally multiple, we only use it for earnings, income approach. 9. Evolvement of business, further growth. Remember, evolvement of business, growth of business means market oriented or market related intangible assets. Okay, market. So, good. So 9A. Which of the following is not an example of market related? That means other three are market related. Trademark is market related. Brand is market related. Internet domain name is market related. Lease agreement, it is actually contract related. So therefore, lease agreement is the wrong answer for market related. That is the right answer here. So 10D. Which intangible asset includes plays, books, films, music, non-contractual copyright protection, artistic?
Artistic.
Oh, very good. So I think you can unmute you and then you can answer, whoever wants to give an answer. That is, so 11C. Now, which intangible assets include patented technology, unpatented technology, formula, design, software, recipe also, grandma recipe.
Technology based.
Technologies.
Technology related. So 12B. Good. So now this is a reverse question. So previously they gave the example, you have to they gave a market related, you have to find which one it is. Now they give the example, you have to find the type of intangible asset. So now what are all the approaches in intangible assets? Same three approaches. If you look at the IVS 210 para 40.1, they say go to 105, whatever approaches they are given, same approach, three approaches. In IC RVO 302 para 42, they say there are three approaches, which is market approach, income approach, and cost approach. They say generally following three main valuation approaches. Do you have any other approach other than this? Yes, you have. Okay. Right now, 13. Which of the following approaches are used for valuation of intangible assets?
All the above.
All the above. So 13D. Now, this is a very important observation you have to make. The cost approach commonly used for intangible assets such as, this is in para 70.3, IVS 210. So, I will value an intangible asset like assembled workforce, internally developed software, acquired third-party software under a cost approach. Why? Because maybe I may not have a comparison. So if I have to go for a market approach, I may not have a comparison. And doing an income approach for this is very, how I will connect that to an income, that is also very difficult. So unless and otherwise it is a completed product and it is marketable, all this stuff is there. So that is why cost approach is the most, I will say, the common approach. Okay, cost approach is commonly used. Okay, good. So now please look at this question. The cost approach is commonly used for intangible assets such as the following. Okay. So they are given all the three, so all of them. So 14D, whatever we just now discussed. Now this is taken from IC RVO 302, para 42 to 84. This is with respect to market approach, two methods they are given. Income approach, 5 methods. Relief from royalty, meme method, multi-period excess earning method, with and without method, greenfield method, distribute method. So 5 methods. So in cost approach, you have reproduction and replacement. Now, which of the following is not a method under income approach? Just now we saw RFR, MEM, WWM, greenfield, distributor. Greenfield is income approach. With or without is income approach. Relief from royalty is income approach. Comparable transaction is not an income approach. Comparable transaction is a market approach. You compare, take a data, and then you arrive at the value. So 15B. Income approach, you have these 5 methods. So ICRVO 302, para 42 to 84, income approach. This is IBS 210, para 60.5, income approach. There are 5 methods. Okay, good. And another point you are closely, you have to observe here. The alternative for with and without method is called premium profit. Okay, good. And this is a very important table because this will give you a clarity with respect to what type of intangible asset you will use to for what intangible asset will be valued using what method of income approach. Okay, so this is actually we can call it as the method. So your meme approach you use for a primary intangible asset. Now, whether one moment you have primary intangible asset, you have a secondary intangible asset also. So meme and distributor, you need to, it goes together. They are in the same family. That is why I used to say always, meme means mother-in-law because mother-in-law means M. M means mother-in-law. And D, distributor, means daughter-in-law. Okay, and mother-in-law, daughter-in-law don't go together. All of you know that. Okay, that is a general worldwide synonym. That is a synonym. So, when in a company, if there are more than one intangible asset, in the balance sheet, it is not one intangible asset. There are 2 or 3 or 4 or 5 intangible assets there. How do you do the valuation? The primary intangible asset, you will adopt mean method. And for the secondary intangible asset or assets, you will adopt distributed. So, example of a secondary intangible asset is customer relationships or customer list. And primary intangible asset is technology, okay, or software, that stuff. The relief from royalty, we generally use relief from royalty for brand know-how. Whether you have to go for lease of those intangible assets, or you want to buy, you want to purchase that asset. So that is the place where you will actually use RFR method. WW method, M means with or without method. And generally, it is for non-competing agreements. And greenfield method we will use for franchisee agreements and also for the broadband spectrum. Okay, so the franchisee agreement is also for spectrum, broadband spectrum. So I'll use for both. So greenfield I'll use for franchise agreement as well as for broadband spectrum, 5G evaluation. So I use greenfield. So now let's go into it. Which of the following are income approach methods? So why the word is given? Out of this, any one will be there. Why are? Sometimes all will be there. Which is income approach? Excess earning method, mean. Relief from royalty is also income approach. Premium profit is also income approach. So all of the above, 16D. Now, this is from ICRVO 302. There are 68 and 69. And non-competing agreement is the valuation of non-competing agreement is done using with or without method. Now, how do they do it? For example, non-competing agreement. So let us make one example. There is a contract, work, both of them have bid for it. And L1, L2. Now L2 guy will be eliminated. Now L2 guy approaches L1 guy. Yeah, you please withdraw, I will get the work. So non-competing. So they both of them they enter into an agreement. Now the L1 guy is asking how much you will pay. L2 guy says whatever I earn, we will share. So there is a method. For example, the L2 guy will do the valuation. He already is having say 5 contracts. From the existing 5 contracts, what is the revenue minus expenses, discounted, find the present value. Now, 6th contract is a new contract. 5 plus 1, 6. The entire 6 contracts, what is the revenue, what is the expenses, minus, discounted, you get the present value. This present value and the previous present value. The 5 contracts present value, net. Similarly, 6 contracts present value. 6 contracts present value will be higher. This will be lower. So the gap is the earnings. The gap is the value of the intangible asset. They say it is a 4 crore at 4 crores. So they'll say 4 crores, let us share. 50-50, 25-75, 20-80, 10-90, something they'll share. Because he's only going to sign and withdraw. Because he will be the working, he will be the active guy. So he will get the active income. By being active, he will earn the income. I am a passive guy. I only sign non-competing. Just keeping quiet. For keeping quiet, I have to be paid. So that is how the valuation is done. So it's quite interesting. So non-competing. So with and without method is frequently used in valuation of non-competition agreements. So 17A. Your exam questions are based on this. So you have to be conceptually very clear to have an understanding on these types. Okay, which method for what? Distributor method. So daughter-in-law. So I already told you what is daughter-in-law method. So daughter-in-law is for that customer. Okay, customer related intangible asset, which is the secondary intangible asset. So distributor method is appropriate when customer related intangible asset, when another intangible asset, that is a primary intangible asset, example brand, technology, etc., is deemed to be the primary. Okay. So you have a primary intangible asset, secondary. So when distributor method you have to use, distributor method you will use only when you have the asset what you are going to do the valuation is a secondary intangible asset. Then you will use distributor method. Okay. So what is distributor method? I want to tell you one thing very important. Don't jump to a myth. It is actually a myth that 5 methods are there. 5 methods, all 5 are different. No. Actually, I will remove the heading. Okay, year, gear, everything I'll do. I'll give only the number. Only the table alone I'll give. I'll take the printout from Excel, I'll give. Mean table I'll give. With and without method table I'll give. And relief from royalty table I'll give. Without showing the heading and all, English and all, I'll remove it. I'll only give the workings. You will not be in a position to actually distinguish which method is this. Why? Because revenue, less expenses, tax, the depreciation, tax amortization benefit, everything you will take. Of course, there will be slight differences there, only 1 or 2 differences there. If you are very keen in observing that difference, you can identify. Otherwise, by looking at the arithmetic, you can't find out. There is a difference. And the purpose of going through this paras is only to understand that fundamental difference. Okay. So good. So this is distributor method. Now please answer this question. The distributor method is appropriate to value which intangible asset? When another intangible asset is deemed to be the primary. So this method is appropriate to value customer related intangible asset. So 18A. So please be careful. Now greenfield method. Now the word greenfield says, greenfield means first, new, fresh. Everything we have to begin from them. I was showing you some of this Mitra Samaj hotel and all I was showing you. Mitra Samaj, if they open a hotel in Bangalore, Delhi, okay, Bombay, Chennai, Kolkata, they'll do very good business. But they'll give franchisee. So I had a discussion with the Mitra Samaj people. So I asked them, see, your idli and vadas are so nice. Can you open a center in Chennai or Bangalore? So will you give franchisee? So they are actually total. So because that owner was there, the owner was actually 3rd generation owner. So a Brahmin person. So I was discussing with them along with my friends. So he was also very keen, but he said, we have been very traditionally doing this, so we don't want to compromise on quality. Just by giving franchise, our name we don't want to lend. If we have to do, we have to do like what we are doing here. But for that, we don't have the infrastructure, facilities. From here, the procurement of material, process, everything is there. So you may not get that quality there. So I don't think it is feasible. So we can't do it. So he refused. But let us presume that he agrees. I have convinced him he agrees. He is ready for the franchisee. The next question is how much I have to pay. Second, my business will start only based on his franchisee. Without his franchisee, where is the business? So that is why please look here. The greenfield method is often used for franchisee agreements and broadband spectrum. So how much I have to pay? Broadband. So in Rajasthan, 5G license has to be given. So 5G license, what is the valuation? And the entire business starts only after giving the license. That is what it's called greenfield method. So no license, no business. So very simple. Franchise agreement I am giving for 5 years. Year 1, 2, 3, 4, 5. What is the gradual increase in revenue? What are the expenses, variable expenses, minus your fixed cost? What is your profit before depreciation and tax and interest? PBDT minus depreciation minus tax. What are the tax amortization benefit? Add and then discounted. Arrive at the surplus. That is your present value of your franchisee business. So since you are going to earn that surplus, he will say, I need a share on this. 30, 70, 50, 50, 40, 60, something. So that is, so the method what I have been saying in the right from the past, all the arithmetic is it looks same. Revenue minus expenses, that this, you get a surplus in present value. That is only sharing. But the approach is different. So franchisee agreement and broadband spectrum. Now this is often used. Greenfield method is often used. Now please, this is a question. 19. Greenfield method is often used in estimating the value of enabling intangible assets such as franchisee, broadband, both ANB. So both ANB. So 19C. Very important. Okay. I don't say that the same question will come, but similar question will come. Same question also can come. Similar is so questions based on greenfield, questions based on broadband spectrum, questions based on franchising. And I want to mention one more thing. There is another question on broadband spectrum. Please look at this. This is in market approach. So therefore, you have to be very careful. Broadband spectrum, you also can do the valuation under greenfield method. And examples are intangible assets in which market approach is sometimes used. Sometimes. What for? Broadband spectrum. So don't jump to a conclusion. No. Broadband spectrum is also here in greenfield. Greenfield is income approach. So broadband spectrum here it is not, it is income approach or not market approach. Wrong. Which are the examples of intangible asset for which market approach is sometimes used, broadband spectrum is sometimes used. But there it is often used. So it is often used, here it is sometimes used. Okay. Broadband. Why? Rajasthan you have valued 5G. Now I want to give license to Chhattisgarh. Can I take the same Rajasthan valuation? You can, but Rajasthan is the largest state in India today after bifurcation of Madhya Pradesh into Chhattisgarh and Madhya Pradesh. Madhya Pradesh used to be the largest state. Now Madhya Pradesh is not the largest state. It is Rajasthan is the largest state. Rajasthan is the biggest state. So for Rajasthan, if you are giving Rajasthan include Registan and now so many things are there. That's very big. So if you are giving license for a 5G for Rajasthan, can the same valuation I can take for Chhattisgarh? No, because size is less for Chhattisgarh. So I need to do some tuning. Population is different. Okay. So therefore, market approach is sometimes used. I'll take the same, I'll do some tuning, adjustments. So broadband spectrum, internet domain name, taxi medallion, all of the above, 20D. Now, this is para 20.5 and very important para because I'm going to understand about the purpose of valuation. Please look at this. This is there in your syllabus, purpose of valuation. For what purpose you do intangible asset valuation? For NDA's requirement, financial reporting, or tax reporting, litigation purpose, statutory legal purpose, general consulting, collateral lending, transaction support. These are all the purpose. Now please answer this question. Intangible asset valuation performed for a variety of purpose. For what? Statutory legal? Yes. General consulting? Yes.
All of the above.
All of them. So 21D. Now, this is the purpose given in ICA RVO 302. Intangible assets, para 2. In IVS 210, para 20.10, purpose, they have only given 5 purpose. But in ICA RVO 302, para 2, how many purpose they are given? A, B, C, D, E, F, G, H, I, J. So 10 purpose they are given compared to IVS. So that is why never compare both and don't weigh both. You take the best of both. Okay. So here for business combination purpose, impairment testing, transfer pricing, okay, purchase price allocation, for merger and acquisition, and when you are using it as a collateral for funding, litigation purpose, bankruptcy restructuring, insurance purpose like finding the personal worth of a celebrity, and issuance of sweat equity shares. Okay, for all this purpose, we use valuation of intangible assets. Which are the following areas where intangible asset is required to value? Except bankruptcy restructuring, yes. Non-financial liability, no, we don't use it. Insurance, yes. Transaction measure acquisition, yes. So answer is 22B. Mean, multi-period excess earning method. Now, this multi-period excess earning method, I have to make one observation, very important observation. All of you guys, please understand. Now you are going to do the valuation of a primary intangibles. So we have finished greenfield, we have finished with or without method. Okay. Now we are distributor method also we are completed. Now mean method. Now you have to value the primary intangible asset. Now how will you do value the primary intangible asset? Very important. And please look at this. This excess earning method, you have a steps here. Okay. And I'm going to explain this step. Please. The excess earning method estimates the value of an intangible asset as the present value of cash flow attributable to the subject intangible asset. So you have the, say, technology is a primary intangible asset. The customer list is there. That is also another intangible asset. That is valued separately. You have working capital, you have land, building, plant and machinery, all this stuff is there. Now, how do you value that technology intangible asset, which is a primary intangible asset? So you have to find the present value of cash flows attributable to the subject intangible asset. How? After excluding the proportion of the cash flow that are attributable to other assets required other than the intangible asset. So then how do I do it? Quite interesting. This is what you need to understand this. It's called contributory assets, CAC. This is contributory. So what I do, I will find the working capital. These are all the working capital items. I will find the tangible assets. I will find the intangible assets other than the primary intangible assets. Okay. So I will arrive at the rate of earning. Contributory asset charge means what is the, for example, what is the total revenue? Okay, what is the total revenue minus expenses? When you are making the expenses, you should also eliminate the contribution of these assets to the main revenue. That if you knock it off, the balance revenue is from the intangible assets. That is most important. So that is why it is called contributory asset charge, and that is Very interesting. Please look at this para, you will have an idea. Contributory assets are defined as assets that are used in conjunction with the subject intangible asset in the realization of prospective cash flows. Assets that do not contribute to the prospective cash flows, it is very difficult to identify the income from that intangible asset. So what I will do, I will take the company as a whole revenue minus expenses minus the revenue that would have been earned by the other assets other than the intangible assets. I will take that as a percentage of their investment. That is revenue out of their investment. So it's called contributory asset charge. That I will knock it off. Technically, it is a revenue from them, but from the total revenue, if I knock it, netting it, then it is called a charge. Very interesting term. Yeah. Well, like for example, a certain amount of real property, like land and building, may be necessary to support the cash flow to a subject intangible asset. Alternative, land held by an entity for investment would not be appropriate to include as a contributory asset if the land is not necessary for revenue generation. It is only kept as an additional investment. Then it is not a contributory asset. So that is why you need to study, and whenever you are doing the meme method fees will be higher than fees for market approach or fees for cost approach for kind of information. So it's very interesting. So now please answer this question. Which method estimates the value of an intangible asset as a present value of cash flows after excluding the proportion of the cash attributed to other assets? It's called exercising. That is why the word is called multi-period exercising. Multi-period means 5 years, 6 years, 10 years, 7 years. Multi-period exercising method. So 23A. That excess earning belongs to that primary intangible assets. Okay. And 24. 24 is a very interesting question. Please look at this. There is an exam question. The distinguishing characteristic of a CA, contributory asset charge, in valuation intangible asset using the meme excess earning method is, it is a subject income generating asset. No, it supports the income generating asset. That is why you are knocking it off. It is irrelevant. No, it is relevant. Then only you will get the excess earnings. If you don't knock it off, excess earning will not come. So it supports the income generating asset. So 24B, very important, guys. If you understand the concept only, you can actually answer these questions. Now I'll solve this beta, bottom of beta question a little later. I'll go to the next question. Relief from royalty. Okay. So what is relief from royalty? Now, if I buy, for example, what relief from royalty example, trademark, brand name, these are all, how do you do the valuation using relief from royalty? Now, there is a guy who's company who's the owner of a trademark. So I want to do business. You want to spend money and buy the trademark? No. You give him some charge, you give him some percentage on the revenue what you earn, you give him some percentage. Best. So rather than buying it out. So whether buying or renting, which will be better? That is a different question. But while valuing the relief from royalty, what you will do is, how do you value an intangible asset? What is the revenue for it? The revenue is in case you lease that intangible asset, you will be paying a royalty. That royalty will be a saving if you buy that asset. This is the concept here. So I will presume that I am going to buy that. Then what is the value of it? I mean, that is what you have to pay. So what is the saving? Saving will be the royalty saving. That would be saved. Now minus all the expenses, you will do it and arrive at the present value. So under which method the value of intangible asset determine reference to the value of a hypothetical fee payment that would be saved. This sentence, if it is there, is relief from royalty. Hypothetical payment that would be saved means relief from royalty. Okay, 27B. Good. And remember, guys, this is a very interesting term in international valuation standards. In IndAS, they'll only use a term called useful life. They never use a term called economic life. But in IndAS 116 leases, they use useful life as well as economic life, for your information. And in IVS 210, they don't use a term called useful life. They use a term called economic life. For example, your useful life will be 7 years. But for that intangible asset, another competitor is developing another much better model. And in another 1 year or 1.5 years, it will hit the market. Then what will happen? You will say my intangible asset is life is there for 7 years. But economic life worth is not there because much better model is available in the market. So what is economic life? 2 years. What is useful life? 7 years. Right. So now please answer this question. An important consideration valuation of an intangible asset, particularly under the income approach, is the dash of the asset. The remaining useful life of the asset, Govinda. It is gone. It is economic life of the asset.
Economic life.
Huh?
Higher of your
No.
Economic life. Economic life, sir.
Please look at this. An important consideration, the value of an intangible asset, particularly in income approach, is the economic life of the asset.
Economic life.
This is under para 100.1, IVS 210, section 100. Okay, good. So now I have to go to IndAS 38. Should I have to do or not? I don't know. Maybe let me hear from Shraddha Dacholia.
So pardon please.
Today morning, whether IndAS 38 was covered?
Yes, sir. We started with the INDS 38.
Yeah. So what and all was covered in that?
Sir, just a second.
So if it is covered, then directly I will go for MCQ.
Sir, objectives
Covered.
and terms, and yes, it was covered. And we did the MCQs mainly.
Okay. So then I will also go to MCQs. So I'll give a 15-minute break. So you can have a cup of coffee and tea, and then you can come back. So Manasi Vatarkar.
Yes, sir.
So you can have a cup of coffee.
Yeah, it's required.
So what is your feedback about so many points what we have covered in valuation intangible assets? Any questions are there? Your feedback, please.
No questions, but it's very vast, I think. Yeah, that's it.
Okay. So after 15 minute ke baad,
Yes, sir.
Good evening, friends.
Good evening, sir.
Yeah, shall we start?
I think others are yet to come. We should wait for 1 or 2 minutes more.
Yes, Mr. Purushottam, very good evening.
Good evening, sir. Good evening.
So, how's your day?
Today is good, sir.
Good. So, let me now share the screen. Yeah. So now directly I will jump to an MCQ. This is with respect to scope. This is from para number 3 of India is 38. India is 39 applies to. Now, if I show you the India is 38 para number 3, please look at para 3. If another standard prescribes the accounting for a specific type of intangible asset, an entity applies that standard instead of this standard. So, how many such standards are the 9 standards? So, 9 such. So, one is India is to inventory. So, if you are dealing with an intangible asset, which is an inventory, then India's 38 is not applicable, 2 is applicable. Similarly, deferred tax asset. Similarly, India is 116, which is applicable from 1st April 2019. India is 19. Similarly, financial asset, India is 32. Then goodwill in a business combination. Then India is 104 for insurance contracts. India is 105 for non-current asset held for sale and discontinued operation. Similarly, contracts arising from customers. That is discussed in India is 115. So these are the 9 intangible assets. We have a separate prescription in the respective standard. So now, please answer this question. India is 38, then applies to non-current intangible asset classified as held for sale, which is excluded in India's 105. Financial asset, which is excluded in
Financial assets.
intangible asset held by an entity for sale in ordinary course of business, included in 2. Intangible asset is included in India's 38. Okay, good. So that is with respect to 3. So this is 1D. Then let me take you to question number 2. So what are intangible assets? So you have this definition in para number 8. Look at para 8. Para 8, you have the intangible asset definition. This is what I showed you at the beginning. Identifiable non-monetary asset without physical substance. So now, can you guess which is the right one?
C, sir. C.
Identifiable non-monetary without physical substance. Good. 2C. Good. Now let me take you to the third question. Third question, I have to take you to the definition of an intangible asset when you will do the recognition. This is there in para number 10. Okay, look at para number 10. So, not all items described in para 9 meet the definition of intangible asset. So, when it will meet the recognition criteria, it should be identifiable separately. If it is part of any other business, it cannot come under India's 38. There should be control over the resource and existence of future economic benefits. So 3 things: identifiable, control, and future economic benefits. So these are the 3 for recognition. Now please answer this question.
Yes, sir. A.
So which are the attributes definition of intangibles for recognition except
A.
A? Because all the other 3 are there in para number So now I want everyone to participate. So Mr. Manmohan Sharma, Purushottam, Anasi, Shraddha, Shalini, Arun, everyone should give voice. Okay.
Yes, sir. Yes, sir.
The entire internet should earthquake. Okay. Voice. So now fourth question. Fourth question is when it will be recognized. I'll take you to para 21. Para 21. So this is in bold color. Intangible assets shall be recognized if and only if two conditions has to be satisfied. There must be future benefits and cost can be measured reliably. So now which will be the right answer? I don't want to say.
C, sir. C.
It's probable that
It is probable. Yeah.
Okay, so C.
Or C.
So now let us see next question. An intangible asset shall be measured initially. So this is in para number 24.
1D.
No, you should not give me ABCD. You should give me the English word. And out of the entire
cost.
this para is the shortest para. After this, there is another short para is there. That also I will tell you. This is the shortest para. So which is the right one?
It costs, sir.
Cost.
Very good. So like this, the gunjana, I must hear the echo. Okay. The valuation aspirants echo I must hear. Good. So now this is with respect to the cost of an intangible asset, and I will take you to para number 28. What are the direct attributable costs which you will add to the intangible assets? Cost of employee benefits arising directly from the assets to its working condition. Professional fees for bringing the asset to its working condition. Testing cost. These are the three you will actually consider as a cost of an intangible asset. So the cost of an intangible asset, separately acquired intangibles, includes the following.
Administration and other general overhead costs.
So which is the answer?
A, sir.
Administration and other general
Administration and other general overhead costs.
Administration and other general overheads. Very good. Then, now let me take you to para number 44. This is with respect to government grant. Very interesting. It is even India's 20 is also applicable for this para, because I'll just share with you an interesting one. Many of our Institute of Chartered Accountants, Institute of Company Secretaries land, and Institute of Cost Accountants land is actually contributed by government and the state government also. For example, Institute of Chartered Accountants of India, Nellore branch. Nellore branch is on the national highway. They have been allotted 2 acres. The market value of the 2 acre will be 2 crore, but it was given at a price of 2 lakhs only. Now tell me, in the Institute of Chartered Accountants of India's balance sheet, will you account that as 2 lakhs or will you account it as 2 crores?
2 crores.
If Ind AS is applied for value, if Ind AS is applicable for financial reporting of Chartered Accountants of India.
2 lakhs only.
Yes.
2 lakhs.
2 lakhs only.
Yes.
Now please look at who says 2 lakhs? Who says 2 lakhs?
2 crores, I said.
No, who says 2 lakhs? Name, Naam.
Purushottam.
Purushottam, just tell me, Mr. Purushottam, why 2 lakhs?
Because that is the cost at which government has allotted to
Very good. So let us wait. So we need both the answers. Then only we'll know which is the prescription. I am not saying. Let us see what 44 says. In some cases, an intangible asset may be acquired free of charge or nominal consideration, 2 lakh, by way of a government grant. So 1 crore and 98 lakhs is government grant. So this may happen, etc., when government transfers the land again, data, right ticket, everything. In accordance with Ind AS 20, accounting for government grant, an entity recognizes, ICA recognizes both the intangible asset and the grant initially at
Fair value.
if Ind AS is applicable. So now please tell me, an intangible asset, blah, 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 blah. So an entity shall recognize both the intangible asset and the grant. So here intangible asset 2 crore, because 2 lakhs is land, 1 crore and 98 is the intangible asset on that land. What is that? Is actually goodwill. Is it goodwill? What is that 1.98? 1.98 is grant. Grant given. So instead of government giving you money, they are given you land. So therefore, you have to recognize that as a grant. So you have this 1.98 crore grant, asset you capitalize 1.98, so it will be 2 crore grant. So out of 2 crore, 1.98 grant is given by Andhra Pradesh government. How 1.98? In terms of fair value. In terms of fair value, they are given grant. So that is 7A. Okay, good. So now, if an intangible asset is exchanged for another, so I will give intangible. I will give my formula, my coding. I am a software engineer. I will give a code. For that, I am given a share. Then how to do the valuation of that intangible asset? You have the answer.
Market price.
Market price. So let us see the prescription in para number 45. AEA para 45. One or more intangible asset may be acquired in exchange for a non-monetary asset or a combination. The following discussion refers to simply an exchange of one non-monetary asset for another, but it also applies to exchange in the preceding sentence. The cost of such intangible asset is measured at
Fair
Fair
value.
value.
para 45. So 8A. Wherever measurement is there in the standard. Okay, be thorough. Now, internally generated goods is a very popular question. Very, very popular. So many times it has come in exam. Okay, this is
Not
Not recognized.
Not recognized.
para number 48. Always remember, you must note down the para number also and read the para. If you are not read the para, you are not read Indians. So internally generated goodwill shall not be regarded, recognized as an asset. Para 48. So now answer is 48. That is para 48. Answer question number 9 is B. Good. I have a fancy towards this question. I have a liking for this. Now this a very similar paragraph will be there in other Indias also. An entity shall assess the probability of expected future benefit. Okay, so what is the benefit I will get if I expect the future economic benefit as very high value, my intangible asset also will be very high value. If my probable future economic benefit is less, the present value will be very small. Intangible asset is small. Now, who actually assess that? That represent dash of the set of economic condition. So, is it market's best estimate? Is it valuer will do the estimate, or auditor will do the estimate, or management will do the estimate? Who will do that estimate?
Actually, management has to do the estimates, sir.
Okay, is it given somewhere, or it is your? Whose answer is this?
It's my answer, sir.
Who is my?
Arun, sir.
Arun Vishwanath, Arun. I don't want anybody's your answer. I want the answer of the standard. So let us go to standard. Standard para number. Para number 22. 22. An entity shall assess, because this is bold color. So shall assess the probability of expected future economic benefits using reasonable and supportable assumptions. That represents
Management system.
management. So therefore 10C. Okay, good. Then, how often should the useful life of the intangible asset with the finite useful life be reviewed? Any answer?
I think yes, sir. At least each financial year end.
Is it or any other alternative?
Financial year. A.
Okay, so I'll take you to para number 104. Please look at para number 104. This is para 104. Review of amortization period and amortization method. So the amortization period and amortization method for an intangible asset with a finite useful life. There is another intangible asset which will have an indefinite life. Indefinite life.
Yes,
It's
yes.
not infinite. Infinite is wrong. Indefinite. Finite useful life, indefinite life. Okay. So finite useful life shall be reviewed at least at the end of each financial year. So para number 104. Okay. So at least at each financial year. Good. So now what is the answer for this? Now residual value, because you have to amortize means the cost minus residual value only you will amortize over the useful life. So residual value of an intangible asset with a finite useful life shall be assumed to be cost of disposal, value in use, zero, carrying cost, which will be the closest answer.
B, sir. B, sir. 0.
Zero.
So let me take you to para number 100. Bold color. See here. The residual value of the intangible asset with a finite useful life shall be assumed to be 0. Unless, so this can also be an exam question. Unless there's a written contract that this will be the purchase price. So there's a commitment that there will be a purchase at the end of the useful life. Okay. Good. So that is with respect to this. Now let us take a 13th question. To assess whether an internally generated intangible asset meets the criteria for recognition, an entity classifies the generation of the asset into
Development phase.
Development.
Development phase.
So let me take you to para 52. To assess whether an internally generated intangible asset meets the criteria for recognition, an entity classifies, there is a plural. You should classify the generation of asset into, this is a very tricky, first research phase and development phase. So please understand, it is not research or development. We always say R&D only we'll say. We not say R&R, RRD we don't say. We always say R&D only we'll say. So it is research and development. So an entity shall classify. So once you classify it is research phase, charge off to revenue. If it is development phase, you have to measure it and capitalize it. So that is why it is both A and B. An entity classifies the generation into research phase and development phase. So it is 13D. Here you can. Para number 52. Para number 52. Good. An entity shall choose what assets accounting policy for intangible assets.
Sir, it is C, sir. Either A or B.
Or A and B.
Either A or B.
So let us see para 72. 72 says an entity shall choose. The moment the word is there, choose, that means 2 is the answer. Catch. Shall choose. The moment they say choose means answer is 2. So shall choose either the cost model or the revaluation model. So either the cost or evaluation. So answer is C. 14C. 90% of the answer you can select by reading the question properly. Okay, good. Now, very important question. Let's see.
Indefinite. Indefinite. Useful.
Yes.
Answer
It's
B, sir.
infinite.
Indefinite.
Infinite.
Infinite. Okay, right. So now
Yes.
I'm taking you to para number 88. Yes. An entity shall assess whether the useful life of a tangible asset is finite or indefinite. So I told you there is no word called infinite in standard. It is only indefinite. And they are given an explanation also in para number 91. Please look at this. The term indefinite does not mean infinite. So the useful life of an intangible asset reflects only the level of future maintainable expenditure required to maintain an asset. Now, generally, will an intangible asset be indefinite? Yes. Yes. You actually patent, you get a patent from the Indian Patent Office. So the patent is indefinite. Once you got a patent, it is indefinite life. So generally, all patents. So in some software, some software, some formula. Okay, you have patented it. All patents will be indefinite life. I'm telling you. Okay. So an entity shall assess whether the useful life of an intangible asset is finite or indefinite, and if finite, the length or the number of production of similar units that will be having useful life. So finite means useful life will be there. Indefinite means useful life will not be there. But I will not answer this question. There will be a separate MCQ on this. If it is indefinite, what we should do? Shall we leave it from the balance sheet itself? We will not touch it. It is untouchable. What to do? We'll see. So an intangible asset shall be regarded by the entity as having a. Okay, I think it is next para. An intangible asset shall be regarded by an entity as having indefinite. So when it will be regarded as indefinite? When, based on an analysis of all the relevant factors, there is no foreseeable limit to the period over which the asset is expected to generate net cash inflow. So it goes on. So I'm not able to see the end for it. So then it is indefinite. Okay. So there is no foreseeable limit. So then it is indefinite. So 15B, para number 88. Okay. Now you have a question on indefinite useful life. What should I do?
Yes, sir. Shall not be amortized.
Shall not be
Shall
amortized.
not be amortized, yes.
Okay. So you have the answer in para 107.
It's like land.
Yeah. So an intangible asset with an indefinite useful life. Okay. So it will not be amortized. Only finite, okay, useful life will be amortized over its useful life. Because I don't know the useful life as well, then how can I amortize? So 107 is A. Para number 107, question number 16A. Good. Now, so now in accordance with India's 36, reassessing the useful life of an intangible asset as finite rather than indefinite. Very tricky question.
I think it is B, sir. It's an indicator that asset may be impaired.
Okay. So any other answer?
Indicator to change the asset.
So it's an indicator to change the asset. Good. So let's see. I'm taking you to para number 110. Yes. In accordance with India's 36, reassessing the useful life of an intangible asset as finite rather than indefinite. Okay, so every year, please look at this. The useful life of an intangible asset that is not being amortized shall be reviewed each period to determine whether events and circumstances continue to be indefinite. So the moment it is indefinite, every year you have to do review of that indefinite period. The moment it is definite, so meaning what will be the indication? So that it is indefinite is an indicator that the asset may be impaired. So reassessing the useful life of an intangible asset as finite rather than indefinite is an indicator that asset may be impaired. So very important. Okay. So this is a prescription not of Ind AS 38. This is a prescription of Ind AS 36. Please look at this. Ind AS 36 is impairment of assets. We are in actually Ind AS 38. In Ind AS 38, they are giving the prescription of Ind AS 36. Okay, so that is a very interesting point. So 17B, para 110. Okay. So actually, this para is copy paste from Ind AS 36. Okay. 109 is prescription. 110 is recommendation of Ind AS 36. Anyhow, Ind AS 36 is also there in our syllabus. But even though it says Ind AS 36, this is not Ind AS 36. This is from Ind AS 38. Good. So this is actually with this beginning question. Identifiable. There are 3 criteria. It should be identifiable, future economic benefit should be there, and it can be reliably measured. So, what is identifiable means?
Which is separable, like which can be seen separately.
That's good. So let me take you to para number 12. Okay, para number 12. So an asset is identifiable if it is either or. Either is separable. Why it is separable? Meaning it is transferred, licensed, rented. So individually, it is having a separate existence. So, for example, franchisee. Franchisee is because of a license you have got. So that is why it is separable. Or arises from contractual or other legal rights. For example, right of use of an asset, especially in a leasing agreement. In a lease agreement, right of use of an asset is actually a intangible asset. So that is why I'll just share with you. This is Bajaj Finance. Please look at this Bajaj Finance. This is property, plant and equipment statement. This is actually 1920. And here, please look at this. They say property, plant and equipment and intangible assets. And here they say freehold, building, computers, office equipments, furniture and fixtures, vehicle, lease or improvements, right of use. And intangible assets, you have computer software. So the right of use will come. So right of use is coming because of the leases which you have taken. So leasing agreement as a lessee, you have the right of use of a premise. So arises from contractual or other legal rights. So an intangible asset is identified. So it is either A or B. So 18C. So 19. So let's see who gives me the right answer.
I think these are both A and B.
A and B, facts and circumstances.
Facts and circumstances. This is actually a landmine question. You have to be very careful. Very careful. The entity uses what to assess the degree of certainty attached to the flow of future economic benefit that are attributed to the use of an asset on the basis of evidence available at the time of initial recognition, giving greater weight to external evidence. I am taking you to para number 23. because this will come in recognition, and here you have to probable the expected future economic benefit. Now remember, the moment you are going to expect the future economic benefit, future means no circumstances, no facts. Past only facts and circumstances. Present only fact and circumstances. Future, nobody can say which is correct. So facts and circumstances is wrong. So always future means, remember the definition of the value. The definition of the value, I want to show this part. Sorry. So I will take IC evaluation standards. So here itself, I'll show you the definition of value, and in that 101 they have the definition. Now please look at this. Value means two words, remember: estimate, and remember the word judgment. Always remember, value means it is estimate, and it is based on value versus judgment. That is why when two valuers they are estimating, their judgment is different, estimation will be different. So value will be different. So come to this question 23. An entity uses judgment to assess the degree of certainty attached to the flow of future economic benefit. Future means judgment only. Always remember. So 19C. It's a very tricky question. Not a gold mine, land mine question. Boom. And next.
Sir, A, cash price plus equivalent interest.
Anything else? Okay, so I'll take you to para 32. 32. If payment for an intangible asset is delayed, I buy an intangible asset. For example, I take a software, I buy a software, 2 lakhs, 20 lakhs. I pay only 5 lakhs, balance 15 lakhs, I pay after 6 months. So now what I should do? If the payment for intangible asset is deferred beyond normal credit terms, its cost is the cash equivalent. Its cost is the cash price equivalent. So if payment for intangible asset is deferred beyond normal credit, its cost is, because you have to value at cost. What is cost? Cash price equivalent. That means what is the cash down payment? If you are giving it today, what is the cash down payment? You recorded that. And if you are paying more than that, the difference is actually the interest, and that will be recorded as per the prescription of India AS 23. So the recognition of that will be done as per India AS 20. So therefore, cash price. So you will feel as though you have to record even the equivalent interest also, but equivalent interest will come in India AS 23. So 20B. So very interesting. So any questions so far? So Shalini ji, आप कुछ बताइए. And we have who's the other friend? Govardhan. Now only I'm seeing your face. So you had a good sleep?
Not sleep, sir. Had Booja in office. Unavoidable. So my senior partner is not feeling well, so I need to attend.
So from which question to which question it was Pooja? Question number
No,
1
no,
to question number 20.
almost, yeah. I joined some last 5 questions are here.
Oh, last 5 questions you had there. Very good. So, Shalini ji, आप बताइए.
It's a nice this thing. It's a kind of revision what we have learned in early morning, and quite a few things are coming back to us. Yes, we have read this, we have read that. So it's kind of refreshment of what we have learned in the morning session. And yes, we have to study this accounting standard very thoroughly, and I think make our notes kind of thing so that it should be understood in a proper way, and only thereafter we can answer all these things properly.
Arun Vishwanath, Tripurari.
Yes, sir.
So you are answering very well, very good.
Yes, sir. As ma'am said, in the morning session only, Ind AS 38 has been told by the sir.
Very
So it is just a revision of what he has told. So we could give the answers.
So Manasi Vatarkar. So I am sure you can do well.
Yes,
So
sir.
1 week is there. So next week, and my suggestion to all of you, once this 50 hour is over, immediately take a slot. So don't wait for no, I am not prepared. What I will do. Go and write exam. Exam will teach us. So it will tell where the gap will be. And I'm telling you, with your being all of you are lateral entry participants, so you have a good amount of experience and knowledge and education. So you will get minimum 40 marks. So the challenge is your preparation is between only 40 to 60. So you will know where and all you have to actually focus. And out of this 80 questions, 1 mark question, 20 questions straight away you can answer by looking at the question. Oh yeah, I know this. This should be the answer. You will be confident. 20 questions you will be confident. And there will be another 20 questions which will be from kahan se ball aa raha hai, you don't know. You will only swing the bat in dark. So that is how the questions will come. So you need to have an in-depth study in every topic to actually understand that question. So 20 will be very easy. 20 will be extremely, they will, that is the place where they will hold your mark. And another 40 marks, it will be this side and that side. It all depends upon your conceptual clarity on the subject. So there are guys who are able to, I'll tell you one very interesting participant, she actually got 60.25 by answering only 57 questions. 57 questions, she got 60.25. Anything 60 and above is a very good mark. She cleared. So answer only 57. And there are people who answer out of excitement. One more, let me do. So 59.75. So actually, what the person should have done is one question, if he or she hasn't attended, that minus 0.25 wouldn't have come. She would have cleared. He or she would have cleared. And there was one candidate who actually got all marks between 50 and 60. 59, 50.25, 59.5, 59.75. You know, she gave me a very big message. Sir, between 59 and 59.75, I got everything. So I am more experienced. So the point is, you should not be excited with that. So once you have crossed that 40 questions, once you are confident with 40, from there scoring every mark, please do it very carefully. Unless otherwise you know, so calculate it. So good. Manmohan Sharma ji, I think he is technically online but physically offline. तो मनमोहन जी बताइए आप कैसा था ये 4 दिन का मेला? सर आप you have to unmute.
Sir, you observed very right. I'm technically online, technically offline, but actually online. The only regret is I should have like be prepared by studying before taking these classes.
Oh. आपको एक शुभ खबर सुनाना चाहता हूँ.
Sure, sir.
मनमोहन जी के लिए. मनमोहन
Yes,
जी.
sir. Sure.
Those who have crossed 50, 55, 60, they don't take more attempts like juniors. Seniors, they take very less attempts. Sometimes they even clear it in first attempt. So you have a fair chance, sir.
Thank you, sir.
So you have to.
Yeah, I did IRP in the first attempt itself.
मैं तो ठीक ही बोला था.
Thank you, sir.
So please book your slots immediately after 50 hours is over. So don't be bother about the level of preparation. Just go. Okay. And all of you can clear the course with good marks. So my best wishes. Govardhan. So let
Yes,
me
sir.
tell you about your preparation. 4 दिन का 4 days Mela. How was it?
Yes, sir. Fine. Few subjects were fine. And as far as the bonds and other things are concerned, I feel, I need to go through it once.
Not go through and all. You have to practice. Take a notebook, pencil, pen, okay, and then practice. Only practice can give you that.
Yeah.
Sir, only out of excitement, 5-6 marks will be gone, sir.
So don't be emotional, okay? No commotion, emotion in exam.
Sir, just tell me one thing. Is it okay to select few topics, prepare it completely and take up the exam rather than covering all the topics? Like, say, valuation, Ind AS, accounting part, and the economics. Say, for example, I'm just saying, okay, those part let me completely prepare and shall I go and take up the exam rather than, concentrating on the entire syllabus, which is more impractical, but to master it, I'm saying. Is it okay?
Actually, what will happen is if you give entire spread, you will somewhere that portion will help you to actually cross that winning line.
Okay.
So, though it is actually will look very, very unfortunate when people they get marks like 54, 55, 56, 57, 58, 59. That time you will actually understand. Yeah. I think I should have actually, because the 2 or 3 marks
makes a difference.
Very, very important role. So you should be like Sunil Gavaskar. Every ball score. Okay. Okay, not like Kapil Dev. Not like Virat Kohli. Virat Kohli will be either 90 or 0. No. So be like Sunil Gavaskar. So thank you very much.
Thank
so
you, sir.
Let's hear last from Purushottam ji.
Sir, I have this subject is okay, but problems I have to solve more.
Please. Okay. So my best wishes. Thank you very much, and So I want to leave Sunday evening quite early. So please have your good time and happy Dashara, happy Navaratri, happy Saraswati Puja, and this Vijayadashami should bring a lot of prosperity and good health, and maybe we should develop in our profession, especially post COVID-19. Although slow down should actually go and it should pick up the speed. What we were in 2019, we should. Thank you.
Thank you, sir. Wish you the same.
Thank you, sir. Wish you the same.
Bye all.
Bye, ma'am. Wish you happy Dasra.
Same to you. Meet you next weekend.
I think only one class is there, ma'am, next week, or 2 classes?
Yeah.
Only Sunday, I think only Sunday we have class, I think, ma'am. I think only Sunday we have the class, I think.
Okay.
So
I have to see that schedule. Actually, I haven't seen that. This week I have seen. Next week I haven't seen. Is it, we don't have classes for Saturday?
Yes, ma'am. Better we check the schedule.
Okay. I'll do that. Thank you for telling. Thank you. Bye,
Thank you,
sir.
thank you. Sir, shall I call you, sir?
Yes, you can call afterwards.
Okay, sir. When can I call, sir?
Another 5 minutes. Now itself I can call.
Okay, sir. Then I'll call you, sir.
I don't have problem.
Okay, sir.
Right.
Okay, sir.
Thank you.
Right. Thank you.